7 certification sooner rather than later, and we need that aircraft, and it's a wonderful aircraft.
I want to thank,
Phil, thank
Bob
you
for coming on the set and Phil for visiting us, because I've been negative on the stock, as you know, but I've changed that stance. It's just too good an opportunity, even though your price
we appreciate it. Thank you all for the time. Thank you, Jim.
When we come back, we'll get Cramer's Mad Dash, countdown to the opening bell, take another look at futures here holding in. 10 years still sub 4, and the 30-year just about 11 basis points away. Don't go away. Futures remain green. So many interesting numbers this morning. 10-year 396. VIX is right at 12. The dollar index almost back to 102. And of course, the all-time closing high on the S&P, 47.96, would be just about 90 points away. We'll get the opening bell in 4 minutes.
get to a mad dash. You have a very little amount of time. We got an opening bell in 45 seconds.
All right. Look, Raj Subramanian's not getting the recognition he should at FedEx. Bernstein today just talks about, can FedEx continue to put points on the board in a down market? Yes, they can. This is about a transformation of FedEx, and I think that this stock, as high as it is, goes higher because Raj is doing a killer job. He's just crushing it.
Margins keep going up?
Yes. And Raj, look, Fred Smith built a great company. Time for new blood. Raj is taking it into overdrive. This pen's called drive. I like this stock very, very much.
Let's get the opening bell in the CNBC Real-Time Exchange. The big board, it is B of A, celebrating its sponsorship of Bryant Park, one of the best places in New York City and the Winter Village there. At the NASDAQ, Alico, an agribusiness and land management company. Jim is up to 47.23 today.
Yeah, look, I think that there's a big pivot. You got to watch Mag 7 versus everything else. Watch a Zions Bank. Watch a bank like Comerica, which everybody was really worried about. Watch Schwab, which at one time people were worried about. Those are the ones that I think can really have a move. And then, even though they're up big, the home builders will do better. But I just think that this is also a Home Depot market. Like, if you start feeling better, you're going to remodel and renovate. And a lot of people are not remodeling and renovating. That stock may be another stock that you want to be in.
What did Langone say yesterday? Of course, he's one of the old founders of Home Depot. I mean, the returns on that company's stock since inception since it went public, are amazing.
Well, look,
yearly, I think.
Yes, they are amazing. And if you think that shrink has peaked, they have a terrible shrink problem. All you have to do is you look at their private label brands that are for sale right now on Amazon.
Yeah.
They don't sell on Amazon.
Oh, so people are stealing them and selling them on Amazon.
And then they have website.
Right.
That's not a really good thing.
No, it's a bad thing.
Yeah, but you get some great deals. And I think everyone belongs to jail.
We gotta figure out something. Yeah, look at the return. Look at the return. There it is. Thank you, guys. Look at that.
Will you look at that?
Look at that.
It's fun. The stores are packed.
Wait, that's almost 1,000,000% return.
The stores are jammed, like my wife has said, more than she's ever seen.
To be fair,
gorgeous, too.
That is 42 years, but...
Well, David, it's a fantastic place to shop.
Jim, that's wealth creation.
Yes, it's wealth. But this is discovering Home Depot. It's where you go.
No, I mean, come on. Did you know it was 1,000,000%? A million?
1,000,000%, no. But I do know that this is what the market does. But maybe we should just sit here and talk about wealth distribution and the rich and the poor and Congress and how we got to look at the 2-year and the 10-year and forget that 1,000,000%, David, because that's only available for people who do the homework.
You could have come with a mad dash in 1981 and said, hey, put away Home Depot, and then you wouldn't have had to say anything again. You could have just shut up for the next 42 years.
Do you think I'd be here? I love this company.
Yes.
Home Depot.
Yes.
My wife was sending me pictures 2 days ago from Home Depot. And just the sheer number of people. Incredible.
Jim, your point about the regionals is a good one because Schwab, Citizens, Truist, Key, Regions, Zions, all helping to lead the market here up 4 or more.
That's a percentage gain. That's what you want. We play for percentage gains. We don't, we don't want 4 more points in Microsoft. We want to get the 5% in Regions Financial, which we thought was left for dead. 8 times earnings, 5% yield. I now feel much better about the yield, and that's what you're looking for. And now people say, well, where's Regions Financial? Well, it's in the South. Nothing the matter with that.
Adobe, you had Shantanu on Mad Money last night.
Yes.
Adobe stock is down over 6% after reporting earnings after the bell yesterday. It seems to be, despite what was a strong fourth quarter, Jim, that they did lower their fiscal year 24 expectations in terms of guidance.
Not the first time he's done that.
No. What do you think?
I think you wait for another day, maybe tomorrow, but then you buy it because even though he lowered guidance, every division is on fire. And he's done this before, usually wait a day or 2, and you get back in. Now, of course, in a Fed rate cut, it may not be the ideal stock to buy. But, David, I'm going to go back to your world, okay? This Figma deal is very important for them.
Still, right. They're still waiting on approvals on
And
the
I think
Figment
the
deal.
Justice
Private company,
Department-
by the way. Private company.
But I think
that
the
they paid a huge number for.
20 bill.
Yeah.
But I think the Justice Department doesn't want it to happen. And Shanta and I were batting back and forth that there are now so many new companies in the area that since the Justice Department got angry, this is very typical. Like when Justice Department went after Google, that was before TikTok. I mean, TikTok is killing Google. So, I mean, why should we worry about Google? TikTok's killing everybody.
Well, that is the old criticism of antitrust policy in general. It can never keep up with the dynamism of the market.
Wow, it's good.
Thank you.
Good.
Every so often.
He's so good.
You know?
Dynamism of the market. Wow. Look, this is just one of those moments where you look at what's worst, decide if it has a good balance sheet, and if it has a good balance sheet, you can get in, which brings me to Foot Locker. Foot Locker upgraded. Okay, it does not have a good balance sheet. My trust owns it. It's been disappointing, but not anymore because they're talking about full price merchandise. What's bedeviled them is discounting. They had $1 billion in inventory that wasn't good. They're going to close like 70 champs. This is Mary Dillon. It's never paid to bet against Mary Dillon. She turned around Ulta. She's going to do it again with Foot Locker. Wow. Even as everybody feels that she doesn't have the horses. She's got Nike. She's got New Balance is doing incredibly well. People don't talk about New Balance. Don't forget Hulk is doing well.
We're going to get, we got the Foot Locker upgrade. Piper goes to overweight. We'll get Costco tonight.
Costco's going to be one where I think we're going to say, well, that's an A student. I'm looking for a C student that's going to become an A student. I don't need an A student. It's been the best stock.
That was an all-time high yesterday, and again today. I would think maybe Etsy. These layoffs.
Yeah.
Bernstein today calls it the new eBay, and a good short.
That's so aggressive. I think that's wrong. I think that Josh Silverman was overstaffed. I think that there's a lot to like, but it was one of those companies that are like Ohana, like Salesforce had. With the Ohana, before Elliott got involved, Elliott was not as interested in the Ohana. We're Hawaiian family.
The Hawaiian word for family is Ohana, right?
Right.
And Salesforce had a more Ohana approach.
Yeah, but that went out the window.
And then when they got a bunch of activists, they started to focus more on margins, and perhaps that meant actually not hiring as many and even firing some people.
Yes.
Yeah.
Yes, they actually are down 10,000.
So your point is on Etsy, what? That they were overstaffed?
I just think that Etsy could be a remarkable stock again, but obviously they had too big of table employment.
Yeah.
Right here in Brooklyn.
Right here in Brooklyn.
I happen to think that that obviously they're worried about Christmas and probably not that good, but I also think it's a franchise. It's a good franchise.
You do?
Yeah, I do.
Let's talk a little Moderna, because that stock is up sharply.
Yes.
It does typically trade in big increments percentage-wise on news, sometimes not even on any. But this morning the news is potentially a real positive for people with resected high-risk melanoma. They've been testing their cancer vaccine, essentially, for lack of a better term, with Keytruda, of course, one of the great cancer-fighting drugs from Merck, and they got some decent results, Jim.
Yeah, I think I'm so glad you call it the vaccine, because when I first interviewed Stefan Bancel, it was at the J.P. Morgan conference. The stock was at 11. Remember, stock went up big, and he said we're going to develop vaccines for cancer, and I said I'll believe it when I see it.
I know.
And then he did it.
And then he did. Stefan Bancel was a guest on Squawk Box this morning talking about this latest trial. As you can see, sort of the headlines on it right there. Take a listen to what he thought.
Now at the 3-year mark in the same study, we're showing almost 50%, meaning the two curves are differentiating further as time goes by. And that's really exciting because not only we think it will have a huge impact on melanoma, it's 1 in 2 people. Think about the number of lives that can be impacted, number of people that can be saved and live a normal life despite a diagnostic of cancer.
Very exciting.
Yeah.
Now we know cancers, people think that cancer is all one disease, and it's not. But I just think that this is something that tells me that the original franchise is finally here, and that's something that's worth more than just where the stock is. But David, as great as this one is, the stock that people keep talking about is Vertex, because if you do have a pain drug and it does not cause habit-forming behavior, then you have to buy the stock. And it's coming down, so it's an opportunity.
Yeah, it was up yesterday. Of course, we discussed it.
Right.
The positive, it was phase 2 trial, I believe.
Yeah,
right?
but that's they publicized that, which was meaning their confidence levels very
Something
high.
that conceivably would replace opioids in terms of pain management, which obviously would be a very big deal.
Yes.
We still are in the midst of an absolute crisis in this country.
Oh my, it's just horrible.
We don't talk about that often. But
Why don't we? Because it's at the core of a lot of the problems with employment, healthcare, and we don't talk about it.
300 people a day still dying of opioid or opioid-related.
So if you had something, it could change. It could change whole towns.
Yeah. Yeah.
Got a record high on Apple, Jim. 199.62. Citi today names it a top pick for 24. They say the bears are missing iPhone premiumization, the silicon insourcing, acceleration in services. They think Vision Pro and AI is just an upside catalyst.
Yeah, look, I have to tell you, I thought that report was very good in terms of talking about the service revenue. They're using 16%. I think they're actually lowballing. But Mike Seaver at T-Mobile, when I interviewed him last week in Seattle, these guys are an amazing partner. And it would not surprise me if they partner on some bigger stuff than they're just doing right now. But Mike said that the just opening an account with an iPhone is the easiest thing in the world. And their numbers are the best.
Speaking of chips, Intel's going to announce some processors today that might improve the AI story. That's the second best Dow name of the year.
I know, and I got to hand it to them. They are making a turn, but AMD's ahead of them, and NVIDIA is the king.
NVIDIA is the king.
It's the king. Did you read the piece in the Journal or the piece in New Yorker?
I did read the New Yorker piece, yeah, on Jensen, absolutely.
I think the Denny's story
piece.
is a great story.
Well, remember what he said about Intel? I flee Intel every chance I get.
That was fantastic.
Yeah.
I urge people to read it because you need to know who this man is.
In our never-ending sort of discussion about advances in AI and generative AI and where we are, guys, I don't know if you saw the latest entry from Tesla in terms of its Optimus robot. You see what this thing can do? It can pick up an egg now. That's a robot. And,
all right.
Wait.
Okay.
Yeah, there we go. There's an egg.
All right.
That's an egg.
All
that is, by the way, that's huge right there.
I see you an egg.
Because that was really hand manipulation is a key here. I mean, of course, it can walk, it can dance, but now it's got brand new hands.
I see you
You
with
put
this hand
generative AI in that
egg.
thing, and who knows what we got.
Okay, I see you with a hand in the egg. But how about a dog that can pick up Jell-O? Jensen. Dogs picking up Jell-O. Bingo. No?
We all need Jell-O picking up dogs.
Do you know how hard it is to pick up Jell-O?
Listen, this thing can walk all over your house. It could probably make you breakfast pretty soon.
I did not talk to him, but I went to a
By
lecture.
the way, they say they're a year away from this thing being able to thread a needle.
Really?
Yes.
Well, okay, I can do that now.
And do you remember when Musk said we're going to have a robot for every person?
No,
One-on-one ratio?
I know. Well, I'm just more worried about the Sam Altman. Much more,
And it dances. So if you want to have a dance party, take a listen.
It dances.
Hey,
I've seen you.
Ain't costing
You've got
nothing.
moves.
Ain't costing nothing.
those were nice moves.
Now, David.
Yes, Jim.
This just makes you even more fearful, I presume.
Of course.
Because Shantanu last night, Shantanu Ryan, Adobe said, look, don't have to worry about it.
Right, because it's going to have an off-on switch. Sure, right. Come on, you remember that Will Smith movie? It's a good movie. iRobot? Yeah, it was good.
Oh, yeah. Yeah, I thought it was a device. I just think that the fear I have is the fear of they have 100 people, this brain that's an
It's gonna
NVIDIA
be
brain.
great. When it's got higher intelligence than we have and it's fully mobile.
Well,
oh yeah, they're gonna just be our slaves.
Well,
I think maybe it could be the other way around.
Well, Jensen does. He will give this and say, "I want a summary of this," and he gets the summary of it. He does this actually in real life.
Best
Gets
of
the summary of it in a minute. Now I'm sitting there
Best of
reading.
intentions.
You know, I'm sitting there reading about W.K. Kellogg, and he's like got the summary, and he knows he doesn't need to read it. He has the edge on me, Jensen.
So he's
Kellogg.
thinking about humanity and the war with machines, and you're like, buy, sell, or hold W.K. Kellogg.
Yeah,
trying
I'm-
to find out about
I'm
his history.
atavistic. I'm
Did he start
atavistic.
as a sanitarium in Michigan there? Wasn't that what it started with? And then he fed everybody, you know, he gave everybody sort of nice breakfast, and then
Well, all I know is that
Battle Creek there?
yes, that's
Yeah.
Kellogg.
Yeah.
That all I know is that I read the things that are superfluous. I don't know the superfluous. Jensen would say, "Don't give me the superfluous."
Guys, real quick back to, I mean, if you've got a lot of debt, you're having a heck of a day.
Is it Warner Brothers Discovery?
I mean, they're even buying Altice.
Oh, really?
Yeah, it's up 22%, Altice, which,
Oh, jeez.
be careful. But Rivian, Lucid, and in other words, if you have a huge need for capital and/or huge refinancing needs or financing needs,
Rivian.
your stock is up sharply. By the way, I would add on Rivian and Lucid, both of which are up over 9%. Rivian did sign some deal with AT&T. Did you see this?
AT&T, a new pilot program
They didn't give us a number,
for
though.
fleet cars, yes.
They're going to buy some Rivian.
Amazing. These are. Look, we're in a moment where what was left for dead is fantastic.
How about you want to bang out Oxy Berkshire and Nucor?
Let's just buy the darn thing. Yeah, it buys. You know, it looks like Warren just buys it all the time. He's got a huge percentage.
600 million in 3 days?
Kind of
What's he up
addicted
to now,
it.
percentage-wise? Where is he?
27? 27%? It's 27%. It's pretty amazing, right? Does it quietly?
It's a lot. I mean, by the way, of Apple, though, you say all these things, and then his Apple position alone is $100 and something billion.
No, that's brilliant.
Well more, right? So,
I mean, you know, you can do a little dark throw here and hit a lot of stocks.
you can.
They're going higher.
It is a nice day. I mean, the broader averages, but if you are to the point Carl made, of course, the banks and/or a levered balance sheet, need for capital, you are having a very good day. And so cable also, which consumes a good amount of capital. Comcast shares are up almost 3%. Charter's up 4%.
Do we work for Comcast?
Yes, we do.
I like to say that one.
Dish. I mean, if you're just a disaster in terms of your capital
Dish?
structure,
Dish is
you're
up?
actually having a good day. Yeah,
Dish.
10%.
Well, I mean, so what? We just have a holiday where we can buy whatever we want?
Yeah, today's the day because they're going to live on for longer.
Well,
because the
and
cost of
It's a
capital's going
Walgreens
down.
Boots leads the Dow kind of day.
Well, what's amazing is that Enphase Energy, which has been the consummate dog, because it turned out not to be solar, it turned out to be finance. Second day in a row that the stock is scorching. Scorching. Think about that one.
You think J.P. Morgan's only up a lot less than the big banks because Jamie Dimon has not been right on rates, and so people are taking it out on them?
Well, he also, I mean, that's the least levered. I'd rather own U.S. Bank.
I'm kidding, but remember when Dimon was saying what? Where were we headed? 7%?
Yeah.
7%?
Yeah, he was wrong on that.
Although his geopolitical worries, there's no reason to think those are less relevant right now.
No, but I do know that this is a rally about finance. Companies that need finance. That's what's happening.
Well said.
does not need
The guys are right. 1% gains for the banks, for energy, industrials, consumer discretionary. Wow. A lot's working well today, even with the Dow up only 100 points. Quick reminder, you can get in on the CNBC Investing Club with Jim. Just sign up and find out more at cnbc.com/join the club or use the QR code on your screen. It takes you right there. There's a little more data on the way today. Business inventories in about 15 minutes. Fed balance sheet tonight. But it's all about the curve and certainly what rates have done in the past, say, 18, 24 hours with the 10-year still below 4. Back in a moment. We mentioned the dollar today. Haven't talked about the ECB or the BOE, both holding. ECB trimming their inflation forecast for next year. They were at 3.2. They go down to 2.7. And the BOE says it's way too early to speculate about cuts. Interesting, also a surprise hike out of Norway, 25 basis points. Dow for the meantime up 83 points. We'll get Stop Trading with Jim after a break.
%50 off.
Let's get to Jim and Stop Trading.
Well, Carl, it is at times they are changing Bob Dylan market. People, the slow ones now or later be fast. And what I see is this. I don't want to buy the Altices. I want to think about the next day or the next day. I don't want to recommend a stock that's up 3 or 4 that provides no value. Procter & Gamble is the stock that's been hurt the most by the currency. They said there'd be $800 million hit in currency. It was going to wipe out all their gains from the decline in commodities. They got crushed in Argentina. They've moved out of that. This is the company that has a good yield, a dividend aristocrat, will do well. But look, today it's an A student. They don't want the A students. In the end, you come back to the honor roll, and this company is summa cum laude.
So no worries about lack of pricing power? Or...
No, because their intellectual property's been really good. They've been able to take price pretty much consistently. It's not the kind of stock people want now, but I just don't want... I'm mindful of what David was saying, which is that they're buying stocks that if... You know, they're trying to buy something, an algorithm saying buy it, and then have someone take you out of it. That's a greater fool theory. I like a stock like this because it's for sale, and it is the biggest beneficiary of the big cap stocks. Of a weak dollar.
That's good. That's good. How about tonight?
Okay, I have a stock, Chewy, which makes pictures of your dogs, is a company that prospered for a long time, and then Amazon came in, and I think Amazon crushed it. But I think they have a good business model. We're going to have them on tonight. What a wild day, huh?
It is kind of crazy.
It really is.
Russell's up. Strongest in more than 10 months.
Yeah, there's someone on Frank's show that talked about that's really where the action is. I prefer to buy a Wells Fargo or Morgan Stanley, which my Travel Trust owns, and have lagged the market hideously, down a lot, and that's another thing to buy. Wells Fargo, Charlie Scharf's doing a great job. No one cares.
No?
Scharf's great. Nobody cares a Scharf.
I don't care.
You know Charlie, right?
I do a bit, yeah.
Well, should we call him?
No.
After you dance a little bit more on our way out.
We don't need to call.
Thank you.
It's going to be a great robot future. It's going to be one big dance party.
Well, David, that's probably what we're going to have to take up because we certainly won't be needed here.
How about a split screen here,
Yeah.
Jim, really quick before we go?
Give it to us.
No, one more.
Come on. Send us to break dancing.
I know. Look, but Sam Altman said it. There's no need for any of us, basically.
Mad Money, 6 p.m. Eastern Time. When we come back, Art Cashin's playbook for 24 in a minute.
A member.
Good Thursday morning. Welcome to another hour of Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla and David Faber, live for you, as always, from Post 9 of the New York Stock Exchange. Take a look at stocks. The post-Powell celebration continues right now with the Dow at a record high, up 1/3%. The S&P 500 up 0.5%. The NASDAQ comp up 0.6% again after the big rally that we saw yesterday in the wake of that bond move. Big bond rally as well after Powell. Every sector's higher except for staples and healthcare. Today, the charge is being led by real estate, interest rate sensitive sector. And there's the story on yields. 10-year note yield below 4%, which is where it got after Powell yesterday. So more buying of treasuries and more lower yields. The 2-year 4.3. We're 30 minutes here into the trading session. Here are some three movers that we're watching. Adobe is under pressure after issuing a lighter than expected forecast for 2024. The company says it's carefully looking at spending and remains focused on closing its $20 billion acquisition of Figma. Remember that deal currently being probed by antitrust regulators. Moderna's on the move, announcing positive data from a mid-stage trial of the company's melanoma treatment when combined with Merck's blockbuster cancer drug, Keytruda. The combination reducing the risk of recurrence or death for patients by 49% after 3 years. And we're watching Apple trading at all-time highs, on pace for its 7th straight week of gains. It's been one of the key stocks behind the Dow's rally past 37,000 for the first time ever. We'll have more Apple news and talk more about some of the other names leading the Dow a little bit later this hour.
Got business inventories out this morning. Let's get to Rick Santelli. Morning, Rick.
Good morning, Carl. Yes, if you recall, wholesale inventories have been mostly negative month-over-month change for most of 2023. Business inventory is a bit of a different model, except for this month, we are down 0.1% as expected. That means you'd have to go to June when we were also down 0.1% to find a lower number. You'd have to go to March. But 1, 2, 3, 4 months so far of the year have been negative. That's about half on the wholesale inventory side, and it does underscore how things are slowly starting to get back to normal. But you want to pay attention to these numbers, especially if you're monitoring, of course, the beginning of the fourth quarter and how things may fare with regard to holiday sales. One thing I want to point out here, if 2 years closed right here, they'd be at a 6.5-month low yield close. If 10's closed here, it'd be about nearly 5 months. But more importantly, look at the following charts. 2-year note yields are now down on the year. They closed last year at 4.43. We're now hovering at 4.36. 10 years are getting close. They closed last year at 3.88. They're currently trading at 3.95. Sarah, back to you.
It's amazing. So we just wiped out a year of high yields, basically.
A whole year.
Unbelievable. Yep. Thank you, Rick. It speaks to how ferocious this Treasury rally has been post-Fed. Guys, and we also just got in the last hour the news conference from ECB President Christine Lagarde, who also paused on rate hikes, but had a very different message for the market surrounding rate cuts. Listen.
We did not discuss rate cuts at all. No discussion, no debate on this issue. And I think everybody in the room takes the view that between hike and cut, there's a whole plateau, whole beach of hold.
That was very different than the message we heard from Fed Chair Powell yesterday on the subject of rate cuts. Listen.
The question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
They discussed it at the meeting today. So very different message, David, I think underscores why Powell was remarkably and surprisingly dovish. It started with the 3 rate cuts that were penciled into their summary of economic projections. I think I and a lot of people were surprised by that. And then it continued with the statement where we knew they were going to maybe make some tweaks around the language about the tightening bias. They added the word any policy firming instead of additional policy firming. So that was a pretty well telegraphed signal that they're in a different mode. And then the biggest came in the news conference when he said that they're talking about cuts, when he said that they're probably at peak rates. I mean, there are a number of different ways you can point to it, but he did not talk down the market from the rate cuts, and in fact added fuel to that fire. And a lot of the economists this morning are out revising their cut schedule next year, adding in faster and more of them.
Yeah, and as you pointed out, not what was expected.
Look at this. Look at this pivot.
Yeah.
December 1st. That was the last time we heard from him. It came in less than 2 weeks. It would be premature to speculate on when policy might ease. Yesterday, rate cuts are something that begin to come into view.
12 days?
Well, we did get some inflation reports, PCE and CPI, and they showed that they continue to be benign. I don't know. I don't have reporting on whether he's been speaking to Treasury Secretary Yellen, but after my conversation with her yesterday, he very much is coming around to her view. Remember, this is what she said about the potential for rate cuts. I mean, she wouldn't go that far because she doesn't want to interfere with Fed policy now at Treasury, but listen to what she said.
As inflation moves down, it's in a way natural that interest rates should come down somewhat because real interest rates would otherwise increase, which can tend to tighten financial conditions. But, you know, they have 2 risks to manage. One that is that inflation doesn't come down back toward their target as they envision, and the other is that the economy becomes too weak. And I'm going to leave that call to them.
Leave the call to them, but said it's natural to think of bringing interest rates down as inflation comes lower. And she also made some news by saying she expects inflation to have a 2% in front of it. In other words, to get to the Fed target by the end of next year. It feels like Powell and Yellen, again, are very simpatico here on their view. And he's really come around to this idea of not worrying too much about 70s style inflation.
And worth reminding people, I know most of our viewers know, but she was chair of the Federal Reserve.
She was chair of the Fed.
And in fact, right before he was. So.
Which is why I always ask her about the Fed, even though she doesn't want to talk about the Fed as Treasury Secretary, but also why, you know, her economic views have been very important and have been spot on. I'm sort of sick of the term soft landing, because that's what it's all, especially after talking to her, it's all soft landing. And she's right, it has been, and she expects that to continue into next year. But we got 2 data points this morning, guys, that confirm the soft landing, or maybe we can call it immaculate disinflation, or maybe we can call it growth without threatening inflation. But it's all the same point, which the market loves, which is we're still getting growth and inflation rates are coming down. Jobless claims continue to defy expectations. They're super low. They fell again last week. And then retail sales came in better than expected on the month, a 0.3% gain. 8 out of, I think, the 13 categories rose. Restaurants led the way, and that's the only services category in the report. But online sales were good. Electronic sales were good.
Sarah, real quick, just coming back to the top of your report, what accounts for the differential in language between the ECB and our Fed?
Well, one factor could be that the ECB has a single mandate on inflation, and so if it's not at their target, they have to be squarely focused on fighting it and can't let their guard down. I think that was the exact language she used. The Fed also has a mandate to keep employment, you know, strong, and they look at growth. So because they're weighing both of those, the Fed doesn't want to wreck the good economy that it has in the face of falling inflation. That's a big part of it, because the Bank of England was also out this morning and much more in the ECB camp of, you know, we still may have some work to do. I think they use that term on inflation and not signaling cuts, because they're much more focused on the inflationary story, David. But I think we will continue to debate on this network and in the market about whether the Fed is premature here when it comes to talking about rate cuts, with core inflation still at 4%, double the target, and the unemployment rate at 3.7%, which is not really threatening a big decline in the economy.
There's no doubt about that. We're definitely going to debate it. Yields falling, stocks off the highs here. Dow's up 43 now on the heels of Powell. Our senior economics reporter, Steve Leisman, joins us with more on what comes next. Speaking of which, Steve, I see Breen now referring to claims and retail sales. They say no signs of a pickup in layoff activity, but they do not think these provide fundamental support to the outlook on the Fed funds.
Yeah, I mean, we might be back into this zone now, Carl, where good news is bad news if you really want those cuts to come early, and there'll be many of them. I think also the retail sales report today is going to flatter the GDP numbers. I haven't seen upward adjustments yet. They were waiting for the inventory numbers to come through, but later this afternoon or just in a few hours, we'll get a few. My guess is that people will upgrade that outlook for the fourth quarter, which, you remember, the third quarter was a surprise. Why? Because the consumer was spending. The fourth quarter might be a surprise, too, because the consumer continues to spend. Our CNBC NRF retail monitor data was actually spot on with where the government came in and pointing out this unexpected strength we've had in the consumer. Let me go back a second and add to Sarah's answer about the difference between the ECB and the Fed. I would also add to her, I think I agree with all of her points, but I would add that the Fed was earlier in terms of raising interest rates, and it also went further than the ECB went. So the idea that they would pivot earlier also makes sense here. Lagarde clearly not ready. I liked her comment also where she said it's not time to let our guard down when it comes to inflation. She's not ready yet to make that call. And of course, I would underscore Sarah's answer about them having the single mandate, whereas Powell's trying to really balance both mandates. And you heard a lot yesterday from Powell, in my opinion anyway, about how much concern there is about the other side of the mandate. I don't know if the Fed is looking at something scarier. I think you're asking the right question. What happened between December 1st And today I went back and reread the whole interview at Spelman, and it's very hard to get from Powell's last interview to where he is today. I've got a couple suspicions. One is that the inflation numbers, he had a more dovish read than the market did on it. That was one. And two is I think maybe his committee started to get a little more dovish than either he was or he was ready to go. And the downside of all this, which you guys are already toying with, is have financial conditions loosened too much now. That's going to make the job of fighting inflation harder.
Yeah, although on that point, you mentioned GDP. Goldman goes to 2, which is almost double consensus. And Jan's point last night was that some of these easing conditions from October on, they think are durable because of what inflation's done.
I think that's right. And remember, you had Rick point out that the 2-year is now down on the year, which is quite remarkable. Now, we did have Michael Gapin on Squawk Box this morning. He thinks financial conditions are still relatively tight, or I guess tight enough for the Federal Reserve. But we'll just have to play it by ear. I don't think money's not free again, just to be clear, right? When you look at what the average Fed official is planning, and you think about it in terms of real interest rates, which is how many of them thinking about it, the Fed is not seeing itself loosening up very much at all. Do the math and take the Fed funds rate minus their core PCE rate, which is imperfect according to a lot of the wonks out there, but it's just a benchmark way of thinking about it. They're still looking at 2.2% real. So the only reason they come down, according to their own forecast, is because inflation comes down. They are not reducing interest rates to ease financial conditions, so to speak.
Steve, thank you. And continue the conversation, of course. Let's get more on the market implications of this move. Want to bring in senior markets commentator Mike Santoli. Mike, we've remarked on, obviously, any of those companies that are either highly leveraged or reliant on the financing markets for future growth and or just keeping their business going are benefiting today. But what else are you seeing?
Yeah, I mean, David, it pushes off the day of reckoning if there was going to be one for highly leveraged companies. It probably puts a little bit of a refinancing refresh cycle out there, going to stoke a push of housing demand as well, mortgage rates crashing. So all those things underway. I think what the market reaction did is it basically set the don't fight the Fed and don't fight the tape rules in sync to say, you know, that we have this really pretty impressive bullish uptrend, a breakout in the indexes, and mostly, and not just because, you know, the market is craving and pushing for lower Fed funds rate down the road, but because Powell explicitly tried to further delink Fed policy in the short term from what the economy has to do to get us there, right? The Fed doesn't anymore feel like it needs to really kneecap the economy to get the job done. And I think, in answer to the question you guys have been talking about, what changed recently, I really do think it's the preponderance of benign inflation numbers that have built up. You've got this run of data that have not just been pretty much right center in line with the soft landing thesis, but also coming in really close to forecast. So I think no surprises and numbers that are exactly as you might want to draw them up have combined to create this confidence that the disinflationary trend is reliable at the moment, and there's time to figure out how that develops without having to do anything on rates for a little while. So now, in the very short term, the stock market's quite extended. You know, we did have this breakout. It's really broad, all to the good, but you definitely are getting a little bit stretched out there. And so many things have been working together. You had the short squeeze, low quality rally in stocks that have been left for dead. You had the rate relief rally, the pressure off the bank's balance sheets, the soft landing celebration, and then you had the repositioning where people just were not prepared for a strong stock market. They need to raise exposure. I think a lot of that stuff has probably played out. Maybe it's the first quarter's business to try and reconcile some of that and have a bit of a gut check, and maybe we're going to have to, you know, kind of reset a little bit. But for now, it really did kind of check off all the market's boxes.
I know it's Fed first when it comes to the market these days and the equity rally. But now that we're getting to these levels, I do wonder, Mike, with the GDP picture subdued, even if it ticks higher for fourth quarter after retail sales, earnings expectations, how realistic are they into next year?
Yeah, I mean, that's the question. First of all, the fourth quarter earnings forecasts have been cut pretty significantly. I mean, it probably sets off a pretty easy beat cycle once we get the reports. But I think the test of whether 2024 earnings are plausible, it's out there probably a couple of quarters. It's a back-end loaded forecast at this point, as you wouldn't be surprised to hear. It is typically the stronger growth coming in the latter half of the year. But I think what the Fed's message And the sturdy current economic data is it gives a longer leash for companies to prove that those numbers are plausible. So the market might be able to look through a little more weakness than you might expect. Look, we got, warnings from Adobe and Oracle and Pfizer and Etsy, and they don't really seem to be causing that many ripple effects in other companies, because I think we're willing to give the benefit of the doubt.
They're also coming from companies that had been weaker and struggling, whether it's Etsy or Hasbro before. Thank you very much, Mike Santoli. As we head to break, here's our roadmap for the rest of the hour. The road for auto stocks in 2024. We have some top picks for you.
The Dow topping 37K for the first time. We'll take a look at the stocks that are fueling those gains.
And a number of home builders are also hitting new highs. We're going to discuss what is ahead for these companies and their stocks. This, of course, is the Fed. Appears to be focused now on potentially cutting rates next year. A lot more Squawk on the Street for you. Don't go anywhere. Welcome back to Squawk on the Street. Earlier this week, Ford announced plans to cut production for the F-150 Lightning EV pickup truck. Our next guest is bearish on the auto industry overall, though he does like Borg-Warner headed into 2024. Joining us here at Post 9, Colin Langan. He's the senior analyst at Wells Fargo for autos. Has a buy rating on that particular stock, BWA, price target 47. It's that time of year, your best picks. I guess were you hard-pressed to find one in auto, so you had to go to Borg-Warner?
I mean, I've liked Borg for a while. I mean, I am very bearish on the auto sector in general.
Why?
Why Borg? Or,
no, why are you bearish on the auto sector?
I mean, I think there's really probably four key reasons. One, I think we're probably at peak profits for the industry, and I think a lot of that's driven by pricing. I mean, we're at record pricing. I think that's going to come down. If you look at the Detroit 3, they've all collectively gotten $10 billion of pricing help since COVID. You know, two, I think people haven't paid any attention to capacity. The industry is probably going to see close to a 20% increase in capacity. We know historically that's terrible for profitability. What happens is automakers feel pressure to utilize that capacity and pricing starts coming down. So it really feeds into the pricing concern. Three, you know, electric vehicles, right? So I think people are very excited by the fact there's moderation in EV demand because these are unprofitable. What I think they're missing is the regulations that are behind all of this. And so for 2026, you're going to need maybe 9 or 10% EVs. For the Detroit 3, they're at 0 to 4% right now. So they're going to need more of these unprofitable vehicles on the way to get there. And the last thing I don't think people are paying attention to is pickups. So if you look at pickups, which are historically the vast majority of profits for the Detroit 3, their inventory has been creeping up and the sales are fairly flat. And it's been a very distracting market with the strikes and the supply chain volatility. But at the end of the day, historically, there's a good correlation between housing starts and pickup sales. And it makes sense because contractors are a big customer base. So I think you have a lot of negative reasons for the industry into next year. It's very little that's actually good news into next year.
All right, now we'll go to Borg Warner. I appreciate your sort of rounding that up for us. Why is that something within the industry that you do feel is perhaps something to buy?
Well, I think if you look at it, the suppliers historically can perform well, especially high-quality suppliers, even when their customers are struggling. This is a globally diversified company. They're cheap. I mean, if you strip out some of the pricing help this year suppliers have been getting from cost recoveries, they are one of the fastest growers this year, and yet they're not trading at a premium to the group. They're trading in line with the group. This is also a company that has executed really well since COVID, when there's been so much volatility, and I think we're going to see more volatility for the suppliers next year. We're going to have labor cost inflation. There's going to be some FX issues. So, I'd rather stick with a name that has executed through all the volatility recently.
Just on the demand question, I'm looking at the retail sales report today. Motor parts and parts dealers, 6.1% growth from this time last year, November number. I mean, it continues to show strong demand, doesn't it?
Well, I mean, we're still seeing SAR up year over year, but SAR has been fairly flat. So new auto sales have been sort of flatlining in the low 15s. They're creeping up a little bit, and there's probably upside to auto sales. But I think what we're seeing is inventory is up all around. And if demand was so high at current price levels, we'd actually be at a 17 million SAR, which is where we were before COVID. So normal demand is probably 16, 17. So there's actually a problem that we're only at 15 and we have plenty of inventory out there, which means that we're going to need to cut prices if we want to get that volume, which goes back to the capacity issue, because if we have all this unused capacity, then there's pressure to cut prices because you're sitting on all these fixed costs.
Colin, we're going to leave it there for today, but thank you. Appreciate it.
Yeah, thanks.
Still to come this morning, as we said, the Dow tops 37K for the first time. We'll get a closer look at some of the stocks leading that charge. Plus, it's an annual tradition, our cash-in with some market predictions for the coming year when Squawk on the Street comes back.
Rated PG.
The Dow closing at a record high yesterday, crossing above the 37,000 mark for the first time ever. Let's get to Bob Hassani with a closer look at some of the stocks, Bob, leading the chart.
I don't even know where to start. With 350 new highs here at the NYSE, over 300 on the NASDAQ. Just take a look. Apple, of course, obviously all-time high. Visa's at an all-time high. We've been talking about that all week. IBM, 6-year high. Boeing's up 23%. JP Morgan, Home Depot, Goldman, Intel, all new highs. So the market's very overbought. Okay, how overbought is this? Is the big conversation. What should we do in January here? 89% of the stocks in the S&P are above their 50-day moving average. That is very unusual. That's a really, really broad rally here. Relative strength indicator, RSI, is at 78 for the S&P. Anything over 70 is considered overbought. It's hard to keep the market advancing every day when the market keeps going up by that much, that quickly. And it's very expensive. When you get towards 20 times forward earnings, 19.2 now, the market gets very picky. They don't like paying that much. Normally, the historic average is about 17 here. So there's a game that everybody's going to play now when you have a big up year. That's the January mean reversion trade. That is, let's pick at the edges of stuff that didn't do any very well in 2023. So small cap value doing well. Small cap underperforming still, though better recently. But you got to believe interest rates are going to come down really big. Consumer staples, yeah, we saw Smuckers and Hershey down here, but that's not a big play if the market is going to be stabilizing around the soft landing. Energy down, but you got to believe here that oil's going to rally. Probably not going to happen. In China, big geopolitical plays. Finally, want to note here, we got the triple witching tomorrow. It's going to be the last liquidity event. A lot of volume here, rebalancing on the S&P, some NASDAQ indexes rebalancing. So Uber's going into the S&P 500 along with J-Bill, Builder's First Source. Sealed Air is going out. You want to see the effect of the S&P 500 going in? Look at this. This is Uber in the last month. It was $40 a month ago. Earnings came out. Everybody realized they were suddenly a candidate for inclusion in the S&P. Look at that. S&P, they're up 50% in 1 month. This is called the S&P inclusion effect. Stock tends to rise going into the S&P 500, and then, of course, after that, it tends to move sideways to down. You get all of the value going in as it's going into the S&P 500.
All right, tomorrow's going to be big. You want to talk some Art Cashin?
Yeah, you know what's really great here? We just caught up with Art. This is the annual predictions here. So despite the 20% run-up in the S&P 500 this year, I met with Art over at Harry's. Art's very enthusiastic about the setup for 2024. I was surprised about this. He's telling me election years with a sitting president tend to be very strong ones.
It's an election year, and that tends to be good for the market as people are making projections and promises and programs, and even the upward bias on an election year when a sitting president is running for re-election, that compounds it even more. The best of all those historical patterns is when an incumbent president is deciding to go for re-election, and he needs a decent economy to back him up.
Now, that decent economy, Art says, requires a lot more spending. And that goes to the first issue that worries him in 2024, that the flood of new treasuries and less demand for our debt, particularly overseas, may keep rates a bit higher than people think.
The Chinese were big buyers of U.S. treasuries to protect their currency, not to put them at a trade disadvantage. For years before that, the Japanese, too, were enormous buyers of U.S. treasuries. So we had that demand, which allowed us to run deficits and never start to choke up toward the end. But the Chinese are having their own economic problems, so I don't know that they will have the latitude to buy U.S. treasuries in the scope that they have.
A second worry is what we were just talking about, stock valuations. The broad market is very pricey. Valuations are nearing extreme levels in some, but not all sectors. I asked if that would be an issue in January when some people who had poured cash into money market funds in 2023 might be tempted to come back into stocks at very high prices.
Oh, of course it is. And that's the problem. You know, the fear of missing out, the idea the train is leaving the station. the idea I've got to get on board. And so you begin to ignore multiples and you pay up, and that's where bubbles come from. People go in and say, yeah, but the train is leaving the station. And, am I paying a high premium? Yeah, but I've got to get on board before that train is gone. And that is a risk.
My full interview with Art is going to be up on CNBC Pro later today. Art also talks about another worry, the looming commercial real estate problems he thinks are still going to be there for banks in 2024. And he offers a surprisingly strong endorsement of the benefits of artificial intelligence for the economy in 2024. This from a guy who still uses a flip phone, who still writes his morning newsletter by hand and calls into his secretary. Very interesting observations on artificial intelligence and what it's going to do for the economy.
I'm so glad you got to that part, because the hyperbole thesis is a golden age of productivity, and hence corporate earnings.
And he talks about that on the influence on some of the retailers and where it's going to go. It's just great to see, Art, and just great to be back. We didn't do it last year, and it's a 20-year tradition. So glad to see him. Again, the full interview on CNBC Pro later on today.
Love it. And in the holiday bow tie, of course.
And he dressed up, and he looked he looked great. I can't describe how important that man was to me in the 1990s and how influential and what a great mentor he's been to me over the last 25 years. And it's always cheers me to see him.
No, it's nice to see it. We miss seeing him here every single day. Thank you, Bob.
Okay.
Bob Pisani. Still ahead, former Dallas Fed President Robert Kaplan with his take on where rates could be headed in the new year and when he's expecting the first rate cut. As we head to break, check out the biggest gainers on the S&P 500 this morning. No shortage of them, but Moderna out with some good news on the melanoma vaccine, along with Merck. It's at the top, 12.5% higher. There's some others as well. Most sectors, as I mentioned, are higher. The banks are having a really good session. Real estate, energy, materials, all leading the S&P. Don't go anywhere.
Borston with your CNBC News update. National Security Advisor Jake Sullivan is in Israel right now to meet with Prime Minister Benjamin Netanyahu and Israel's war cabinet. Sullivan is there to talk about the timetable for Israel's war with Hamas. The Israeli defense minister said in a press conference this morning it will last more than several months. Russian President Vladimir Putin said today Moscow is in talks with the U.S. to bring home jailed American Evan Qqq and Paul Whelan. His comment came as a Russian court once again rejected Qqq's appeal against his pre-trial detention. Putin said he hoped Russia could find a solution that, quote, suits the Russian side when it comes to the release of the Wall Street Journal reporter and Whelan, a Marine Corps veteran. And the Pope is the latest person pushing for more controls on artificial intelligence. The appeal is somewhat personal for Pope Francis, who was seen in a viral AI-generated image earlier this year wearing a luxury white puffer jacket. He called for an international treaty to make sure AI is developed and used ethically. Back over to you.
Thank you, Julia. Interest rate futures are now indicating a higher chance of rate cuts starting in March after the Fed's new rate projection signaled the end of its tightening policy, and a lot of commentary from Fed Chair Powell backing that up. Former Dallas Fed President Robert Kaplan is currently professor at Harvard Business School, and he joins us now. Were you surprised at the extent to which he endorsed the market's view of rate cuts and even fueled that fire even further?
Well, not so much. What he's looking at is, as inflation comes down, the real Fed funds rate actually goes up unless you begin to cut rates. So the FOMC was going to have to start discussing the conditions for cutting rates. What I mean by that, if the nominal Fed funds rate is 5.25, and let's say inflation, depending on your measures, running at 3.5, means you have a real Fed funds rate at 1.75. If inflation continues to go down, they don't want the real rate to go up. They want it either to stay the same or even go down. And so they've got room to start considering cuts if they see sustained improvement. And there'll be a point at which over the next year or so where they're going to also think that the real Fed funds rate doesn't need to be as high. So this was a conversation destined to happen. He had to preview it sometime, and he chose yesterday.
Agree, and I think actually that's a great explanation for it. And a lot of people think that obviously worry about that happening, the tightening going on beyond them stopping to raise interest rates. I guess it's just the financial conditions on the other side that are loosening pretty significantly here. They were into the Fed meeting, and they're doing even more so out of the Fed meeting, and whether that risks some of the progress that he's made on inflation.
Yeah, so that's why people should not overreact either to what he said. He left his options open. He thinks they're done. It's likely the next move will be down, not up, but he's keeping the option open. And the things that they're going to, and if I were there, I'd be watching very closely. What does service sector inflation do? Goods inflation's been very weak, but the service sector is still over 5%, and they want to see some improvement there. You've had a big oil rally. We've got the benefit of it in the inflation numbers. You could easily have that reverse. You see that today, oil is up. And then the other thing is we are spending at historic levels. You've heard me say this before on the fiscal side. That he probably won't talk about, but I think that's a big factor. We're on our way to running a very large deficit this year, and you've got unspent ARPA money, Inflation Reduction Act projects, Infrastructure Act projects. So they're going to want to see into 2024 at least 2 or 3 months of sustained improvement, and there's some reasons why it might be bumpy, but if they do see the sustained improvement, they're going to be prepared to take action.
Robert, on the fiscal side, though, again, they won't address it, but others have said, listen, they've got to be aware of the interest costs in the budget and what that's ultimately going to mean. I'm just curious, is Powell looking at that as well, running regressions on what that's going to look like over time?
No. It turns out, listen, this rate rally is good news for the fiscal side, and that the issue for this coming year, let's say we have $27 trillion of debt in this country held by the public, okay? The Treasury is going to have to issue $9 trillion of new debt this year, 7 refinance, and another 2 to finance the deficit we just ran. And the debt rolling off is probably in the low 2s, and it's going to get refinanced even in a positive case, probably in the low 4s. That's 200 basis points or, $180 billion more plus of interest expense before we've even started the year. So I don't think the Fed is explicitly going to focus on it, but I'll tell you, I'm focused on it, and I think the markets will be focused on it. We've got a substantial amount of Treasury volume that we've got to issue in the years ahead. Debt to GDP is over 100%. And I'm more focused right now on what the 10-year does over the next 3 to 6 months. I'm as focused on that as I am on what decisions the Fed makes and the timing of those decisions.
You think the 10-year stays below 4% through next year?
I mean, I don't know. The reason you've got estimates all over the map, for those who think it's going to come down a lot more, I think they're expecting a more severe slowing in the economy. Yeah. They're expecting even a recession. For those who think it's going to be sticky here, I think they're thinking the economy will be resilient. I personally think if we continue to run $2 trillion deficits into 2024 and we keep spending on these projects, I think the economy is probably going to be more resilient than people think. And the Treasury is trying to respond to this very quietly by front-end loading issuance, i.e. in bills, not testing the market's capacity for the 10-year and the 30-year. Yep. And I think this will be one of the things I'll be watching very closely is how deep is the bid for duration in the Treasury market. And I think the Treasury is going to be very careful about going overboard in testing that.
Agree. Thank you, Robert Kaplan. Really good to get your insight, especially as someone who's in the room recently. Former Dallas Fed president.
All right, we got news on that pending proxy fight from Nelson Peltz that we've been talking about for some time. It's now official. Just a few moments ago, Peltz's Trian putting out a press release confirming what our own Jim Cramer actually had reported a few weeks ago, namely that they would nominate 2, not 3, 2 board members for Disney's board. Of course, if you recall, Peltz a year ago was in the midst of a potential proxy fight to seat himself on Disney's board, and then he gave up that proxy fight right after an interview that I did early this year with Bob Iger. They're back, and this time it is not just Peltz, but also another nominee, Jay Rasulo, which is an interesting name to note here because Mr. Rasulo had been the CFO at Disney from 2010 to 2015, and also had run the parks and resorts from 05 to 09. The Disney I know and love has lost its way, Rasulo's quoted as saying. As independent voices in the boardroom, he says, Nelson and I are confident the combination of his decades of experience at Disney and Nelson's significant boardroom skills and history of driving positive strategic change will get things back on track. Those are my words, not theirs. What I also would share with you from their letter is the following. They say the root cause of Disney's underperformance, in our view, is a board that is too closely connected to a long-tenured CEO and too disconnected from shareholders' interests. The board, we believe, lacks objectivity as well as focus, alignment, and accountability. Although the recent appointment of 2 new directors to the board is a step toward greater objectivity, they go on to say this reactive board self-refreshment on the eve of a proxy contest is insufficient, in their opinion, both because the new directors were chosen without shareholder input and they don't seemingly own any amount of stock. They do talk about, Sarah, the fact that non-management directors collectively own less than 15 million of Disney stock, and that Iger has sold the vast majority of his ownership stake as well. I would make a point, though, that I believe 26 of the 33 million shares that Trian lists are actually like Perlmutter's, not Trian's.
Which has been a Disney argument.
Yes.
Against him.
Without a doubt.
I mean, if you just look at the stock price, so Peltz called off the last fight in February with you. The stock was at over $110. A share, it's at 93 right now. So 2 questions. What's wrong with Disney? And is Peltz going to get what he wants?
Very much unclear whether Peltz will get what he wants at this point. You know, I would have said it's somewhat of an uphill battle for him, potentially to seat himself. Jay Rasulo is a very interesting nominee, no doubt, especially given his experience at the company for quite a period of time, both in parks. Although parks is not the issue here, again, to answer this other part of your question. I mean, it really is about getting streaming to profitability, dealing, of course, with the collapse of the linear cable ecosystem, of which we've all been a part for so many years. Iger talks about these challenges very much up front. And he has cut costs significantly, far beyond, in fact, what they originally had targeted. And so while you certainly can make an argument, Sarah, that there needs to be more accountability and that the board is too closely connected to Iger, so to speak, I'm still seeing or not seeing specifics here at this point in terms of what they would recommend that they do from an execution standpoint that isn't already perhaps underway at Disney. My expectation would be that will be Disney's argument, particularly with that recent board refreshment, adding Gorman, for example, from Morgan Stanley to the board.
Expectation is that Tryon will do so as we get into the proxy
that would
context
be an
as well. They usually release white papers and have all sorts of recommendations.
Exactly.
Meantime, getting some news out of D.C. Let's get to Emily Wilkins with that. Emily, is this about defense policy?
Yes, so Congress has passed a major must-pass defense authorization bill. This bill, it's almost $900 billion, incredible critical piece of legislation that Congress is getting done today before everyone goes home for Christmas. And look, a lot of this bill, it does have to do with the military, a 5.2% pay raise for service members, additional funding for Ukraine. But there are also a number of provisions in here that deal with other interests and other topics. One really big one is AI. We are seeing dozens of provisions in here as the Pentagon and the military really look to adopt this new technology. That includes trying to see if they can hold a competition to get someone who can identify watermarks on AI and AI-generated content so you can tell what's real, what's fake. And they're also basically sponsoring a program telling hackers, hey, come ahead, test our AI, see where our faults are. We want to make sure that we are putting out a really strong product when it comes to the AI models as well as cyber defense models. There are also pieces in here on China and Taiwan, having the Department of Defense basically train Taiwan military and help boost up their capacity. And we also have another provision in here dealing with U.S.-Mexico trade, a huge, huge package for Congress to close out the year with. But of course, a lot that did not get done this year and will need to be addressed very soon in 2024.
We'll see them in a few weeks. Emily, thank you. Emily Wilkins this morning in Washington. Still to come with some potential rate cuts on the horizon. Is it time to start betting on housing stocks? We'll discuss that and get some top picks for 24 when we're back in a minute.
they can deliver.
Quick programming note. Big guest coming up in the next hour. SEC Chairman Gary Gensler, fresh off news that the agency is investigating investment advisors' use of AI. We're going to talk more about that move, his priorities, wins and losses from 2023, and what he's looking to do in 2024. That's coming up in the next hour, 11 a.m. on Money Movers.
Meantime, D.R. Horton and Pulte trading at all-time highs. Other home construction-related names like Masco and Martin Marietta also new highs. The Fed now expecting more rate cuts next year. What is the outlook for housing stocks in that environment? Joining us this morning is Oppenheimer's Tyler Batory. Tyler, it's good to have you. I mean, an important 24 hours we just had. What does this new rate environment do to some of these builders' margins and orders?
It's definitely a tailwind, certainly. And look, you look at the playbook for next year, which we think is definitely going to be turbocharged by what happened yesterday. I think the playbook and the outlook for next year looks pretty similar to this year, actually, for the industry. Still limited existing inventory out there. We don't really see that changing. So there's a market share shift underway where new homes or a lot of locations are the only game in town. The public builders, they have size, scale, access to capital that allows them to grow their inventory, buy down interest rates. That's attractive for the end user and for buyers. So there's really a market share shift going on where the demand is being funneled to new homes. It's being funneled to home builders. And for the stocks, we think it's a group that's really grown up. These management teams, the public builders collectively, they're very focused on returns. They've really adjusted how they think about deploying capital. So you roll that all up in the blender. We think there are some fundamental tailwinds here. And I think an outlook that's really quite positive for the industry and for the sector overall.
Is there an argument that if rates come down enough that it unleashes a supply of existing homes and the new builders do face more competition?
Yeah, it's kind of odd to think lower interest rates might not be a good thing for home builders, but certainly this tailwind in terms of limited existing inventory. The reason why there's not much existing inventory out there is because 40% of those homeowners with a mortgage have a rate below 4%. So if you have a mortgage rate that's at 3%, 3.5%, trading that for a 7% mortgage doesn't really make a whole lot of financial sense. Obviously, if rates start to tick down, that math starts to change a little bit more. So it is possible you could get some incremental inventory coming onto the market next year. But our perspective is lower rates would be a good thing for demand that would offset any incremental supply that might come. And then for the home builders, if rates are lower, likely means they don't have to offer as much in terms of incentives. That's a tailwind for their gross margin too. So from our perspective, with rates potentially moving lower next year, mortgage rates moving lower as well, we think that's a tailwind still for the industry.
I mean, it was a funny environment for home builders because the stocks actually did fine as inventories were low and prices remained high. Tyler, is there worry that prices could go even higher now if this unleashes a lot of activity in the mortgage market, which would make the Fed worried again?
Yeah, it's definitely a potential risk, and this supply-demand imbalance that's in the market, I think, does give builders pricing power. You look at what homes are going to be running through their P&L this year, you're going to see the impact from some of the higher incentives activity level earlier in 2023. But you look towards next year, especially the back half of the year, if interest rates cooperate and even stay the same as where they are right now, there's going to be demand, and the builders are trying to meet that demand with more supply. But again, the key to this whole story is that there's not a whole lot of existing inventory out there on the market. There's going to be more demand than there is supply. Simple economics in that sort of a situation should give the builders pricing power and the ability to raise prices.
Yeah, we're watching that 30-year fix below 7 now, but as you say, long way to go to get out of those velvet handcuffs for a lot of homeowners. Tyler, thanks. Tyler Batory, thanks.
Well, in the broader markets, we have continued the rally that we saw after yesterday's Fed decision, and particularly after yesterday's comments from Chair Powell at his press conference with the S&P up, let's call it a little less than 0.5%. Notably, absent from the rally are many of the big seven names, as we like to call them, or the Magnificent Seven, actually, is what we really call them more often than not. Apple, though, is actually up new highs there as it approaches $3.1 trillion. As we said earlier, many companies that rely on the financing markets for their business or have highly leveraged balance sheets are the beneficiaries of this rally today. And the banks, as you might expect, also given what it means for rates and for the curve in terms of their borrowing and or lending. Also a positive tone there as well. We got a lot more market coverage for you right after this break. Don't go anywhere.
NBC.
Good Thursday morning. Welcome to Money Movers. I'm Carl Quintanilla with Sarah Eisen, live at Post 9 of the New York Stock Exchange. Today, a fresh all-time high for the Dow again as Powell signals this dovish pivot. When can the street expect cuts? Neuberger Berman's Holly Newman-Croft is with us.
Plus, an exclusive with SEC Chairman Gary Gensler. New rules on cybersecurity and short selling, plus the latest on how he's tackling AI and, of course, crypto.
How are airlines going to maintain pricing power in 24? We did see Southwest under pressure yesterday. Frontier's chief executive going to join us this morning.
Right now, take a look at stocks. The post-Powell celebration continues. It's broad. It's across the board. The S&P is up 0.4%. The Dow, as Carl mentioned, at a record high. Goldman Sachs adding 100 points to the Dow by itself. It speaks to the strength in banks. The regional banks are just soaring right now. Think of the hardest hit stocks over the past year because of the move higher in rates. Reversing today, real estate is your top performing sector. No surprise, the office REITs in particular are getting some reaction and relief as well off the new rate outlook from the Fed. The street is reacting to this decision to keep rates steady this month. Goldman Sachs expecting cuts now as soon as March. Bank of America calling that a close call. Deutsche Bank and Barclays and Wells Fargo all looking to June for the first cut. Our next guest thinks that if the Fed decides to cut that soon, it would be due to a suffering economy and to keeping a close eye on the labor markets and other economic indicators. Joining us here at Post 9, Neuberger Berman, Private Wealth Management Senior Wealth Advisor, Holly Newman-Croft. Reminder, she oversees $3.8 billion in assets under management, is a Barron's Hall of Fame financial advisor. Welcome back. Nice to see you.
Nice to see you both. Thank you.
You've been waiting for a moment to get more bullish. Powell basically rang the bell yesterday and basically signaled we're done cutting, or we're done raising rates, and we're starting to think about cutting rates. Is this it?
I'm not bearish. I've been cautious, and we continue to be cautious and maybe more excited about other asset classes. I'm a little surprised by the euphoria in the market by what Powell said, because it wasn't so surprising. Everyone expected him to stay static with rates, and I think everyone expected rates to be cut next year. So it's not so surprising. When they cut rates, whether it's March or July, I don't think matters, because remember, monetary policy lags in the market. So we'll still be feeling the effects of the higher rates for longer in the market next year. I think what's really interesting and where we see opportunities in the equity sector is in the asset classes that underperformed this year. So if you look at the equity market, the rage in returns is really in what I'm calling the terrific 10, right? 10 stocks responsible for 80% of market returns. And you can find a lot of value in those securities that are left behind. And we're seeing that actually since Powell's statements, like you just mentioned, Sarah, real estate, utilities, they're really driving this charge in the last 2 days. And those are areas where we're expecting to see outperformance next year.
Because the rally broadens out, because they got too cheap. What is
they're totally undervalued. These mega cap tech stocks just drove this market performance. When you look at the equal weighted return of the market, it's about 10 or 11%. And actually, remember, my job is responsible growth of client capital, but also preservation of client capital. And when you look at the 2-year annualized returns, because everyone forgets that last year was down so significantly, it's like 2 or 2.5%. So if we still protect on the downside, and we're not out of equities, we're just not overweight or so concentrated in 10 securities. But we are seeing undervalued sectors and opportunities as we enter 2024 that we're excited about.
That's just in large cap? Are you looking at small and mid as well?
In every asset class. I mean, this year, you know, large has done better than small and mid, developed over emerging markets, and we're probably still favoring those. But within every sub-asset class of the equity market, we're seeing opportunities. In markets where there's more volatility and more uncertainty, like the market that I think we're in today and we will continue to be in next year, we favor active management over all those asset classes, because we think fundamental analysis is so important to identify the companies that aren't so sensitive to interest rates and are undervalued and perhaps unappreciated in 2023, and where we can see the opportunity for outsized growth. But let's remember, the fixed income market is still offering equity-like long-term returns with much less risk and much less volatility. So we're extending duration there to lock in higher rates for longer for our clients with equity exposure.
So if you had to choose, you'd choose fixed income over bonds, over stocks at the moment.
We're overweight equities. We're overweight fixed income, apologies. We're neutral on equities, and we continue to be overweight alternatives, because I think where capital is scarce and in tightening credit markets, there are very few places to go. So if you have money and you can lend in the private credit space, we really do like that area.
What is the Neuberger outlook on growth next year?
So our outlook on growth is we're cautious. We are cautious. You know, we think economic growth is going to slow. And with respect to the pace of rate cuts, whether it happens in March, whether it happens in June, I think we don't expect all of it to happen in the first quarter. And if it does, that will be because there's something that is bad that has happened in the economy that the Fed is trying to protect against. So I think there will be thoughtful and responsible cuts next year, barring a surprise like inflation to the upside. We think growth will slow, and we think the job market is going to soften. But in that environment, we still see opportunities really in all asset classes, in fixed income, in equities, in areas that have been undervalued, in alternatives.
Munis? You always love munis.
We still like munis, yeah.
All right, thank you, Holly. Good to check in with you on a day like today, especially. Holly Newman-Croft from Neuberger.
It's a big day for Intel. Let's turn to the chip space. They're making some AI announcements in the last hour, focusing on the PC space. Christina Partsenevelos is at the NASDAQ, having talked with Pat Gelsinger. Hey, Christina.
Hi, Carl. Well, the race is on to be the first to market with AI PCs. Like all of those PCs right behind me right now, Intel says they are first, despite Qualcomm actually announcing their own version very recently. I caught up with Pat Gelsinger just this morning, and he said they are already shipping these PCs and will have about 100 million units in the market by year's end. That's actually, quote, 5 times, according to them, 5 times more their competition. Qualcomm, though, speaking of competition, AMD, Intel, they've all been pushing the AI PC, right? That means running AI applications directly locally on a PC so that you don't necessarily have to use the cloud. It's better for battery, and it should help boost the PC market, especially as this refresh cycle begins next year in 2024. But recently, Dell did warn of near-term softness in PC. So I asked Pat about this morning. He said they're not changing their guidance at all, and that's the problem, though. With this event here, there's been actually no updates with any type of financial goals thus far. Intel also launching their next-generation CPU. That's the new thing here today. Think of it like a system on a chip, the Xeon that you're seeing right now. Intel has been losing market share to AMD in this category, so it's important for this CPU to launch and for next iterations in the years to come. Lastly, Gelsinger on stage just revealed the Gaudi 3 chip, which is a custom AI chip primarily used for training large language models, with Gelsinger promising about a $2 billion pipeline next year. Gelsinger, much like AMD CEO Lisa Su told me just last week, this market is big enough to offer a market for all of them. Even if Intel is offering maybe a lower performance, cheaper chip, they have the supply for it. That was a key point that he mentioned. But what we're seeing, or the takeaway from this giant event here too, is that the theme is volume, being the first to ship. Intel is claiming that right now for the PC chips that you're seeing behind me and for many of the other products, and it's getting it out to market as soon as possible before the competition, and that's what they're claiming right now.
All right, Christina, well, stock's up. By the way, the whole buy the losers of last year turned out to be true for Intel, up 73% this year after sliding sharply in 2022. SEC Chairman Gary Gensler coming up after the break, the latest on regulating AI, plus new cybersecurity and short selling rules, all in focus.
Watch Moderna today higher after releasing these positive trial data for its melanoma treatment when combined with Merck's Keytruda. Stock, as you can see, up 9% in a week. We're back in a couple of minutes. Wells Fargo with a 100-page 2024 outlook for banks this morning, most notably swapping out its top pick for the sector. JP Morgan goes to number 2. Citi now holds the top spot, bullish on Citi's multi-year restructuring plan and the potential for future buybacks. Wells also thinks that Citi's earnings growth can accelerate long-term. Price target there goes to 55. That would be welcome news, as you know, Sarah, to a bank that's had to do a lot of internal restructuring lately.
Absolutely. The SEC, speaking of banks, making progress on a number of new rules across cybersecurity, treasury clearance, short selling. On top of that long list, SEC announced this week that they will probe investment advisors' use of AI. And the future of crypto still hangs in the balance. Joining us to discuss all of that in an exclusive interview is Chairman of the Securities and Exchange Commission, Gary Gensler. Chair Gensler, welcome. Good to see you.
Good to be with you, Sarah.
I mean, I just went through so many different rules. Maybe we just start there, because it's one of the criticisms of your leadership at the SEC that they're just coming so fast and furiously that you're not taking the time to really look into the impact and consequences of those rules. Isn't it better to do less and get them right? How do you respond?
I think we are getting them right, Sarah. I think we work for the American public, both the investors that watch your shows and the people trying to raise money, the issuers. Those are our clients, and we're trying to update our markets for the 2020s. We put these proposals out to public comment. We get a lot of feedback. We generally take between a year and 2 years before we finalize these rules. Yesterday, we finalized a very important set of rules around the Treasury market. It's the base of our entire capital markets, the U.S. Treasuries. It's how the Federal Reserve does its monetary policy. And of course, it's how we fund ourselves. That rule was out there for 18 to 20 months of comment and feedback from the public.
No, on the public point, so you put it out for public comment and then make changes. Why then do you not go out and repropose it so it can be vetted again with the changes?
Because we've already put it out there, Sarah. We've gotten a lot of feedback in terms of this set of proposals for the Treasury market. It's really important for the markets that we lower the risk in these markets. You might remember, as COVID was breaking out around the world, there were challenges in our U.S. Treasury market. Even the year before that, in 2019, there were very significant challenges in the funding of the Treasury market, what's called the repurchase market. And I would note, this is a market that has a lot of leverage. Hedge funds are borrowing from banks and broker-dealers through something called the prime brokerage relationship, but they're borrowing from them through the repurchase markets, and we can lower the risk in the system for the American public by implementing this rule.
I'm curious what you're doing on AI, because I know that's new. It's something you're focused on. You've warned about the perils of AI when it comes to investment. I think warned that they could create a financial crisis. So how are you tackling this issue?
I thank you. I started studying this actually when I was honored to be up at MIT as a professor. Artificial intelligence is I really truly believe, the most transformative technology of our time. As transformative as the internet, but even if you go back to the 1920s and the whole industrialization in the automobile. AI is already being used across finance, whether it's just in call centers, compliance, various ways you can process claims at insurance companies and the like, but it's also being used in those robo-advising apps and brokerage apps that you might know of. So what we've done is we did put out a proposal with the simple concept that you need to keep the investor's interest ahead of that of the investment advisor or broker or dealer, and you can't have the algorithm putting the investment advisor or the broker dealer ahead of the investor.
Chair Gensler, I'm wondering, the performance of these tools and their capabilities, is it running ahead or behind your initial expectations?
I would say that we're in a mode of acceleration, that the technology curve, if you wish, is probably picking up. And it's about the computational power, and it's about the data analytics behind it. The buzz, of course, is around generative AI, but in finance, it's already being used. And I would say this, I do think that there are natural economics around artificial intelligence that will lead to dominant or single source based models, just like we've seen elsewhere in technology. I mean, we largely have one search engine that we all turn to, or maybe 3 cloud providers. I think similarly we'll end up with a very short list of base or foundation models in artificial intelligence. And unfortunately, if the markets are relying on directly or indirectly one base model, that could lead to real problems in finance and a future financial crisis. We could be sitting back on this program and we'll be saying, it was that base model that got it wrong, and we all kind of invariably went off a cliff based on that model.
Are you seeing symmetry between our policy efforts in this country and Europe and Asia?
It's a great question. Each jurisdiction is taking it a little differently. In Europe, they're actually passing laws through their parliament and taking a different approach. I think that we are fortunate. We probably have the lead in terms of the technology and the private sector here in the U.S. And then I would say, just thinking about China for a moment, more of the development there is happening at the official sector. I like our approach. It's in the private sector. But there, they may have some advantages where they can take the data from 1.4 billion people and aggregate it all together at the official sector.
How much do you take into account, Chair Gensler, worries about stifling innovation and technological deployment and advances when generative AI is coming? And a lot of people think it makes us much more productive and can help democratize the markets even further, like other technologies have.
Again, I think it's even broader than generative AI, and artificial intelligence is probably already boost economic activity. I mean, it's changing science, it's changing medicine and radiology, and it's changing finance. It can lead to greater access and lower cost. Even those robo-advisor apps can have lower costs. But it doesn't mean there's not challenges as well around explainability, around bias, around accuracy. And these challenges we need to sort through as well.
How is the, on another topic, approval process going for a spot Bitcoin ETF? I know you're facing a window in early January. What does that look like?
Well, Sarah, we have, I think it's between 8 and a dozen filings. I'm a chair of a commission. I'm not to prejudge anything, so that's going through the process right now. And as you might know, we had in the past denied a number of these applications, but the courts here in the District of Columbia weighed in on that. And so we're taking a new look at this based upon those court rulings.
Market's excited about it. You're referring to the Grayscale, the subsidiary of Digital Currency Group. It doesn't look like you're objecting to that ruling from the courts, which is why the market is excited that this might finally happen.
Well, look, Sarah, we do everything at the Securities and Exchange Commission within the laws Congress has passed and how the courts interpret them. We look keenly to the economics. But I would say this about the crypto field. This is a field that your viewers should be aware that there's a lot of non-compliance with the securities laws that are there to help give you the disclosure so you can make the investment decision, but also to protect you against fraud and manipulation. And there's been far too much fraud and bad actors in the crypto field. There's a lot of non-compliance, not only with the securities laws, but other laws around anti-money laundering and protecting the public against bad actors there. And so I would note, this is a field where you still don't have the fundamental information on many of these projects, and the intermediaries of the so-called crypto exchanges are commingling and doing things that we do not allow anywhere else in our financial system.
There is this strange kind of thread of thought within crypto that because there have been high-profile either convictions and sentencings or examples of cooperation that somehow fraud's been flushed out. I would imagine you'd push back on that pretty hard.
I just think that I take the other side of that. I think these repeated bankruptcies, these repeated frauds. We've brought somewhere between 150 and 175 cases either settled or litigated successfully. And what we've found is this is really the Wild West, and it's around the globe. I would say, again, this is a small part of our U.S. capital markets, but it can undermine confidence when so many people have been hurt, and all they can do is then stand in line at a bankruptcy court. And it's not just one actor, and it's not just, oh, it's just a few bad actors over here. This is something that pervades a lot of this field globally. And it's hard for the good faith actors even to compete because there's so many challenges elsewhere.
Well, we eagerly wait that decision. I just also have to talk to you, Chair Gensler, about some of the legal challenges. Just this week, a group of hedge funds sued on the short selling disclosure rules that you proposed. There have been numerous other legal challenges to some of yours, the buybacks ones, the private fund industries. Do all the legal challenges undermine what you're trying to do?
Look, we do what we do based on the law and how the courts interpret it, and it's part of our great democracy. These industry trade groups or others have a right to go into court, but I'm very confident about the work that we've done. And let me just address a couple of the things you said. Transparency helps our capital markets. Transparency, economists have studied, lowers the cost of capital formation on the one side and raises the returns for investors because it drives to greater competition and efficiency in the middle of the market.
Well, they say though it discourages short selling and shames them, and it's an important part of the market structure.
I would say Congress weighed in after the financial crisis and mandated that the SEC address and have rules around the transparency around short selling for investment managers, I think is the term. And I got to the agency 9 years later. The SEC had not done a congressional mandate. I'm very proud that we took it up. We proposed something based upon a lot of public feedback, and we adopted a rule. And I think that it's a really important, I mean, for many of those investors out there, the everyday investors that might be investing and looking at these markets, remember the events around GameStop. What was that? Nearly 3 years ago. And no, seriously, like about transparency in the short selling market. We have a lot of transparency on the long side. Let's add the transparency on the short side that Congress mandated.
I only chuckle because of the list of issues you've had to tackle, from crypto to China to SPACs to memes to AI. I can't imagine it's anything like what you thought when you took the job.
Look, this is a great privilege. I pinch myself. I can't believe that this boy from Baltimore, neither of my parents went to college, has this opportunity, and I'm serving my third president. But more specifically, the great honor of being part of the 5,000 people at the SEC, and that we help oversee the markets and help those issuers and investors. But you're right, it's a wide swath of parts of the market, and the base of that market is the U.S. Treasury market. I'm just bringing it back because I'm so proud of what we did yesterday, and there's a lot of leverage in that market, and there's a lot of risk from time to time, and we want to promote greater efficiency and competition, but also resiliency in that market. We've got some really important projects around driving greater efficiency and competition in the stock market that you follow, the equity markets, and as like.
Well, there's been pushback on those proposals, too. So can we expect another 24 or so rules in 2024?
I don't want to prejudge anything, Sarah, but you're right about the figures. We've now, I think, adopted about 30 proposed rules have now been adopted, again, from China to the Treasury markets to the transparency projects we talked about. But there are really important projects, and you're right, it's about 25 or so, that we are still considering the public comments. and we're taking them on only when the staff is ready, the commission's ready, and it's based on the economics and the law.
Well, we look forward to talking to you about each and every one of them, hopefully. Chair Gensler, thank you very much for taking the time.
Thank you so much, Sarah and Carl, and happy holidays to all your viewers.
Happy holidays to you.
Got a news alert on GM today. Company announcing that its Cruise robotaxi unit will be laying off 24% of its workforce. It's roughly 900 employees. Layoffs come a day after Cruise dismissed 9, quote, key leaders for the company's response to that October accident that led to the fleet being grounded in San Francisco. It has been a tough time lately for autonomous, whether that's in the experimental or the practicing phase.
Kind of puts another one in the category of announcing layoffs with businesses that have been challenges. It's not like mass layoffs we're seeing, but the announcements are piling up here after Etsy and Hasbro, now GM Cruise. Up next, why European stocks are rallying despite the ECB's effort to push back against rate cut bets next year. That's next.
Plus, if you missed part of the show, don't forget to follow and subscribe to our Money Movers podcast, available wherever you get your podcasts. We're back in a moment.
European markets mostly higher this morning. The German DAX crossing the 17,000 mark for the first time earlier this morning before giving back some gains. The bullishness comes as the majority of central banks hold rates steady. Norway was the only exception. The European Central Bank, Bank of England, Swiss National Bank all staying put. Norway raised by 25 basis points, but says it expects to maintain the rate for, quote, some time ahead. Bank of England agrees, saying that monetary policy is, quote, likely to need to be restrictive for an extended period of time, singing a different tune than the Fed. And ECB President Christine Lagarde expressing similar sentiment as well.
We don't think that it's time to lower our guard. And we believe that there is still work to be done, and that can very much take the form of holding.
Lagarde also mentioned that the ECB did not discuss rate cuts at all during their meeting, which was in contrast to Fed Chair Powell, what he said about how the natural thought to go from rate hiking to stopping would be rate cuts, and that they did discuss it at the meeting.
Were you satisfied with Leisman's answer about the difference between us and Europe and
For
in
sure.
the mandate and the timing of our initial hikes?
Yeah, of course. And his point was that we started earlier, we did more here in the U.S., so maybe that's why. But also, you have to keep in mind that they have a single mandate in Europe, which is just to get inflation to target, and they're not there yet. And the Fed has that mandate too, but it also has a mandate for jobs and to keep employment going. And they have to be worried about the other side of it. I think Robert Kaplan of the former Dallas Fed came on with us and said the backstory here is they don't want real rates to be rising, because when they pause, that does happen with inflation coming down. They're also still doing quantitative tightening. So they don't want to be choking off what appears to be a soft landing or immaculate disinflation by continuing to keep a tight, restrictive monetary policy that gets even more restrictive, and that's why he pivoted.
Oh, wow, 10-year now below 3.9. We're going to watch that. Let's get a news update with Kate Rooney. Morning, Kate.
Hey, Carl, good morning. A big reversal this morning in Rudy Giuliani's civil defamation trial. His lawyers say he won't take the stand today as the only defense witness, which means proceedings will go into closing arguments. Then the jury will be left to decide how much Giuliani, the former New York City mayor and longtime Trump ally, will have to pay 2 Georgia elections workers for making false statements accusing them of election fraud. And Danish authorities say 4 people have been arrested on suspicion of planning a terrorist attack. Police arrested 3 of the suspects in Denmark and the 4th in the Netherlands in overnight raids. They have not identified the suspects or identified the possible target of that plot. And the U.S. is expected to sign a defense pact with Russian neighbor Finland next week in a deal that would allow Washington to send troops to the country. The Finnish foreign minister said today that the new NATO member's defense minister will be in D.C. on Monday to confirm the defense cooperation agreement. Carl, back over to you.
Thanks, Kate. Coming up after the break, Frontier Airlines has seen its stock cut in half this year. Can the company stage a turnaround and hold on to pricing power as others in the industry, like Southwest, warn of rising fuel costs? CEO is going to join us next to answer some of those questions when we're back in 2. We mentioned airlines before the break. When it comes to what to expect from demand this holiday season, our next guest thinks we're in for one of the biggest travel cycles in history, with leisure travel remaining strong and business travel showing some signs of normalizing. Joining us this morning is Frontier Airlines CEO Barry Biffle. Barry, welcome back. Good to have you.
Thanks for having us on.
What is the bigger surprise, that leisure can accelerate or that corporate can join?
I think the bigger surprise is corporate's finally coming back, but I think it's really not a surprise when you think about what's happened with kind of return to the office. And I think we often joke that people prefer to stay at a hotel versus their cube in their office. So it's not surprising to see people back traveling, but leisure is strong. And we're going to see one of the best holiday seasons that we've ever had.
As far as you can tell, from both your vantage point and the industry's, are these capacity additions for 24 going to be enough?
Yeah, so I think, look, we've had challenges. We ourselves have had challenges with kind of an uneven capacity growth that kind of favored the leisure markets and left a lot of kind of, city to city, visiting friends and family markets kind of left behind. So that capacity is going to shift, and I think you're going to see it normalizing. We're pivoting away from the overserved areas and pivoting to the underserved areas. And I think that normalization will be good for the airlines as well as consumers, because it's going to put more capacity where it's needed.
And prices. I mean, we've already seen a little bit of pressure on prices. Airfares have started to come down in the CPI report. What's happening with pricing as these demand dynamic shifts?
Yeah, so pricing has come down as you've seen some of the oversupply in Florida as an example. But we're finally seeing that stabilize. And I think, the actions that we're taking and the industry is taking, you should see a bottoming in fares that we think we've already seen.
I'm an old airline reporter when I was in my print days, and I used to cover Northwest, and they had a saying in Minneapolis, and that was about their route structure. They said, it's cold, it's dark, but it's ours, meaning those underserved areas where you could get big yield. Are there still markets like that?
Oh, yeah. In the United States, you've got places like Orlando and you get Las Vegas, where I'm standing today, which are actually up 15 to 20% in some cases versus 2019. But you've got other areas that you mentioned, your cold and dark areas. A lot of the, your Minneapolises, your Chicagos, many of those markets are actually flat to down versus 2019. So again, you've seen kind of an uneven return of capacity, and we were part of that. We were in some of the places that were too oversupplied, but we're going to shift that capacity, and so it'll be good for consumers because we'll bring kind of low fare relief to them, but it'll be good for us because it enables us to actually raise our fares on average.
What about the labor environment, Barry? How hard is it to find, we reported a lot over the year over pilot shortages. We've also seen some pretty significant pay rises at other airlines and unions this cycle. I think your contract's open in 2024. So what are you bracing for on that front?
Yeah, so look, we're going to have new contracts at some point, but we've finally seen the labor supply finally start to catch the demand, and so we don't have the shortages that we had, fortunately, in the industry, if you go back a year or two. So it's much better place, and everyone's, almost overstaffed, I think, depending upon the airline and the category, but everybody's got plenty of staff now.
Finally, industry's made some attempts at consolidation. The market's on a watch for regulatory friction on that front. I just wonder how amiable you think regulation is right now to carriers getting together.
Well, we're within weeks to find out the final answer in the JetBlue Spirit trial. So I think we will all know a lot more once that's done, just probably in the next few weeks.
Very appreciate it. Obviously timely as we're getting closer to the peak holiday season. We'll talk, if not before then early next year. Thanks.
Hey, thanks for having us on.
Barry Biffle of Frontier.
Were Adobe's results the canary in the coal mine for tech in 2024? We're going to dig into that after the break, with the stock down more than 5%.
Insight, analysis, opportunity. A look behind the curtain of what's really driving the market. Money Movers is now online. Follow us on X at Money Movers CNBC. become a member.
Look at shares of Adobe sinking after issuing lower than expected guidance. Deirdre Bosa on what that could tell us about 2024 in today's Tech Check. Do you think there's a broader message here?
Yeah, and Sarah, I'm not trying to spoil the party here, but it's worth noting that not everything is risk on, and there could be some signs of stress building in certain areas of tech. You mentioned Exhibit A. That's Adobe. Shares are down last time I looked more than 6% on the back of its earnings, which raised some key issues for the year ahead. Disappointing outlook, slower than expected AI ramp, regulatory scrutiny. Its Figma acquisition announced more than a year ago. That's still making its way through the DOJ. It's getting scrutiny abroad as well. And now there is a separate investigation from the other antitrust agency, the FTC, into its disclosure and subscription cancellation practices, which Adobe said could result in significant costs or penalties. This is part of a broader story that we've been telling over the past few months, that of more aggressive, more nimble regulators that are only ramping up scrutiny of tech. The rate environment and the macro backdrop, that may be getting more favorable for M&A activity, but getting deals through may be another thing, and that's another point. Adobe is another point for that argument. Exhibit B, that's Oracle. Shares are down more than 10% this week. Its earnings pointed, again, to slowing sequential growth in its cloud business, raising questions about a software comeback that some analysts and VCs have started talking about. It was also a reality check coming after beaten raises from other smaller names, and a reminder that the cloud story, it's not yet in the clear. Remember back to Google, which missed estimates on its cloud business, and then there was Amazon, which provided some hope of a bottoming of AWS growth, but management couldn't explicitly say that it was the bottom. So if cloud growth is indeed weak, we'll get more signals in the month ahead. That could, in turn, signal weaker enterprise spending and economic uncertainty. That said, Sarah and Carl, these moves, they are constrained. They're not impacting the broader software and cloud universe, yet at least. The story for now for tech at large is rates and those lower yields helping the rotation into high-growth speculative names, while those mega caps, they take a breather today. I'm just saying Adobe and Oracle, that could be something to keep an eye on and could be indicative of perhaps a broader trend as we head into 24.
Yeah, and also just how it matches with expectations, which have been so high for this group in particular, and Adobe and Oracle have been beneficiaries, right?
Yeah, and they report later on in the earnings season, right? So there's this tendency to think that once we get through the mega caps or the Magnificent Seven, we're in the clear. But Oracle and Adobe are two names that are not small. These are big cap, important names that say something about the economy at large and enterprise spending in the cloud. So they're important to keep an eye on, and they have more data to go on as well, right? What they say is really important because they're further on in the current quarter, so they may be seeing trends that we didn't hear from some of the larger names earlier on in the earnings season.
Yeah, two important dynamics that you mentioned, Dee. One, of course, is the idea that these mega caps are a source of funds to buy so much else in the market now that the rate environment has arguably changed. But, you know, we did talk to one of the analysts who upped Microsoft yesterday about IT spending intent, and at least it remains pretty strong, at least within Copilot and Microsoft, and they argued it would be broader than that as well.
Right, and one of the biggest questions here is we know that everyone's going to be spending more on artificial intelligence, but does that replace some of their current spend, right? Is it additional, or does it just replace some of the other stuff they've been spending on? So, you know, as Sarah said, these expectations are rising going into next year, but is that actually going to come through in enterprise spend? So it's a key question that I don't think we have the answer to yet.
Yeah, Adobe, as you can see, down about 5 after that guidance. Thanks, Dee. Deirdre Bosa. Still to come this morning, the Fed's impact for energy investors. The CEO of Cheniere is with us, the largest producer of LNG and biggest buyer of nat gas in this country, when Money Movers is back in 2. We'll close out the hour with the energy sector. Our next guest runs one of the largest natural gas producers in the world and joins us with his outlook for prices during what some are expecting to be a warmer than average winter across the United States. Cheniere CEO Jack Fusco is with us. Jack, welcome back. Thanks for the time. Great to see you.
Oh, Carl, thank you for having me today. It's good to see you also.
It's been hard not to watch prices, I guess, of the commodity itself. I just ask you, what do you think, what accounts for these low levels, and is the path of least resistance still lower?
Well, as you know, Carl, it's all about supply and demand. So the U.S. has hit an all-time production high. We've been producing around 105, 106 billion cubic feet a day of natural gas. As you said earlier, it's a little warmer on the weather, so there's not as much demand here. It's driving prices down, but that is actually really good news to Cheniere. So as you know, we're the largest processor of liquefied natural gas in America, but our customers pay us an index price to gas. So we don't have any price exposure to natural gas. In fact, the cheaper it is here in the United States, the better it is for demand worldwide.
What does demand look like worldwide right now for U.S. LNG?
It's off the chart, Sarah. We signed another 6.5 million tons of long-term contracts. Those are 20-year contracts. They're with utilities around the world. There's Norwegian utilities, German utilities, and industrial users, Korean, Chinese, and those are 20-year contracts. They start in 2028, run through 2053.
I know it's hard to predict the trajectory of geopolitics, but is there any scenario or resolution politically regarding, say, Ukraine that would interrupt the current movement of these prices or demand in Europe?
I don't see it. So what we're doing, Carl and Sarah, is we're exporting American innovation. So America dropped greenhouse gas emissions by 17% over the last decade. We did it by switching from coal-fired power generation to natural gas combined cycle power generation. And that's what the rest of the world needs. And that's what they want from us. They value our energy security, they value our reliability, and they value our affordability. And that's why the utilities are willing to sign such long-term contracts with us.
Really quickly, Jack, what's your sense of the regulatory environment into next year as you look toward expansion?
Personally, I'm a little worried. We're down to 3 FERC commissioners. That's Federal Energy Regulatory Commission. That's the federal governing agency that oversees our operations. We have another commissioner that her time is up middle of next year, and if that position doesn't get filled, then we won't have a quorum, and things will come to a screeching halt as far as new approvals. We have a lot of expansions going on at our sites. We're currently in a $10 billion expansion down at Corpus Christi, and our customers are depending on us, and our allies are depending on us. So we just need to keep things moving, even though I know it's an election year and things get a little silly.
Jack, some important issues there, way beyond just the state of the business. It's good to talk to you. Thanks for the time. Jack Fusco over at Cheniere.
Yeah, sounding that alarm there on the regulatory environment. We've got a news alert to close out here on Disney, who is now responding to Trian's nominations to the board that we brought you last hour. Those 2 names. Julia has the response. Julia.
Yes, Disney responding, saying the Governance and Nominating Committee, which evaluates director nominations, will review the proposed Trian nominees and provide a recommendation to the board as part of its governance process. Now, just a reminder here that Trian nominated Nelson Peltz, as well as Jay Rizzullo, the former CFO of Disney, longtime parks executive at Disney. Disney also saying here in this comment that it, quote, has an experienced, diverse, and highly qualified board that is focused on the long-term performance of the company, strategic growth initiatives, including the ongoing transformation of its business, the succession planning process, and increasing shareholder value. They also note that they expect to file preliminary materials for their shareholder meeting, and that shareholders right now do not need to take any action. You see Disney shares are up 2%.
Yep, proxy fight here. Thank you, Julia Borston. Just as we look to this rally, Carl, I would note the winners, REITs, office REITs, the home improvement stores and home builders. These are regional banks, the groups that got hit the hardest this year on the back of higher rates, going the other way. On the message from Powell, that soothing message on cuts.
That 10-year got below 3.9 a while back. Average 30-year fix now, Sarah, 6.62. Going back to May. And even though the indices aren't moving a lot on a numbers basis, breadth is very good. Volume almost 8-to-1 positive.
Yeah, people are excited about the activity this could spur, whether it's in the housing market or refinancing in the corporate bond market. It has a lot of impact.
And big OPEX tomorrow. Let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, the next leg of the rally as stocks continue their post-Fed pop. Now we ask the investment committee which sectors are now in play, given Chair Powell's pivot. Joining me for the hour, Josh Brown, Rob Seach, and Jim Leventhal. Everybody's here at Post 9 today. Markets, we are trading at record highs on the Dow Jones Industrial Average, still above 37,000. The 10-year lowest level since July. Small caps with a 52-week high. The market, Josh, is raising now the probability of cuts. March, 85%. May and June, 100%. Hotsiest over at Goldman. We expect earlier and faster cuts from the Fed. Our question to you first, does this pivot clear the way for the next leg of the rally?
I think the next leg of the rally didn't wait for this pivot. I think it front ran it. Let's put up a chart of IWN. This is small cap value. This is the place to be. We talked about this around Thanksgiving time. If you're betting on a year end where everyone's chasing and people who weren't in NVIDIA and Apple, what are they going to do? We said this is what they're going to do. This is what they did. IWN, small cap value ETF, is up, get ready for this, 18% over the last 30 days, which of course is ridiculous until you realize how much catch-up it has to play just to get anywhere close to what large cap S&P 500 names did. That 18% is versus 7% total return for both the triple Qs and the SPX. So that catch-up trade has worked. We knew it would come. It did come. It comes every year. You get this much outperformance from the large caps. I think there's still room. Look at the 52-week high list today, away from small caps. It's anything but large cap tech. I guess Intel, with the exception of Intel, but it's Blackstone, BX, Lennar, Pulte Homes, Home Depot, Wells Fargo, JP Morgan, 52-week highs. None of those companies do AI. No AI. Okay? That's the message. The catch-up trade is working. I think it's got room. It can continue to work.
Okay, so Rob Seachin, Goldman's head of hedge fund client coverage, Tony Pasquarello, normally puts a note out, into the weekend. He put one out today, just before we came on the air, in which he says, quote, I suspect there's still a little bit of gas left in the tank. To Josh's point on small caps, he says this was the exposure that most everyone in the community was short at some point in 2023. Well, those shorts are being covered. We've entered a seasonally strong period. Furthermore, a backdrop of easier financial conditions alongside a totally decent growth trajectory fundamentally argues for strength in small caps. Do you agree?
Do agree. Higher for longer has been taken off the table. Refinancing risk has come down. I think there's going to be a broadening out of markets. When you look at this from a macro level, Scott, there's a number of ways that it can play out. It can play out awesome, too awesome, or there's a problem. And we're in kind of the awesome camp for equities broadly because of the broadening out that Josh talked about yesterday.
But you haven't been, right? You've been a little more.
Second half of the year, we've been invested.
Yeah, but you haven't been using words like awesome to describe what might lie ahead.
We were in the
for
higher for
now,
longer camp,
right?
We were in the higher for longer camp. We thought inflation was not going to break the way it broke, and obviously there's a lot of issues out there. It's not like we weren't invested, though. We were invested.
I hear you.
And I do think when you think about the awesome side of this, you're going to see benefits from animal spirits, IPO activity picking up, M&A activity picking up, while the labor market continues to remain strong as economic growth may accelerate. Where it becomes too awesome is kind of like 1998, after long-term capital, when Greenspan fed the fuel on the fire and it kind of lit too high. But that can also be positive because we can stay positive for longer. The problem, and this is what I want to get to, which I don't think is going to happen, is if the Fed starts to cause this reacceleration in inflation, because energy prices have been key to this. As you pick up in economic activity, you get a weaker dollar, you're going to start to probably see some reacceleration in energy prices, which may change the inflation narrative.
Maybe. I mean, so I'm still hearing Jimmy the Bull, about the lagging impact of what the Fed's already done from Wolf. No change in their bearish outlook for the market for 24. Some are pointing to 89% of stocks above their 50-day as a reason to sort of take a pause. And then, you know, I spoke with Gundlach yesterday right after Powell finished on closing bell about the idea that is money going to come out of money markets because rates are continuing to drop and then push into the stock market, and that's going to fuel the next leg of the equity rally. Here's what he told me, because he thinks that might not be the case.
I think the logic that people have that money market bloat is going to go into the stock market is wrong. I think it's unlikely for investors to go from risk-free 6-month T-bills to the Magnificent Seven at massive PEs and all-time highs on the Dow Jones Industrials. I think they're much more likely to go from their mountain of cash in T-bills into bonds.
I don't agree. Big surprise there, right? But, you know,
by the way, Rob doesn't agree. Josh said yesterday, right after Gundlach finished, that, with all due respect, he didn't agree.
Yeah.
So give me your reasons why you don't.
I mean, look, I can understand his point that T-bills at 5% are attractive, but they're not as attractive as stocks that, depending on what sector you look at, might get 5% in a month. Now, look, I am a risk taker. I appreciate Jimmy the Bull as the moniker. But here's how I look at it. Here's how I rationalize it. I'm not just a guy with a nickname. If you look at, say, non-tech stocks, right, a lot of these companies have had fabulous operational results. I'm talking about, you guys know these stocks with me, General Motors, Alaska Airlines, Delta Airlines, Wynn Resorts. I can go down a long list of stocks whose operational results have been nothing short of awesome, okay, but their share prices have stunk. And what you're seeing right now is the market realize that that recession is less and less likely as the Fed pivots, and that the durability of those awesome operational results is intact and is a giant mismatch from where the share prices are. So that 5% in a month, I mean, look, yesterday, look at those stocks I'm just naming, we're up 5%. A lot of them are up 5% today. I mean, if you want to play it safe, God bless you, take the T-bills. If you want to make some money, get in the stock market.
So the problem with the T-bills, too, so you hear people screaming 5%, 5%. Dude, it's an annualized 5%. If you don't own it for a year, and definitionally, you buy a 6-month T-bill today, you will not own it for a year.
And you roll it.
In 6 months, you will roll it. You will not be rolling it at 5 unless the Fed stays where it is right now, which they're already telling you is likely that they won't. So let's be careful when we say, oh, it's just 5% risk-free. Annualized. That's not 5% in your account. So everyone needs to chill out with that also.
I feel like there are a couple of debate points to have around this whole issue of next leg of market rally and where it comes from, whether it's a rotation out of mega cap winners or if it simply is money from money markets, which Pasquarello at Goldman addresses as well, where he says, quote, there's nearly $6 trillion sitting in money market funds. Household net worth around $150 trillion. Wage gains continue to outrun the rest of the inflation basket. So if households want to add some value stocks to their portfolio, there are plenty of ways to do so that don't involve selling the winners. So he's making the case for money coming out of cash from money markets and going into stocks that you don't necessarily, Rob, have to have a bleed from mega cap tech to make anything happen in these other lagging areas.
You don't. You could see it happen in financials, and we're seeing that in the last few weeks, frankly. You could see it happen in industrials. You're going to see it happen in other capitalizations like small cap, which is ripping, and I think that continues. I really do. I don't know that there's a bell that's going to ring to say to everybody, hey, now's the time to get out of these large caps. They're very fundamentally sound businesses, but you are definitely going to see a broadening out.
Can I put a little mustard on that for you?
Yeah.
Because I like what you're saying. I did this after, so we were on with Gundlach last night. He made the comment, stocks are more overvalued than they were a few months ago. I think it's important to point out some stocks are, and Jeff is right about that. But I made the comment on the whole, it's just not true. This is what I want to share. On a forward basis, we know the S&P 500 is selling at 19.3 times forward earnings. That's not cheap historically. It's obviously not cheap in absolute terms. Mid caps and small caps are both 14 times forward. But even more interestingly, even in the large cap universe, ex-tech, the S&P 500, 26 times. Pull out tech, it's 17. So if I tell you, you can buy the average non-tech S&P 500 name at a 17 forward PE, and the next move for rates is more likely to be down than up, you probably would look at that and say, okay, great, I already bought a lot of cash this year. I'm part of that group that added to $6 trillion in money market. My next move should probably be to add a stock, even if it's a large cap, if it's non-tech, and you're buying something at 12, 13, 14 times earnings. It's probably a more productive move if you could think about it from a 3 to 5 month standpoint, not is this the right decision for the next 30 days?
In equal weight, Josh, equal weight trades at a discount to where it typically does. The equal weight S&P.
Equal weight's at what, 15 times, right? 14, 15?
And I think history is somewhere north of 16.
Maybe growing as we're, watching the market sort of go down the tracks. Speaking of buying names, not small caps, Jimmy bought United Health.
Bought United Health. There's a little bit of a story here. I'm going to do this out of order with where you started, which is to say I sold Nike. Let's start there.
Well, you sold Nike, you sold Bristol. You used some of the Bristol proceeds to buy United Health. Just tell me the buy first, and then we get to the sell part.
Okay, so United Health is because I want healthcare exposure, all right? This sector has been a dog. We know that. It's lagged all year. I do think that the value is there. The dividends are there, and I want to have healthy healthcare exposure, no pun intended, going into 2024 for what is likely to be a mean reversion trade. But I had to buy United Health, more or less, because I sold Bristol Myers. Bristol Myers is typical of the healthcare sector this year. It's just done awfully, and I needed that tax loss, Scott, because I sold Nike. Nike, I'd held it for 2.5 months after the last earnings report.
That's short for you.
And you know what? It's up 27% in 2.5 months. You're exactly right. It is short for me. The market gave me this gift. I had to take it, Scott. Think about it just from a psychological point of view. Do I really want to go into next week's earnings report and risk that gain in 2.5 months? The answer is, it's a rhetorical question. Of course I don't. And I hope that holders do well. I hope the earnings are great. The stock blows it out of the water. I got 27% in 2.5 months. That would be good for a 12-month return for me. I'm going to take that money. I'm going to find other things to do with it.
What do you guys make of these moves? Rob, you first. I mean, you own UNH. You own Bristol Myers. You don't own Nike, but it is an interesting strategy to sort of take the money and run in a short period of time from a name like Nike, where Jim surveyed it for an awfully long period of time, wasn't ready to get in for an awfully long period of time, then did. Now he's out.
Totally get what Jim did and appreciate what he did. We did the opposite moves of Jim, though, in healthcare. We've been trimming UNH, have owned it for a very long time, and have been a steady trimmer on declining profitability, growth, and free cash flow. We did buy 2 weeks ago on the show BMY. So stocks underperformed the S&P by 50% year to date. It's down 37%. I'm sure there was some tax loss selling related to that.
Well, it was to offset Nike. Right? It was to offset the gain in Nike.
Got it.
It's portfolio management.
Yeah, just portfolio management. Stock's cheap, trades at 7 times. I think healthcare is going to be a beneficiary of this broadening out, and that's why we took a slightly different
tactic. Why is Bristol Myers so terrible this year, and what's the catalyst that you think will turn the trend around? I don't follow it closely. I'm genuinely serious.
It's the business has been quietly performing well, and our thesis on that is that earnings are bottoming here. So really simple. We're trying to find ways to add value stocks in portfolios, and that was one that 2 weeks ago we talked about on the show.
Almost a 5% dividend yield. Is it solid? Are they debating doing anything with it?
I don't think so.
Okay. Why don't you think that the gains, which by the way Nike called top pick today at Barclays, and there's been a lot more positive commentary on Nike lately than almost any other footwear or apparel related stock. Remember, there's been a multitude of notes in the last 2 to 3 weeks where they've taken Lulu, for example, not necessarily in a downgrade, but down a notch in favor of a Nike on multiple lists. That stock has gone up.
Yeah, look, If the stock goes to 140 from here, I'm happy for everybody who owns it. I will try to take those proceeds, which again, look, I bought the stock at 24 times forward earnings, which I was saying all along was my line in the sand. Maybe some people felt it's arbitrary, but I've had great success over the years buying Nike at that level. It's now at 30 times, right? That's what happens when it goes up 25%. I will, Scott, try to find a stock with those proceeds to buy that will have the same or better return as Nike going from 120 to 140, but psychologically, and there is psychology involved here. I just don't want to go into that earnings report next week. I think they'll do fine, but if they do badly and all of a sudden my 27% gain evaporates, I don't want that.
How do we feel today about financials, which have hit a 52-week high, Josh? Since November 1st, the real heart of this market burst, if you want to call it such. These stocks are up, most of them, more than 20%, in some cases greater than 25%. The only one that's not is JPM, but it's up 17%, so it's not exactly a slouch.
Well, I think the steepening of the yield curve is the story here, and I think the anticipation of that happening, because of course it hasn't happened yet. But there were some serious questions about the balance sheets. Bank of America, most notably, a lot of mortgage debt that they were upside down in, and a lot of debates about the held-to-maturity portfolio versus held for sale, and whether or not that was a legitimate way to even think about how much liability the bank had, et cetera. All of those debates kind of go away if we think the forward course of rates is that overnight rates are going lower, and intermediate to long-term rates probably have peaked for the cycle. We could stop worrying so much about some of the things that have held those stocks down. And look at Bank of America. It's almost like trying to hold a beach ball underwater. That's a parabolic move to the upside you very rarely see in a company like that. So it's a pretty notable 180. I'm not in that stock. I'm in JP Morgan, though. It's at a 52-week high today, very happily. A lot of the financials have gotten that benefit of what's happening in rates. I don't really think there's much more to it than that.
Jimmy, Mayo over at Wells Fargo today names your city his top 2024 pick, his #1 large cap pick. Stock's up near 30% since November 1st. What do we think about financials here, specifically that stock which you own?
I like the financials a lot here for a lot of the reasons that Josh just mentioned. I like Citigroup in particular. People have to understand this is not JP Morgan. It's not the same company. They shouldn't be compared to one another. This isn't an investment banking company. This is a securities services and cash management company. And what Jane Fraser, who's been CEO for 2.5 years, has done is the right thing. First, she started out by rationalizing the international businesses, getting rid of things that were non-core. That's done. Now she's rationalizing the domestic business, getting rid of expenses, cutting layers of management. The street is applauding. This is what Mike Mayo and others have wanted all along, is to get the return on tangible equity for Citigroup up. You do that by cutting expenses, stocks being bought back by the company below book value. And there's something that Josh mentioned about, as the Fed takes its foot off the neck of the economy, this helps on the margins credit delinquencies. Citigroup has a very large credit card business.
What is the growth story? So the stock is down 6% since she took over versus an S&P that's up about 35%. What is the growth story for? So we get it. She's restructuring. It sounds like you agree with those moves. Then what? Like how does this stock not be 8 times earnings? Still sitting at the same price roughly where it's been for 15 years.
Couple of things. I mean, first off, keep it simple. And this is why I said the comparison to JP Morgan is not right. JP Morgan has a lot of awesome things going on. We know that.
They're goated. Take them out of the conversation.
Right.
I agree.
No. Got it. Okay. But Citigroup is just basic banking, Josh. It's just.
Is that a good business?
Yeah, it is. Well, it is if the economy does what we've been talking about, what I've been talking about for quite some time.
Banking, that's good. We like it. No wealth management, really.
You lend at this rate, you borrow at this rate. It's really good. And at the same time, you're cutting costs. At the same time, your credit delinquencies are getting under control. Stock has a lot of cash flow. They're buying back those shares. And I know I talk about this a lot, but buying back shares below tangible book value, like at a 40% discount to tangible book value, it's accretive on the balance sheet right away.
So we're overweight financials. We started to add to our position in JP Morgan in June. November, we doubled our position in Wells and added Comerica. It's up 25% since we added it on the show 2 weeks ago. I think you have to be overweight financials. There's going to be this broadening out of the value trade. Financials are one of the largest beneficiaries of that. In addition, these companies are very, very cheap, especially the regional banks.
Would you add exposure here?
might be my final trade.
Okay. Nice tease. Thank you very little. Okay, let's address, I don't know if it's the elephant in the room or whatever, but let's address mega cap, okay? Did the game in any way, Josh, change for mega cap stock performance yesterday with this apparent pivot, that's what people are calling it, by Powell? The rate trajectory is now lower.
Yeah.
Did the game change yesterday? The goalpost move at all for that trade?
I think one of the things we've learned in the post-financial crisis period, we now have like a decade and a half of history. One of the things we've learned is that in periods of time where there is doubt about overall economic growth, these are the stocks that catch a bid and tend to lead the markets, both on the way up and they go down less than the overall market. And there's a good reason for that. They have secular growth, or maybe they used to, more so than they will now, given how big they are. But there were market environments where there were serious concerns about global growth or U.S. growth, or why can't the Fed stoke any inflation whatsoever? Why are we fighting disinflation? We had inverted yield curve in 2019, way before COVID, and these stocks were leading. Because when you have growth, and growth is scarce, you're worth more to the investing public, and they will bid your stock up. If the game is now going to change, and we're not hung up on the recession starts next week, no, the week after, no, the week after that, and we think there's a path for overall economic growth, it makes less sense to bid up the Mag 7 because they won't be the only growth in town. So that's the way that I think about these stocks. They get more coveted when no one else can grow. If other stocks, other sectors have their own growth story, they're less coveted and therefore should shrink in proportion to the overall market.
That was kind of Rob Gundlach's point too. It's not like he doesn't think stocks, can do well. It's just, quote, I think you want equal weight rather than market cap weighted at this juncture. He's speaking directly of Mag 7, the multiple expansion that we've seen there. Apple, new record high today, but you saw the others on the list. There are several that are selling off just a little bit. Reiterated sector weight at KeyBank is Apple. A lot of the other names talked about almost on a daily basis. The stocks have just done incredibly well. I'll ask you the same question, though. Did the game change in any way yesterday?
I think if it hasn't, it's going to. We've been overweight tech all year. We're evaluating that right now. It's tough to evaluate it in December. As you're approaching year end, you've got a lot of clients that have huge embedded gains in these names, and even just resizing the positioning. I'll give you an example. We bought Broadcom in April. Okay, Broadcom has been such an unbelievable performer.
Record high today, by the way.
And it's also
reiterated overweight, $1,200 the target at KeyBank.
And it's also become our second largest position in very short order because of that performance. I think people have to pay attention as they go into next year about exactly what Josh talked about, which is where am I going to get the funds if they're not coming from cash and I don't want to increase equities? You're going to reallocate within equities. And so I do think there's this catch up. I think there's going to be beneficiaries beyond the Magnificent Seven, and you should be prudent. It doesn't mean you have to run from them. I think that would be foolish as well. These are companies that are some of the best businesses in the world, but you have to right size them.
Speaking of non-Mag 7 tech, Qualcomm overweight, 145 at KeyBank. That's a 52-week high today for that stock.
Yeah, I mean, this dovetails exactly with what Josh and Rob were just saying. And let me point out a data point that may seem arcane, but it actually matters. South Korean exports are up heavily. Okay, what does that mean? You think South Korea is exporting lettuce? No, they're exporting semiconductor chips. And this is semiconductor outside of AI.
I was going to guess kimchi.
That was pretty good.
Go ahead.
All right, but these are semiconductor chips outside of AI. These are mobile phone. These are automotive. This is Internet of Things. It's even laptops. Okay, it's clear that the cycle has turned for mobile, which is helping Qualcomm. It's also never turned down for automotive, which is why NXP and Qualcomm are doing well.
AMD, Josh, yours top pick for the first half of next year at Rosenblatt. 52-week high again. Price target $200.
I mean, this is one that I don't own enough of. I typically buy a stock, and my assumption is I'll be wrong, it'll get cheaper. I consider that a form of schmuck insurance, just the way I carry myself generally in life. I shouldn't have done that here. I should have owned more. So now I got a stock that's up like 45% in a month, and I barely own enough to even get excited. So I don't really know how to answer your question or whether or not that does. I just wanted to share that because I think if I bottle it up, it doesn't do me any favors later in the day.
All right. I appreciate you letting that out. You feel better?
No.
Maybe you will after the break. because we're going to take one. When we come back, calls of the day. We've got a ton of analyst activity today. I've got some stuff on Palo Alto. We're talking Live Nation, Wynn, GM, Honeywell, Delta, and on and on. We'll do them next. All right, here we go. Calls of the day. Got a number to get through. ATH, all-time high for Palo Alto today. The price target to 350. We do have ownership of cyber stocks. Not that specific, but Josh, you got CrowdStrike.
Yeah.
What do you think?
I mean, this is, from my perspective, this is going to be a growing pie. I don't think it matters that much which slice you own, but I think be careful because eventually there are going to be some very clear winners and not as many players as there are today. In my personal opinion, CrowdStrike is going to be in the winner's circle. I've been saying that for years. Stock's up like 150% this year. I'm sticking with it. I think it goes higher.
Rob, Fortinet is your play here.
Yeah, I mean, the metrics on this company, 40% free cash flow margins, growing at 30% year on year. To Josh's point, these businesses are phenomenal. Anytime there's a concern, though, with any slowing top line, you're going to get pullbacks because they're fully valued names, right? So you're going to...
None of them are cheap. I agree.
All right, let's do Live Nation. That's yours, Josh. Upgraded today to overweight. That's at Morgan Stanley. Price target about 25%. Higher than where it is now.
You're giving me all my Hanukkah gifts in one night. I don't know what we're doing here. It's almost too many. Live Nation looks great. Look, the stock basically sat out most of this year. It's been back and forth between the 70s and where it is right now. I do think there will be a breakout, though, at some point. I'm keeping this holding as well. The concert business is absolutely on fire. What Taylor Swift did this year is absolutely historic. She won't be the only one. I think next year you'll have massive tours. I could reel off a list of 5 or 10 names. A very big one, Drake and J. Cole. These are all Live Nation venues. You're going to see Chris Stapleton and his whole festival on tour. There's going to be a whole host of names. Luke Combs. I can go down the list. I think Live Nation is the way to play, regardless of what's on your playlist. This is where the money is being made right now. That's not going to change.
Jimmy, at Wynn, your stock, top pick at J.P. Morgan. Overweight, $104. We see this as a mid-cap way to play the Macau recovery while capitalizing on strong domestic trends in Vegas.
I mean, and there's a ton of reasons to back that up. I mean, first off, if you listen to the last conference call, Wynn said that the Formula One race a few weeks ago was going to be a record for their weekly revenue in their hotels. And I don't care what happened with the race. They had record revenues. They got the Super Bowl coming up. The Sphere is, rolling all around that city. And by the way, on Macau, it's not just a recovery from Macau. It's the multiples that are being placed on the Macau levels right now are out of whack with how good the gross gaming revenue is right now at Macau. There's all sorts of positives. They're buying back shares. They initiated a dividend a couple of quarters ago. This is a ridiculously cheap stock. I like Wynn a lot.
Are you finally going to get some performance from GM?
I think so. I think so.
Because it was named a top pick as well at Morgan Stanley. $40 is the price target for that stock right there.
Adam Jonas, excellent analyst. He's in some sort of toxic relationship with GM and the industry. I think he wants to cover another industry, honestly, because he says, I'm reading it right now, heading into 2024, we remain concerned about the future of the U.S. auto industry, even more than during the fiscal crisis of 2008, 2009.
Because he's been worried about what they're spending. Right.
But they've pulled that back. And internal combustion engines are going through the roof. I mean, by the way, prices are coming down on new cars. That's good. That's good for the economy. Volume is going up more than enough to make up for that. Right. Profits are terrific. They've got a lot of cash at GM, a lot of cash flow. They're buying back a quarter of the company in an accelerated share repurchase. The recession's off the table. Can we agree on that?
Well, I mean, look at the stock over 1 month, 26%.
The recession's off the table, and that's going to continue.
Honeywell, Robbie, reiterated buy today at Goldman. Price target $230.
All these economically sensitive names, Wynn, GM, Honeywell. I mean, I think what you're seeing is the fact that lower rates are going to stimulate economic activity prospectively. Investors are getting out in front of that. And it's going to benefit names like this and the others mentioned. Do you not love Jimmy's inner monologue as he talks?
I do.
It comes out.
Okay, we'll give him another chance right now because Delta was reiterated by at Goldman. Price target goes to 47. Relatively strong balance sheet, they say. Accelerating growth in high-margin businesses like customer loyalty.
Great airline, but I think emblematic of the airlines overall, this is what I was saying earlier and what Rob was just saying, the operational results of these companies have been nothing short of fabulous, nothing short of awesome. The share prices have languished because of concern of a recession. As Josh said, and it was funny, the recession is going to be next week, no, the week after next. Guys, it's off the table, all right? The durability of these operational results is intact, and with that, the share prices should go higher.
What about Boeing, which was called a top pick today at Goldman?
A lot of momentum, a lot of positive sentiment at Boeing, and I think it's deserved. This is Boeing's victory to not lose, okay? As long as the production continues to increase, and they're going to go to 42 a month in 737 MAX production in February. That's a lot. That's going to generate free cash flow. It's going to allow them to pay down the debt that's on the balance sheet. Things are looking great. Order book is fabulous. And by the way, at some point, I think soon, China's going to place an order. That's a catalyst that is not in the stock right now.
Last but not least, Depot. Rob, you guys have Depot and Lowe's. Target at Home Depot, $370 at Guggenheim today. Set up to impress investors in a transition period before its plans to grow its pro segment take off.
Yeah. Again, household formation is not slowing down. I think, as interest rates come in, economic activity is going to pick up again, specifically in the housing area, and they're going to be beneficiaries of that. The stock's been on a tear. I'm glad we held on to it. I was tempted to let it go earlier this year. It did nothing for a very long time.
What's so great about Home Depot, and I don't own it, and I feel terrible every time I look at it. What's so great is in a terrible housing market like the one we're in now, which is basically frozen, right? So people have to stay put. What do? They spend money to renovate. Yeah. In a great housing market, guess what? They go to Home Depot anyway, and now they're building. And it's almost like you win either way because they're so good at executing.
You do have to be patient a lot of times with this stock, though. Yes. It stalls for periods of time, and like I said, patience has been rewarded.
All right, let's get the headlines now with Julia Borston. Hi, Julia.
Hey, Scott. Former President Trump's bid to overturn the gag order in his civil fraud trial denied today by New York State Appeals Court. The court ruled the impact of the gag order was limited and narrow, and that the gravity of potential harm from it was small. Closing arguments are underway now in the trial of Jonathan Majors, the actor and Marvel star accused of assaulting his former girlfriend. The defense rested his case Wednesday. The jury is expected to begin deliberations today. He faces up to a year in prison if convicted on all charges. And you don't see this very often, a bull on the loose in northern New Jersey. It was spotted this morning on tracks near Newark's Penn Station. Police eventually corralled him behind a fence and tranquilized him. He was taken to a nearby animal sanctuary. No word yet on how he got there in the first place. Scott, that's a pretty unusual reason to have delays for New Jersey Transit.
It's like a metaphor for something.
If they don't name that bull Tom Lee, then I don't know.
Those are my peeps. Those
Julia,
are my peeps
thank you.
on the tracks.
That's Julia Borston. Somebody sent that around earlier. I thought it was fake.
It's too good. It's too on the nose. It's like a meme, but it actually happened.
The bull's running. The bull is running today. Not in every stock. Not in every stock. We're going to show you one that's down pretty substantially today on its guidance. It's from the software space. We do have ownership up here. We'll do it next.
CNBC.
It's not all fun and games today, is it, Robbie? Adobe's down 6.5%. Well, no, it's less than that, about 5.5 now. Guidance was weak. It's one of the worst stocks in the S&P today, and you own it.
We do own it, but let's not neglect to say that it's up 88%.
That's fine.
Giving some back. And, you know, listen, the guidance wasn't good. The earnings didn't beat as much as expected. This is the danger of owning a stock that's kind of priced for perfection. because if you end up having not a perfect outcome, your stock's going to take a hit. And it doesn't invalidate the company, but I think the setup for this entire AI ecosystem is one where, you know, the expectations are so high that a lot of these stocks, if they disappoint, you're going to see stock price reactions like this. It's no surprise.
In the break, Josh, you were flagging Snap shares, which are up 4% today.
I'm trying to count how many days in a row this stock is up, and I lost track at like 13. It conceivably could be up 15 straight days or something like that. There's something interesting going on here where their Snap Plus users have surprised to the upside. They had 5 million users of Snap Plus, which people pay $3.99 a month for. That jumped to above 7 unexpectedly. And one of the main reasons is the AI tools they're giving to those users. Imagine you're a user of Snap. Imagine you're 14 years old again. Your friend sends you one of these AI-generated images, and you're like, how'd you get that? And they're like, oh, Snap Plus. Oh, I want Snap Plus. So the AI story at Snap is really interesting in that it could be generating more paid subs than Wall Street expects. They got an upgrade on Monday from Wells Fargo, $22 price target. I am not in this name. It's been on my radar for a long time. It's down huge over the last 3 years, and now I'm watching it.
It was a $7 stock. I mean, it's a
Word up.
The 52-week range is from 7 and change to the 17 you're seeing here.
And they're actually selling something that's not an advertisement. So the main revenue source for Snap is ads, hence why the stock's so terrible. But this is another business that they're in that actually might have legs. So I'm going to start paying attention now.
Let's kick Berkshire around for a second because they're buying more Oxy. It's like a broken record because they've been buying so much for so long at this point.
Yeah, they love it.
27% is the stake. Why don't you hit that quick, and then I'll hit Jimmy, too, because you guys both own Berkshire.
The thing to keep in mind about Berkshire is that they are not a dilettante when it comes to energy. I think they own the second largest utility in the United States. So they understand not only the output side, but the input side as well. And so seeing them continue to accumulate this stock, I think should get people's attention. Energy has been a tough sector this year. It's lagged pretty much everything. But these are companies with tons of cash flow. A lot of them are paying big dividends. And I think if Berkshire is this committed, we should probably give the space a second look as well.
Jimmy.
Exactly. Tons of cash flow from the space. And I think it's easy when oil comes down from $90 to $70 a barrel for people to say, oh, see, this is why we never own fossil fuel companies. That's the wrong way to look at this. We need fossil fuels for the next several years. It's highly likely that the economy recovers not only here, but globally in the next year. That pushes oil demand up. This stock trades at a 10% free cash flow yield. That's what's attracting Warren Buffett to it. And those free cash flows are likely to grow as energy recovers.
All right, so we have more stock stuff ahead. Steve Weiss alerted us to a stock that he's buying. We're going to take a break. We'll come back. You'll hear from Weiss. Mike Santoli's on the other side of the break as well with his midday word.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
All right, we are back. Our senior markets commentator, Mike Santoli, joining us with his midday word. I can't wait to hear what it is today, Michael.
You know, we have the no pain, big gain trade on. It seems like everyone has decided that there isn't going to be really a dangerous trade-off between what we can expect in terms of easier financial conditions and economic growth. So that's the view from today. You know, on one hand, you take it in really short bites. Yep, the big indexes are looking pretty extended on a very short-term basis. Seems like we've had this culmination moment where all the things you've been asking for has more or less been delivered. On the other hand, you know, markets up, S&P's up less than 3% from the high on December 1st. Obviously, it's flat over a 2-year basis. And as you guys have been discussing, so many things below the very top of the index have just done nothing or worse for a long period of time. So today's a Bank of America, Home Depot, you know, type of upside leadership day as opposed to a Microsoft and Lilly. So that can probably work its way through for a little while right here. And, you know, the dollar is in free fall. Everything is kind of falling into line. So something always comes along, you know, to kind of disturb that happy picture. But for now, people are acting on it. I don't really also think that people are super over their skis with exposure. I was looking at the National Association of Active Investment Managers, the fresh weekly numbers just midday today, and they're below the equity exposures of July, even though they've chased this rally to some degree.
Hey, Mike, 91% of the S&P 500 above the 50-day. That's the highest since November of 2022. 78% of S&P 500 names above the 200-day. That's the highest since January of this year. Historically, not the best place to be adding new positions. Right. Maybe not a sell signal, but usually not optimal. You'd agree with that, right?
I would. So you have all these signals like that which say, you know, we've come a long way in a short period of time. It's been a pretty indiscriminate rally in the short term. On the other hand, usually the forward implications of that, if you go out a few months, are positive. So when you have one of these big rushes higher with almost every stock running, it is usually time to cool off a little bit. I don't know if that happens, you know, in this sort of seasonal air pocket here, but you're absolutely right. That's what I mean by saying it's kind of extended, but the message of what the market is trying to price in here is still relatively encouraging.
Yeah, I mean, you got 700 points nearly on the Dow since yesterday afternoon. Yeah. So your point's well taken. Mike, I'll see you in a little bit on Closing Bell. Thank you. Mike Santoli, our senior markets commentator. Up next, we're tracking the trades. As always, I told you Steve Weiss just added a new name to his portfolio. It got Farmer Jim's attention as well. I'll tell you about it next. All right, welcome back. Told you Steve Weiss was making a move. Joins us now. I think he's on the phone. Weiss, so you bought back Deere, which you sold in the summer. Why'd you do that?
I did. And when I sold in the summer, I said the stock trades is about 370 to 410 while we're trying to figure out the economy and trying to figure out what's going on. Farmers, construction, all of which they're involved in. So I actually did buy a little at 470, very, very little, and it didn't hold, traded down to about 462. But as Powell was talking yesterday, I said, how do I get exposure in the cyclicals? Because the only exposure I truly have is in Freeport, which is doing quite well. And Deere was the easiest for me to go to because it's a company I know well. So I bought some yesterday as he was talking. I bought a little bit more this morning, and then the stock just ran too much. So I can't tell you it's going to be a long-term hold, but I'll tell you what I do like about the company. And the reason why it may not be a long-term hold is I think, again, I'll be able to get it cheaper. They cut their production schedule a little bit early in the year, so management is pretty astute as to what's going on in the market. While prices are coming down, so it's kind of ironic in a way because inflation's come down, allowing Powell to say what he said yesterday in the dot plot, which is what I was really focused on, to add another hike for this year. Mm-hmm. Prices coming down in commodities, as we've seen with corn, as we've seen with beans, soybeans, et cetera, isn't great for the farmers. So you've got that little juxtaposition of inflation coming down, but not coming down where you want it to come down here. Nonetheless, there's going to be a continued broadening of the market, in my view, and this is the best way for me to get into it because I know it. The others I'm looking at, frankly, and this will make Jim happy as well, hopefully, are General Motors. I'm also looking at BMW because it's got a much larger dividend. So hopefully some of these fall back where I can get the exposure. And then the only calculation I have to go through is even if there are weak earnings, which I still believe will be the case, in the January quarterly announcements for the fourth quarter, will the market continue to look through it? And right now, I'm sort of leaning at the market will look through those announcements. But you want to keep powder dry to buy on the initial hit, like we're seeing with Adobe today, where it can be kind of brutal on a sell-off.
I was waiting for you to finish. I was waiting for you to finish your commentary with, and I just want to end with the note that Jim's been right, and I'm sorry for trying to beat him up for all these months on the market because he's looking pretty good right now. And if you bought Deere and even managed to utter the words, "I'm looking at General Motors," to him, we could show his face.
I mean,
that is
I would say that,
a seal of approval of him and his view like I've never seen before.
Listen, I got to hand it to Steve.
Actually, it's not, Scott. It's not. In all seriousness.
Stop while you're ahead, Weiss.
No,
listen.
I am
Steve,
not ahead. Let me just finish thought. It's actually not a seal of approval because Jim's positioning, everybody has different. As a value player, value positioning, it really hasn't worked the whole year. The only things that's worked are what stocks I've been involved in, Meta, Microsoft, and others. So while Jim's been bullish, it's all where you put your dollars. It's about positioning.
All right, I'm still going to be gracious, even though he's being a snot there. Steve, I do applaud you. Here's why. When the facts change, you got to change with it. That's what you've done. You've been bearish, and now you're clearly pivoting with the facts on the ground. I'm going to let the snottishness go. I got to applaud you.
God bless you, Jim. Everyone. I wish I could be a better man.
I do too. I do too, Steve. Work on it. New year coming.
I thought this conversation was going to just have a much lovelier tone to it. I'm sorry that it didn't. Weiss, thank you. We'll see you. I actually did.
Are you new? Are you new here?
I did. Apparently, I'm naive. We're back with finals next.
You thought that was going to get pushed?
All right, we'll see how long this pop's going to continue post-Powell in this pivot, as folks are calling it. We'll definitely talk about that on Closing Bell today, of course, at 3 o'clock Eastern time. We'll run you right into the close, see if we maintain these record highs. The Dow, again, 37,000, almost 250. So 500 plus yesterday. You've got another 160 today. We'll see what we do. We've got Anastasia Amoroso joining the conversation, Mark Okada, Stacey Rascon, Joe Terranova as well. So we'll have some fun. A couple hours time, 3 o'clock. You want to talk about just what's happening in this market?
Yeah, we actually have a breakout in progress in shares of Empire State Realty Trust, which we've talked about on the show. Not for a while. Last time we talked about it, it was $7 this fall. Now it's almost 10. I think it can get above 10. It's been part of this huge rally in real estate, especially office real estate. Company is profitable, paying a big yield. I think just too cheap under 10. I'm staying with it for those who are curious.
How do we think about, Rob, yield plays, whether it's REITs, utilities, yields continuing to come down, broke below 4% on the 10-year. Did that game change yesterday?
100%. I think a lot of the risk has been taken off the table on a lot of those names. They've lagged so much. The price performance has been devastating for some, and you're seeing a major catch up there.
I mean, utilities are down today. Jimmy, how would you think about that question about, you know, we spent, what do we spend, a week straight mentioning utilities every day because they were down for like 9 or 10 days?
I would say the offensive componentry, not the defensive component, so more like the REITs.
Yeah, I think the important part is the defensive element of these. I mean, these stocks, a lot of the utilities just got hammered in the middle of this year. So now they're not as expensive as they were at the end of last year. Maybe they're attractive, not just on the yield basis, but on them having come down and having attractive valuations.
Dollar, you know, obviously dropping yesterday. Energy, the leading sector today, near 3%. What do we think about energy stocks here?
I mean, if you're somebody that believes in mean reversion and you want to go into the new year with an underperformer, that's probably the best place.
Oh, I forgot we're doing finals. Just give me a name.
Zoom.
What do you got?
America.
Paramount.
Oh.
Yeah.
Good old Paramount.
Yep, making my bed. Let's see if I sleep comfortably.
All right, I'll see you at Closing Bell. The exchange begins right now.
Thank you very much, Scott, and welcome to The Exchange. I'm Kelly Evans. Here's what's ahead this hour. The Dow's at a record. The S&P and NASDAQ are touching 52-week highs. Yields are down to levels we haven't seen since the summer. But did the Fed actually give Wall Street the all clear? Our economist isn't convinced. Plus, the most heavily shorted S&P stocks are the same ones up double digits so far this month. That's a warning sign to one equity strategist. He'll tell us what it means for the staying power of this rally. And mortgage rates have a 6 handle for the first time since May, while rents in one key market are falling for the first time in 2 years. Whether we're on the brink of a major turning point in real estate. Before that, though, let's get the very latest on today's market action. A really extraordinary 2 days here. Bob Pisani on the floor of the New York Stock Exchange. Bob?
Yes, and the rally continues, and the breadth of the rally is what's kind of, well, breathtaking in a sense. Let me just show you the major averages. The S&P is having a nice day. It's up about 0.5%. But the equal weight S&P 500 is doing even better. And this has been what's going on all week. There's that RSP there. That's a good way of indicating how broad the rally is. A lot of stocks are participating because everything is equal weight in the S&P 500. We do have a new high on the Dow Industrials, historic high. NASDAQ down fractionally, but also essentially a new high yesterday. 350 or so new highs at the NYSE, more than 300 at the NASDAQ, just all over the place. JP Morgan, Boeing, Apple, historic high yesterday. Home Depot, Goldman Sachs also doing really well recently. Intel all doing really well. I just want to show you another example of how the market's breadth is wide here. High beta stocks have been very hot this week. So there's the SPHB, that's a high beta index. These are stocks that move more than the market moves. So when the market starts moving quickly, momentum traders go into these stocks because if the S&P is up 1%, they typically would be up, say, 2% on a day. And in an up market, that's a lot of money all of a sudden. Let me show you examples of some typical high beta names. Carnival, look at these moves up here, and they were up big yesterday, too. Generac, Blackstone, Broadcom. These stocks all tend to move. They have high betas. They tend to move more when the S&P is up they're up even more. And so you see the market momentum people coming in a very, very big way. Finally, just want to mention the regional banks just on fire this week. Almost every one of the big regional banks are up in the mid-teens right now. So and this is just today. Yesterday, they were up the same thing here. Regions, Synovus, Citizens, it doesn't matter. Kelly, it's just been a remarkable week overall.
And Bob, I was struck that when you checked in with Art Cashin, he was still pretty bullish.
Yeah.
We'll get his mic back. We'll play you the Art Cashin clip. It's very, very interesting. But my next guest is also one of the most, if not the most bullish market strategists coming into this year. The S&P 500 is still going to finish about 200 points above his initial target, and he thinks the rally will continue into next year. His base case is 5,100 by year end. Bullish case takes us to 5,500 next year for the S&P. Joining me here on set now is Binky Chadha, Chief Global Strategist at Deutsche Bank. Welcome to you.
Thank you.
Let's rewind the clock for a minute, shall we? Yeah. Now, do you often find yourself towards the top of the pack, or was a year ago kind of an aberration?
So I would say a year ago we were at the top of the pack. By the middle of the year, we were in the middle of the pack.
You were in the middle. Everyone else, they vaulted over you.
Right, right. I would say, so far, I mean, year's not over. There's still a couple of weeks. Tends to get a little slower as you go in. And what we've seen, of course, is a very, very steep rally. So the counterpart of that is positioning has been rising, I would say almost vertically, which is not, the healthiest sign. And so, yeah, it would be just a little bit careful here, but I don't think it's a big deal. I think, we had, I would call it a game changer yesterday, because I think you have to keep the macro backdrop in mind. For about 5-6 quarters now, the macroeconomic consensus has been of the strong, I would say, almost unanimous view that growth was going to fall off a cliff. That obviously hasn't happened. And so that's the reason for why we got the rally. But the cloud of, are we still going to go into a recession, I would say remains as thick and loud as ever. And so I think what yesterday does is it definitely reduces the probabilities that that downside scenario materializes. And so we should, basically look for, first, maybe some upgrades to the macro consensus, maybe some taking off of the downside. And I would not really underestimate the power of that consensus, how strong it's been, for how long it's been. I would argue it's permeated through everything. Investor perceptions, I would say growth's been pretty good, but perceptions have been very, very poor. Yeah. I would say companies are, concerned about getting in front of this huge, unanimous, strong view, and so guidance is poor. I think so. This, does, lift some of those clouds. I think it would be a gradual process, and
it was interesting to note your tone of caution a little bit about maybe the snapback has gotten a little extended. I did check the CNN, the Fear and Greed Index, yes. One of my favorites, and we're at 71, so we're almost in extreme greed territory, but rarely, I mean, this is now widespread euphoria. You could wait for some course correction, but I do think it's important to just pause and say this year so far has played out contrary to how almost anyone had predicted. Are you bottoms up or top down? How did you get to that 4,500 number a year ago?
We are top down, and what I would say is the very early part of the rally was really, a call for a positioning squeeze. And the positioning squeeze was really not about investors who were focused on the fundamentals of the market. It was really a call for a positioning squeeze on systematic strategies, because vol was very, very elevated last year. That was courtesy of, same people that gave us the vol yesterday. Right. It's really the very volatile Fed hiking cycle that we had. And so, very simple take would be if you looked at systematic strategies, on a Z-score plus -1, they were at -2, and it was all really coming from elevated vol. So the call was really that rates vol would come down, because unless they, so to maintain vol, you need to sort of keep providing more and more shocks to the system. So we're going to do 25, maybe maybe we're going to do 50, 75. At some point, you run out of runway, and at some point, you've already raised rates quite a lot. And that's exactly what happened. But I would say after that comes really, so the first part was the squeeze, as we had, taking stock of the year that just went by. I would say then it's really about the fundamentals taking over. And I would say, yes, we have this recession narrative on the macro. Yes, it has not played out yet. But if you look basically at earnings peaked in the second quarter of last year, fell in the third and the fourth. But that was very, very clear bottom. And earnings are up basically pretty strongly this year, I would say. In the first 9 months, we've got 11.5% earnings growth. That's pretty good in 9 months.
Let me ask you a business cycle question.
Sure.
And, I'm very sympathetic to the arguments for the slowdown, so I know them very well. And you do look at the leading indicators and things like that, and we are at historic levels. I mean, the index of leading indicators is down for how many months in a row?
Sure.
Continuing jobless claims are up year on year. The unemployment rate, we almost hit that 0.5% mark. There's signs that it can't get much better than this. In other words, that the business cycle is peaking. And I'm just curious how long, I know this might not exactly be the way you evaluate the market, but how long can we stay in a place like this as we start to talk about how much further the rally can extend next year?
So if you would allow me, I would just change the question around a little bit and ask, a rhetorical question. I mean, are we in 94, 95, or are we in 99? I would say there's many more parallels with 94, 95. So it is very possible for the cycle to go a very long ways from here.
The interesting thing about that cycle and the soft landing that we got back then is we never saw a real tightening of for instance, in the senior loan officer survey, those kinds of things. That never happened, and that's happening now. So it feels like those kinds of things point you towards a different outcome.
I'd say it is and it isn't, because if you look at the senior loan officer survey for the last quarter, it actually eased a little bit. And if you look back basically at the sluice, generally tends to peak in a recession, has very, very few false turns. So the question is whether you want to believe the turn down. And in the 2001 recession, we went down, then we tightened again a little bit, but it did mark the turning point in the end.
Interesting.
So I'm saying it may not be straight down, but it has improved, number one. Number two, what I would say is that I actually don't pay, I pay attention to the sluice because everybody else pays attention to the sluice, but, do simple exercise and just overlay the sluice of the ISM. It's not hard to do. And you'll see that, the sluice is, why it got a little better is because the ISM's picked up a little bit. They're pretty strongly positively correlated. And so, if growth does pick up from here, and this goes back to my very first point, if, the Fed is not going to be hiking aggressively, it does reduce and maybe even easing, I'm a little cautious there because we are talking about 6 months from now.
Sure.
And we just had two rather large changes, one in 2 weeks and one in 3 months. So it would be a little hesitant to discuss 6 months out. We can talk about it, of course, but...
One quick final question. There's like 10 more things I'd love to ask you, but I'll stick with this one. So this was the year that the Magnificent Seven got their name, literally. Do you make a call so specific as to say whether that market leadership can continue, or do you talk about kind of different leadership areas? I'm curious what you would make of people who are trying to get a little bit more tactical.
Yeah, so I would say two things. Obviously, a lot of people point to the Magnificent Seven and say the rally's been, very thin and narrow. I think it's very important to keep in mind that basically, whenever you have a change, it's very important to evaluate where you're coming from and was that, if we were in a happy equilibrium and all was well with the world, and then only 7 stocks rally, then I would worry about it. But if you look at last year, that's where the sell-off was. So why would one expect everybody else to rally when they didn't really fall that much? So that's the first point. The second point I would make is that we are, so we caught the big move up in January. We then, moved into sort of the fundamental turnaround in their earnings, which was taking place. By June, we went neutral mega cap growth in tech because while we're very, very constructive on their earnings and their fundamentals, on a relative basis, we think there's just too much priced in, basically.
And that's where you still are now.
Exactly. And so we're really looking for the rally to broaden. I wouldn't be short them because they do grow their earnings a lot faster than everybody else does, but we are looking for the rally to broaden. So I would look elsewhere for now, but in neutral on mega cap growth in tech.
Fascinating. 5,100 base case, 5,500 in the bullish case. And real quickly, what gets us to the bullish case? What would be the...
It's just it's the macro consensus giving up on the recession, basically, and a better macro growth outlook. The bullish case is actually if we have 2.5% GDP growth in the U.S., we've had more than that for the last 5 quarters. So I would argue it's a very reasonable alternative to consider.
Incredible turn of events. One of the few people who kind of had the right positioning coming into it. Binky, thanks for joining us today.
Pleasure.
Good to check in with you. Binky Chadha from Deutsche Bank. Well, let's go from the glass half full view to the more pessimistic take on the economy. We did get strong data this morning. Retail sales unexpectedly rose in November. New jobless claims were down by 19,000. But Double Line's Jeff Gundlach did warn the good news won't keep up forever. Here's what he said on CNBC yesterday.
We've broken down below the trend line on the 10-year Treasury yield that goes back a couple of years, and there's a lot of room below it. I would guess that we will see the 10-year Treasury yield in the low 3s sometime next year, and that would be consistent, in my view, only with the Fed cutting more like, I don't know, 200 basis points or even more next year. So I think we're looking for a recession next year. We've been talking about this. The market seems to be picking up on that.
Well, on that note, let's pick up with David Rosenberg. He's the founder and president at Rosenberg Research, joining us on the phone line today. David, it's good to see you. I don't know if you caught our discussion just now with Binky Chadha, but he makes a pretty compelling case for why we're going to dodge the downturn this time around, at least for the time being.
Well, Kelly, thanks for having me on. I don't know why anybody would think that we've necessarily dodged the downturn. The last thing I would do is extrapolate 2023 into 2024. And there's people like him that were extrapolating 2007 into 2008 and got their heads sliced off, or extrapolating 2000 and 2001, getting their head sliced off, extrapolating 1989 into 1990, getting their head sliced off. We've been on a soft landing for at least a year, but the soft landing is just that transition phase of the business cycle, that the bridge from the expansion phase to the contraction phase, which will be next year's story. And I believe that is why all the Fed talked about at the 2-day meeting. And the only thing they talked about was how far and how fast will we be cutting rates in the next 2 years. The stock market is only looking at, wow, rates are going to come down, without thinking about why is it that rates are going to be coming down. And what struck me in the Fed's dot plots on the economy is that they're calling for 3.8% nominal GDP growth next year. 3.8 nominal. I actually think it's going to be closer to 2 to 3%, but that's their forecast. And so the stock market's priced for double-digit earnings growth next year. And that's not going to happen if the Fed's right on nominal GDP. So they both can't be right. So I think that you have to ask yourself, why is the Fed at least verbally pivoting so dramatically? They're seeing something right now that I think a lot of folks in the marketplace aren't seeing.
Or maybe they're seeing what we're all seeing, which is receding inflation. And that's the best, thing to react to, because you don't have to worry about the worsening data. You can just react to that breathing room, right? I mean, Dave, what would you say, quick last question here, is the lesson, the takeaway from 2023, a year in which it looked like we were going to tip into recession at any moment, and we continued to be surprised by the fact that it didn't show up?
Right. And what I'm trying to say is that 2023, when you were asking your previous guest, what does this look like? 2023 looks like 2007. So all it was the bridge. I think the people that were pounding the fist on the table, the recession starting this year, were just too early. But let me just say this, because I know you asked about retail sales. There'll be revisions of that number, as we saw what happened in October, and it's a very small sample size in the first go-round. Here's what we know, Kelly. We know that the Fed is listening more right now to their business contacts around the country than they are to the spurious and off-revised economic data that's coming out of the BLS and other government sources. And when you go to the Beige Book that came out November 29th, what did they say?
Right.
They said that 2/3 of the country is either stagnating or contracting right now. So for all we know, the recession is already starting. It's not in the data, but it's in the anecdotal information that business contacts, not government statisticians, are telling the Fed right now.
Well, I
so
agree.
when we do this interview, I say 2-3 months from now, I get a sense that the conversation is going to be a little bit different than we're having today.
All right, I'm putting it down for Feb 14th, Valentine's Day. We will check back in as a status update. Dave,
it's the economy, Cupid.
Thank you very, very much for joining us. We really appreciate it. David Rosenberg. Coming up, the drop in the 10-year yields are pushing mortgage rates towards their lowest level since mid-May. We're down a full point from that multi-year high of 8.03%. The president of the National Association of Realtors weighs in on that and will join us in her first interview since a federal jury found the NAR liable for artificially inflating home sales commissions. And as we head to break, here's a look at markets. Dow hanging on to an 87-point gain after yesterday's surge. The S&P's up 6 to 4713. The NASDAQ has turned negative. We didn't get to talk to Bob Bassani about it due to technical issues, but let's see what UBS floor director and Wall Street veteran Art Cashin expects from markets next year.
It's an election year, and that tends to be good for the market as people are making projections and promises and programs, and even the upward bias on an election year when a sitting president is running for re-election, that compounds it even more. The best of all those historical patterns is when an incumbent president is deciding to go for re-election, and he needs a decent economy to back him up.
This is The Exchange on CNBC.
Hey, what's up? I'm in the office for the moment here. Just wanted to show you guys this. Coming into that half-hour trigger on the 30-minute chart. Just be aware that I'm always looking at the velocity in the 30-minute time frame. Be easy on this half-hour trigger going negative, and then maybe a break through this hourly trigger as well. Man, I'm losing my voice. Woo! Hang tighter. I got to close the. Just be aware. Well, there's a couple things here. We've got some unclenching coming up into Friday. We got some stuff coming up. So be careful on this. Let's see here. Take a peek down here. Let me mute this CNBC here. keep your eye on this this hourly trigger down here, and then also trend. Okay, so if you're just watching trend over here, this big blue line right here, this big buy line. Something right down there. Change that. 1 second here, guys. All right. So, excuse me. Sorry, I'm losing my voice here. I've been in a meeting all morning and just like talking nonstop. And I've got puts on for today and tomorrow, but I don't know, man. I don't know if those things are gonna print. Hold on 1 second here. That right there. This is that trend, this yellow line that you see here in the 1 minute chart is that 30-minute trend coming all the way up. What you don't want to see happen here is, or if you're a bear, what you want to do is this. You want to be, if you're short here, right? You want to be tactful here, right? Take that trade all the way down to the hourly trigger. Exit the trade. Even if we break through briefly, you don't want to get caught in a squeeze higher, right? Even if we're going to break down below, you want to take the second part of this trade. It's like you got one trade right here, right, is the point. And then you've got another trade below the hourly trigger on a rejection to blast through and go even lower, okay? So just be aware of, you've got like a two-part trade here. You've got the first side down, right, wherever that lands or blasts through. And then you've got the second part of the trade here. So it'd be where you get your first leg down here, then you get one more leg down here, and down. Let me see if I can find the second or S1 down here. 6610. That's right there. And there's your downside target right there. Let me see if I can show you this on the full screen so you can see. Here's your first one right here. Here's your second one right here. So just keep an eye on that right there as it's some downside targets. All right. Back at it, baby. Dude, where's the chat box? Why isn't the chat box showing? Let's see this. It's back up again. You guys can't hear me? Check 1, 2. You guys can't hear me out there? Why are puts so expensive? I'll tell you this. Yesterday I was buying puts at, oh boy, I was buying some like cheap puts here. Hold on. Like somewhere in here I was buying puts for Wednesday or for today and for tomorrow. And then I bought more up in here into the close. I lost almost no value, like none. They were expensive, but I didn't lose any value. I mean, at one point on this, when I was buying puts here, I lost 25% of the value of my puts that were only dated 1 to 2 days out. That shouldn't be the case. I should have been down like 75% or something. So they were just loading up puts as we headed up in here for the rest of the week. Now, some of you out there are going to think that this unclenching into the end of the week could be a pretty big downside move. I would limit your expectations on whatever that downside move is. Anyone expecting like some retrace down to 440 or something like that, highly improbable. Highly improbable. There's gamma in the market that should prevent it. So just be aware of that. We can break down here. We can slam down on the hourly trigger, right? Have a quick bloodbath down and then a V-shaped recovery. If you are a bear, pay attention to what I just drew right here, right? So even if you have this bloodbath down here, whether this is today or tomorrow, right? Even if this is today, just be aware of something here that you really do need price to break down below this hourly trigger. And in cash markets, if you're trading options only, if you're trading futures, you'd be fine. But in cash markets specifically, you want to see price breakdown, right? Let's say you get this breakdown over here, right? You come back down here, you bloodbath. If you get the rejection here underneath the hourly trigger, I would be very wary of like carrying that bearish thesis into a close if you're a cash market trader. If you're a futures trader, you should be fine because you can get out from the trade. But if you're a cash market trader, be careful because they could slip it right back up and ram it up your ass tomorrow, is my point. Now, in cash market, you get underneath here, right? Let's say you get down, blast down to the hourly. And then you have this bloodbath, right? You swing back up here. If you start to see a rejection underneath, heck yeah, you can put a short on or you can buy some puts and have your stops above if you want to start taking it downtown. If you want to know where downtown is, I'm going to show you that right now. We've got S1 here, and then I'm going to give you S2. 1 second here. I got to take this off auto. We got S2 down here at 461.87. Here's S3 down here. That erases the entire move going back to December 11th. Now, for this next leg down, I'm going to tell you, be honest with you here. Like, you need to get underneath this stuff, right? And then you need to break this previous low here, set up a short or some puts to blast down, okay? Like, you can take it here if you want, but if you get trapped and we start swinging high, you're going to get in trouble. So this initial bloodbath down, you break down here, you wait for that previous high to jump in short for that next leg down to S2. Remember that yellow line is the trend right here. Let me look at one more thing for you here. One more second, guys. What am I looking for here? Yeah, I'm going to read some stuff to you. Powell triggered an epic market melt up today, which triggered a massive. Sorry for my nose too. Which triggered a massive short squeeze. Short basket up 6.6% and propelled the gamma imbalance to a new record high. On the other hand, realized the vol continues to be in free fall mode. due to said gamma imbalance, which is a vol suppressor and forces vol control strategies back into the market. We model that this community has increased its exposure by 50 billion since mid-November. Could add another 10 billion until OPEX leads to a gamma unclenching that could potentially increase vol again. We estimate that all else equal, a record gamma amount of 718 million will expire on Friday. See below, which will pump some volatility back into the markets. Yep. This will likely be our last. Yeah. Okay, so I guess this is maybe in some expectation into Friday, I guess. You know, what I'm reading here for some volatility, some true volatility to come inside the market. Let me find out where the gamma flip is here. Give me a second. Gamma flip is 45.90. So yeah, right in here. So your gamma flip is right below here. So right where that hourly trigger is. Shocker, right? So your gamma flip is roughly right here. So this is going to be like a pivotal, pivotal place down here. If we can get underneath this, if you're a bear, that's really where you want to be. Otherwise, dealers are still kind of weakens as we end of Friday, but kind of forced into buying these dips here. So just be aware of that down here. I think that's the basic gist. Put that right there for you. Remember too, so if you're a seller here, right, and you do see, rejection up here, check the 5-minute, come back down here, and we blast through this, don't get all excited and be like, yeah, we're doom and gloom. You need to get the rejection. You get what I'm saying? You need to see this, or even see a squeeze higher to the half hour, and then it rejects straight down. You need to be watching the demand from buyers here and the aggressiveness of sellers underneath this gamma flip zone right here. Now, if you get underneath this stuff here, right, we will trade 4650, and most definitely 4600 could be back on board again as true support. That is the largest gamma that we have. Here you go. All right, I got to go. I'll be right back with you guys.
Welcome back to The Exchange. I'm Contessa Brewer with your news update. The European Union decided today to open negotiations for Ukraine as well as Moldova to join the EU. Ukrainian President Volodymyr Zelensky called the decision a victory for Ukraine and for all of Europe. A 13-year-old boy in Ohio has been arrested and accused of planning a mass shooting at a synagogue in the city of Canton. He's been charged with inducing panic and disorderly conduct. Prosecutors say he made a detailed plan and then shared it on the online platform Discord in September. It was before the Israel-Hamas war began. Representatives for the teenager have not yet responded to an NBC News request for comment. And a set of 6 jerseys worn by Lionel Messi in last year's World Cup victory just sold at auction for $7.8 million. According to Sotheby's, it's the most valuable sports memorabilia sold at auction this year. Lionel Messi raking it in. Kelly.
Huge. All right, Contessa, thank you. Contessa Brewer. Coming up, a real rally or just a short squeeze? My next guest argues we may have to wait and see, but there are some warning signs beneath the surface of this rapid rise. We will tell you what they are when we come back. Dow's off the highs, by the way, up 57.
Also, I want to draw your attention to the SPX chart that's at the bottom of your screen. Hold on here. I want to draw your attention to the SPX chart at the bottom of your screen. Just keep your eyes on this gamma bar as we approach it on SPX. Could be a nice place right down here to close some puts.
The 57 S&P stocks with the highest short interest, 41% are up 10% or more this month. Our next guest warns the correlation between short interest and equity returns has been running at a high. And after a record Dow close yesterday, he expects that correlation has only gotten more extreme, which may be a warning sign for markets. Joining me now is Tavis McCourt, Raymond James institutional equity strategist. Tavis, it's good to see you. So just kind of run us through the historical record here and how much this episode sticks out to you.
Yeah, so this year is most notable. There's been 3 significant periods where equity returns have been highly correlated to high levels of short interest, and one of those was late January, which was followed by a pullback in equities for the next 2 months. Another one was May and June on really the AI-related rally. We hung in there for about a month, and then equities kind of started to weaken again. And the third one really has been November and early December. So there's a lot of reasons for the rally, but on top of that, we've had a lot of short covering. And it doesn't mean that we're going to roll over completely, but it does mean some of the fuel for the rally has probably neared its end.
Does it make you more bearish right now?
Cautious, I would say. I think at some point that the inflation story is effectively over, but at some point you're gonna need better economic data to keep the rally going at these multiples. When we've had 2 to 3 turns of multiple expansion just in the last 6 weeks, which is really just a substantial amount. You've now got mid caps that had been trading 20 to 30% below historical norms are now only 5% below historical norms. Small caps that were 35, 40% below historical norms are now only about 20% below historical norms. and large caps outside the big seven, which were trading kind of 5 to 10% below historical norms, are now 5 or 10% above. So at some point, you've got to have some better earnings to keep the fire going. So I think we're okay, but you know, the kind of rally from just a realization that the inflation risk is likely behind us. I think that part of this is coming to an end.
I like how you say we're a long way from sticking this landing, because a lot of people think we're sticking it right now. I want to just ask you what you said there in passing about valuations. Is that also what's been driving this rally, that valuations are up a couple of points?
Yeah, for sure. I mean, you can think of, you know, at least I think of every equity index is basically pricing in a percentage chance of a soft landing versus a recession. And right now, the percentage chance of soft landing is just skyrocketing in the eyes of the market. But and so that's leading to equity values going up. But if you look historically, most of the times after a rate cycle, we don't get a soft landing. Most of the times after a rate cycle, it takes actually an average of 15 months after the last rate hike to start seeing labor market weakness. Like we're only 5 months after the last rate hike. So, you know, it looked like a soft landing in 06 too. It looked like a soft landing in 1989 too. You just don't know for sure. It's going to be a full year or so before we know for sure if this soft landing really is stuck.
All right, takes some courage to issue the warning in a week like this. Tavis, thanks for joining us. We appreciate it. Yeah. And we'll find out, as you say, in a couple more weeks if this short squeeze runs out of steam. Coming up, rent inflation in November jumped about 7% from last year, but one very expensive area of the market is seeing costs come down. Why Manhattan rentals could be at a turning point. Next on The Exchange. Welcome back to the Exchange. It's not just mortgage rates falling. Manhattan rents are dropping for the first time in 2 years. Robert Frank is here with a look at why we could be at a turning point in that key market. Robert?
Well, Kelly, median rents in Manhattan declining by 2% in November. That may not sound like much, but it is the first time in 27 months that rents actually fell in the nation's largest rental market. Median rents now at $4,000 a month. Average rents are still above $5,000 a month, and apartments are still 11% more expensive than they were pre-pandemic. But rising supply, falling employment in New York's financial and tech industries, and basic affordability issues are finally bringing prices down. Brokers say landlords don't want to officially cut list prices, so many are quietly offering a lot of concessions like a month of free rent or even free parking. Better deals are leading to more rentals. The total number of leases signed in November increased by 10%. Rising supply suggests prices could fall further in 2024.
Oh, baby, I'm making some money. Hey, just keep your eyes, just heads up here, keep your eyes on the, on that gamma down here, right? We're coming into this bar here of gamma, so there should be a bounce as we come in here. Just be very careful here. Watch, we're probing it right now. Do you see it? That's that 4,700 gamma bar right here. That's that base camp we were talking about. So you could see a bounce here, and then if you want to break through it, like you squeeze through, blast into 4,700, tip your wick, and then we come back down for some more. Hold on, sorry about that. I gotta get out of a trade here. Hanging dong right now, baby. S&P 500. How do you like them fucking apples, boys and girls? Sitting right here with you exactly when it's happening, baby. Touch it! Close them out. Dude, how the fuck would you not want to have this shit? And look above, there's a little bit of rejection right above here on Bookmap. How could you not want to be trading with this thing every fucking day? Look at that. They're right up here. Whoop, right up here is where they are. Here are your sellers right here. These are your young gym bros. They're sitting right here. Your old gym bros are up here. Look at that fucking tick strike right there. Look at that sexiness right there. What up out there? What are you all doing out there? What up? Look at that gorgeous pinstripe. Look at that perfect staircasing right there. Just look at that beauty right there. Bear cross right there. Bam, slap down to the half-hour trigger, trade over to the left, right. Huge amplified 2-trigger cluster cross right here. Wham to the downside. Now you've got the 1 and 5-minute crossing down right here. Let's see if we can blast up and get right through that gamma flip to the downside. We got this launching for you on Friday, baby. Also note here that this is the place where the bulls have been buying the dip for weeks. You know what? I'm gonna I should make a page with just like bull music, bear music, and then like the waiting room music for all the tech bro companies when they're doing like their product launches, the stuff, whatever that shit that is. Oh yeah, a Spotify playlist. Come on, Bears. See that cluster up here, right? You got the 1, the 5 minute, and the half an hour. This could easily get price down below that pivot, even if it's for just a moment down there. So watch for this trade right here. The Bears with a little bit of life in the market right now.
Is on pace for a sixth positive day in a row. And I guess we have to wonder, is the optimism going to continue into the new year and what it could mean for the Fed going forward? Jason Pride, Chief Investment Officer of Private Clients at Glen Mead, and Bill Lee is the Chief Economist at the Milken Institute. Let me start off with Bill. Bill, thanks for joining us this morning. What do you think about the Fed? Was it the pivot that we all think it was? And was it too soon and too much?
Well, Steve, as you know, this was quite a pivot and surprised a lot of us who were thinking that the Fed was going to be focusing still on inflation. And I think the message from Chair Powell is that he's pretty convinced that inflation is on a downward path. It's not quite there yet, but there's enough there that they can now shift from an inflation bias to a more balanced dual objective of bias and worry about the real economy. And I think one reason for that is because the Fed is always laser focused on what's happening to the real interest rate. And real interest rates have really gotten quite high. If you look at the 5-year maturity, which is where most loans and business borrowing is occurring, it's well over 2%. And as you know, in normal times, that real interest rate for that maturity is somewhere between 3/4 and maybe 1% and 1.5%. So I think we're well above that. And the Fed, I think, is very concerned that they may be maintaining too long a downward spin on the economy. And Chair Powell said as much. He said, we're now putting rate cuts on the table. And by announcing it, look what's happened to the 10-year rate. It's dropped dramatically. And that's exactly what he's hoping to do. Let the market do the work of lowering that real rate back to more normalized levels. And then he can wait for when he can actually move the policy rate.
Jason, what's the probability or the concern that you may have that the market's gone too far with this? Powell did not promise a rose garden or a rate cut in March, but the market seems to be acting that way. If you look at the probabilities, it's up darn near 80% or 90% for a rate cut in March, but he didn't say March.
Yeah, look, I have to admit, I feel a little bit like the Grinch sitting outside of Whoville right now. I tend to agree with what Bill said in that, the Fed knows they've taken rates really high to a point where it's damaging to the economy and they need to pull it back in. But there's just such a distance to come in at this point in time. And I suspect they're going to be looking over their shoulders all along the way saying, wait a second, if we take it too far here in terms of cuts, do we make another Arthur Burns-like moment? So that's going to be sitting in the back of their head. And our suspicion is that there's just a lot of pressure on the economy from higher rates and from tighter monetary policy conditions that still have yet to find their way all the way in. And they just can't unwind it fast enough, truthfully, in order to get to where they want to get. They're trying to thread a needle here. And this is difficult. And the markets are basically saying, it's done. We're good. We're going to move on from here. That doesn't seem about right.
And Jason, there's something in what you're saying that I've been pondering. I feel like this is a very Steve Leisman kind of thing to ponder, but we've seen rates fall substantially. Yes, that's supporting equities, all of this kind of hopium into next year. But to have a 10-year still, call it 4%, you call it 3.5% if you want, is that still a cost of capital that you think companies will be comfortable with or choke on?
Look, they're going to feel a lot more comfortable about 4 than they are about 5. But by our estimation, look, we started basically near zero. At one point in time, we were at 0.5% on the 10-year. We're now adjusting to an environment of 3.5% plus. We think kind of fair value on short term is somewhere in the 3.5 range. Fair value on longer term, like 10 years, is somewhere around 4. This is a big difference, and the economy hasn't really made a way to filter it through. We're still sitting on a lot of debt at lower rates that's going to be rolling off over the next couple of years and need to be refinanced.
I worry a little bit, Kelly, that the market's acting like money's free again. It's not free again, and it's not going to be free again. But, Bill, I guess there was a lot of pent-up demand, or that the idea that the Fed could hike again, which now looks to be off the table, was something that held back investment in the equity market. There were a lot of people, Bill, who were pretty happy for a few minutes there that were clipping Treasury coupons and collecting 4 or 5% in money market funds. Maybe they're not so happy today. What do you think they ought to be doing? Are they still investing in Treasuries? I mean, I guess as a risk asset, if you were trying to make quick money, it was a good thing. But maybe for the long term, it's a different story.
Well, as you see what's happening in the market today, there's a lot of portfolio readjustment, right? And people are saying, wow, I got to do something with my money rather than sitting back and clipping coupons. And I think that was fed a lot of that market rally. But now you see the market itself is rotating. It's rotating from one sector to another. All that magnificent 7 surge that we had has now been brought into other cyclical companies. And I think that is something the Fed really is less concerned with. As you know, the Fed is really concerned with what's happening to the big picture. And the big picture right now is that the companies that we were just talking about who are worried about financing, are they going to choke on this high cost of capital? Well, if the expected inflation rate is still slightly above 2%, and the pricing in the bond market shows that it's around 2 and 2.25%, then at 3.5 to 4% long-term interest rates, that's a good number for them to do financing with. One of the things the place that we will choke on these high rates would be the government, because the government has to pay a very high interest tab. And that is where the burden's going to be, and crowding out is going to occur. Government's going to suck in money that really should be going to the private sector.
Jason, I think most days are not days to make any changes in your portfolio. I think very few news things come along that really matter that much. I think yesterday might have been one of those days. And I'm just wondering how you're thinking about portfolios differently today. My take was that Powell did what I thought he was going to do in January. He did it yesterday. So I thought there was time. That time has gone away. And I'm wondering if you think there are things and adjustments people ought to be making because of those events yesterday.
Look, I tend to agree with you. We quite often try to keep our bat on the shoulder in terms of portfolios.
Right.
Quite often, that it doesn't make sense to make big shifts. But then sometimes the markets present you with opportunities to do a little bit more. And this is one of those where it just feels like the market's gotten a little bit ahead of itself. And even if you're looking at your portfolio back in time here, if you're positioned well about, say, 3 months ago and you looked at your portfolio today, the likelihood is it is not positioned the way you want it to be today because of the magnitude of movement. So that provides opportunity to bring it back in line. And that, from our perspective, is getting a little bit more conservative in portfolios in recognition that the market seems to be just a hair ahead of itself at the minimum.
Quick question. I don't know, does your strategy, Jason, involve bonds, but what do you do after this move?
Look, bonds, 5%, I think bonds were a fairly good deal at that point in time. We were actually saying that unlike the equity market that was overvalued, bonds were actually undervalued. At 4%, we think they're actually reasonably fairly valued. We've been pushing out a little bit on the yield curve. We've kind of paused that a little bit and are sitting with a pretty neutral duration exposure right now because we think bonds properly reflect the expectations for interest rates that are sitting out there. Now, when those expectations change, that math will change. But for right now, they're basically in line with fair value.
Bill, real quick, we have to go. When does the Fed cut and by how much next year?
If the market continues to lower long-term rates, the Fed can delay, and I'm guessing they delay until somewhere around mid-year when they can actually do a large cut and be done with it before the elections.
And how much next year?
I'm guessing they have to lower rates by about a percentage point.
Wow. Thanks, guys. Jason, Bride, and Bill Lee.
That's how you get just the trading sessions we've had the last couple
Right.
of days. The 10-year yield below 4%, below 390 earlier for the first time since August. Rick Santelli in Chicago with more. Tell us, what's the buzz, Rick? What does everyone make of this?
You know, I think the buzz is that the Fed being done is where the party began, and then the Fed pushing yesterday the notion that maybe they're not done, but by the end of the press conference, it certainly seemed as though all of my sources had a major change of heart, and we're definitely in that FOMO camp. It's all about FOMO. So if you look at a two-day chart of 2s and 10s, you could see that right as the meeting was being announced, the statement was being announced at 2 Eastern, what we saw was a drop of significantly larger proportions on the short maturity to 2-year versus the 10-year. So you dropped about 30 basis points on a 2, you dropped about 23 basis points on a 10. Why is that important? Because if the short maturities are leading the way, the last guest said he believes that the 10-year yield should be closer to 4 or 4.25%. That would make sense if you interpolate where the 2-year is going to go with a Fed that's going to ease nearly 100 basis points.
Have
if
a cross
that
coming
actually
up
happens.
right now, the
You look
5-minute
at
over
2s
the
and
half
10s
hour
on an
trigger.
annualized
Let's see
basis.
if
I
we get
always
a
use the
reversal. We can
30th
get
of
a-
December.
we can get
Right
a
now,
little bit of this
2s
action
are
here.
under that 443 close. 10 years
Kinda like
are
the
just
last
a bit
chance here
over
for
it. They
bears
closed
right
at
up here, so keep
388.
your eyes
And the
on this
dollar
one right here.
index, it closed at 103.52 on the 30th
Bears
of
need
December,
to
which
hold
means
this right
on
here.
the year it's down a smidge less than 2%. But get this, on the week thus far, it's down over 2%. So what's going on? There's a lot of FOMO, and a lot of things have to work out picture perfect with regard to the Fed. But doves rule, so maybe the FOMO is on the right course. Steve?
Rick, I want to follow up on this because you and I talk to different people. I talk more to the managers and you talk to the traders, and we can debate and duke it out who's smarter. I have a lot of respect, obviously, for the guys you talk to. Everybody I talk to over the course of this year has been short duration relative to the index. And that's part of the whole FOMO thing. And I think even today, they're short duration relative to the index, which if you want to translate that into English, it means they didn't own enough 10-year, 20-year, and 30-year paper. Is that still the case, Rick? And does it create potentially more gains to come on the long end of the curve?
You know, I think you're right on it. I think an easier way to look at it is the yield curve 2s to 10s.
Right.
And many, of course, were looking at selling the 2s and buying the 10s. That trade is reversing, and I think a good chunk of the phenomenally quick drop from a one touch of 5% to under 4% was.
Just watch out here. You will see this right here. So you want to look at this. You always want to be looking behind you, right? This pivot. And if we get this new high right here, it's pretty bullish. So you'll likely see a squeeze even higher at this point. And we'll try to take out this previous high right here. You're likely going to see a squeeze right up here. You got like one more tick here, and then you'll see an explosive move to the upside. It's kind of it for bears here. This is the place right here. Move this over so you can see it. Big battle going on here between buyers and sellers.
Up closer to the revised census data because it's not estimated data, but it's a good start for retail data that we're really proud to be offering.
Not
viewers.
least because I don't know if you caught Dave Rosenberg last hour when he was talking about some of his steadfast bearishness, said he doesn't even believe the government data half the time. So here's another data point that can at least tell us what's going on with the economy.
It's going to flatter the fourth quarter GDP reports.
Important to note.
Yep.
And by the way, tomorrow morning, Squawk Box, 8:30 a.m., you and?
John Williams, New York Fed president. Now, just to be clear, this was planned 6 months in advance. They are not rolling out John Williams as some kind of emergency redirect on yesterday. And the crazy, we plan these things. We have done it for many years. John sits down with us at the end of the year.
It doesn't mean if he wants to seize the opportunity
to redirect or otherwise give us more information. You are correct.
Looking forward to that. Coming up, Wall Street's alt-right alternative. Nikki Haley earning support as a pro-business alternative to Trump. What is her economic policy? Plus, a real estate power player will speak to Don Peebles about the state of commercial and residential real estate. Power Lunch is back in 2.
You're looking to take a short here, jump back in short. I'm going to break this right here. Reversal right there, and then take it right in there. If not, this is going to reverse to the upside. Bulls will be stepping right back in to buy a dip again. Sorry about that.
Welcome back. Wall Street always wants what's best for Wall Street. It goes for everything, especially the presidential election. Some would say, gridlock is good. Others say, could Nikki Haley be what's best for investors? Eamon Javers is here to explore that option. Eamon?
Hey there, Kelly. Well, Wall Street is in the middle of a major swoon now for Nikki Haley, and it's really easy to understand why that is. As a GOP presidential candidate, the former South Carolina governor offers a mix of traditional Republican tax and spending policies that Wall Street traditionally loves. Haley rolled out her economic plan back in September, pledging to eliminate the federal gas tax and to offer permanent small business tax relief. She would eliminate the state and local tax deduction, which could cause some angst, though, to her supporters in the Northeast, where taxpayers benefit the most from that provision. She also says she would cut income tax rates. Nikki Haley criticizes both Joe Biden and Donald Trump for running up the federal deficit and says she would link federal spending to a percentage of the overall U.S. economy. She would also eliminate Biden's green energy subsidies and says she would withhold Congress's pay if it fails to pass the budget, although it's a little hard to see how she would get Congress itself to go along with that one. Haley also says she would cut regulations by requiring congressional approval for any federal rule with an economic impact of $100 million or more. Now, Haley's critics say that although she denounces corporate welfare now on the campaign trail, as governor, she lavished subsidies and tax cuts on companies such as Boeing, Volvo, and BMW in an effort to bring them to South Carolina. And they say that simply offering more goodies to lure jobs away from, say, Georgia does nothing to move the needle on jobs nationwide and could cause workers pay cuts while placing a burden on taxpayers. Back over to you guys.
Eamon, tell us how Nikki Haley is stacking up against the polls, say, in head-on races with former President Trump and even against President Biden.
Well, look, what's interesting is she's actually polling better against Joe Biden than Donald Trump is, but everybody in this field is getting absolutely creamed on the Republican side by Donald Trump. Donald Trump is running away with this in these very early polls, and we should say these polls are very early. We are a while now before any meaningful contests actually happen, but all of these candidates, including Nikki Haley, have a lot of digging to do to get themselves out of the hole that they're in. But Republicans who are looking for electability in a candidate,
come on, Bears,
might look at Nikki Haley because
so I got a note this morning that
in most of the polls that I've seen.
I got a note this morning about, I don't know if I should read it to you guys on stream, but I got a note this morning about hedge funds getting blown to bits yesterday.
That's how it got down to the D.C. Bureau.
Go ahead, Steve.
Like straight up blown to bits. Any of you guys hearing about any of that? Is any of that leaked on Twitter at all or no?
About Nikki Haley.
I haven't been on Twitter at all today.
The extent to which this is a sort of either elite Wall Street, maybe elite Washington phenomenon. That
some margin calls going out and about in the professional world was the whispers that I heard. Yeah, I read the same stuff.
Yeah, look, I mean, if you look at the people on our air.
Yeah, you did read. Is anybody talking about it on Twitter or no?
You see people like Jamie Dimon, who's a Democrat, saying that Democrats on Wall Street should send her money. You know, you've seen
it is on Twitter. Okay, yeah, I did hear that. I got a letter this morning, early morning, that talked about it.
Real support among people who.
I'm gonna read some of this stuff to you. Here, I'll read some of it. You gonna read some of this to you, or let me see what I can find here. I don't even know if I should be reading this stuff. I don't think I should, so I'm not gonna read it.
And one of the big questions here is: are all of these candidates who are running against Donald Trump right now on the Republican side sort of?
What did I say? I was talking about. Let me mute this here. I got a letter this morning that some hedge funds got margin called. Some blew up yesterday, and there's talk of like pretty rough talk. Letter that I received this morning. Now I haven't been on Twitter, so I haven't read some of this stuff. I didn't want to repeat any of it either. You want to read some of it? Let me see if I can read any of this to you. Hold on. Let me see what I got here. Hang tight. I'll see what I can read to you. This is coming from a professional, so hold on. Yeah, hedge funds were forced to buy stocks. Dow Jones hits Volmageddon era. That's big news, right? See what else I got here. You should not be in calls right now. So, or you can be, if you're a great trader, you can, trade this to here. You can trade this to here, but you have to exit these trades, and you can get trapped inside of here going long. The best bull trade here is that you wait. What you're looking for as a bull here is you're looking for this structure. I'm going to show you the structure you're looking for to take along. Like the probability of you making money goes up if you wait. There's danger here. There's danger here. But if you wanted to be a smart bull, and I'm going to show you why right now, okay? I'm going to explain it to you right now why you want to wait, okay? We're going to talk about it. As a smart bull, okay? This right here is the, what does the goat call this right here? This is the diddling in the middle in here, okay? So what can happen here is you're super bullish. You buy this. You're like, fuck yeah, right? We're going up. You're all awesome. We're going up, right? We squeeze up here. We don't get a new high, right? And what ends up happening is you get bounced back down, and this becomes a grind zone into the close. And they just wreck you. Like all this, kiss all that shit goodbye. And they just take all your money and they grind you to dust in here. This is the, the finger, I call it the finger trap. You can call this diddle in the middle, any of this in here. So I never take, I'll take calls in here, but it's risky is my point. So you can be tactful if you want in here. My preference for the best payout here is to watch for this squeeze. I want to see a new high. So I want to see a new high from right here. Right, so we'll draw that in right now, okay? So what you're looking for here, if you're bullish, is just a tick higher. Like right there. You want to see like a whale. You want to see, like a whale. Woo, right? Comes up here and breaks back down. That high, excuse me, that high tick from back here is giving you notice that we're going higher later in time, okay? If there's a failure to get the high tick, it shows you that we're just squeezing and that the buyers aren't actually there. They're weak. So we'll bounce back down and we'll consolidate this. And you really can't take calls like an upside call unless you break above that high right there. So you're still waiting for that break above to then take the calls that actually print big money. So you get trapped in here, they burn all your shit. That's bad news. And then if they roll it back down on you, you're all fucked up again is my point. So statistically speaking, if you're a bull, you want to see that break above, come back in for that back check on the 1 minute trigger and the 5 minute coming down here, and you're looking to go long somewhere in there for a bigger upside move. And this usually prints big money. Some people will jump in above here too once the run starts, and this one's like a 98% of the time print for you. So just keep watching the structure here. Don't get trapped in here. Don't get trapped right here as a bull. If they roll this down, don't get trapped in the finger trap over here. Just be watching. Be patient. You've got time. So you're either looking for this one to breach. Hi, cat. Or you're looking for it to fail, okay? One or the other. Which one will tell you which direction we're going to take? All right, so I'm going to read some of this stuff to you. The Dow Jones now blew through the upper Bollinger Band, and now its RSI is at the highest level seen since right before Volmageddon in 2018. So just be aware of that, okay? So the Dow blew through its upper Bollinger Band, and now its RSI is at the exact level right before Volmageddon in 2018. Well, Bloomberg and GS were wondering if they were a remaining bear, if there were any remaining bears or capitulating buyers left to be found out there somewhere. Markets hunted them down swiftly. Modern markets have BPS, bear positioning systems. They will be found and hunted down. Leveraged hedge funds that are herded into big tech but short the stocks they perceive to soon end up with macroeconomic business leverage earnings trouble from here on out. We're being forced to purchase them to close in a massive squeeze, causing hedge fund carnage. It's hard to imagine margin calls on a day like yesterday, but apparently that was occurring. What else I got here? And the letter goes on to explain if we're going to go to the upside, pricing that in is insane. Like he goes in, he talks about he goes on to talk about how if this is what the perception of it is being, you're gonna see predictions of 5,000 for next year be way out of line with whether this is real or not, what the expectations would be. They'd be looking more like 6,000. Massive ramp, too. There's some time, if you look back in like 1996, times like that, it would just be a relentless upside bull run, you know, like just a whole new short-term debt cycle. No, we haven't proven that yet, but you know, that's the thesis being presented.
NYMEX diesel January futures settle at $2.59 a gallon. NYMEX natural gas January futures settle at $2.39. NYMEX gasoline January futures settle at $2.11 a gallon, and NYMEX WTI crude January futures settle at $71.58 a barrel. That's up $2.11 or 3.04%.
Do you want to stay up to date with the latest and be on the bleeding edge of news for non-farm payrolls? Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service for the price of 1 month and save 92%.
We got these new kittens, right? You know, they were abandoned or something in a wood pile up in my backyard. There were 5 of them. Got rid of
Welcome back to Power Lunch.
3 of them.
2023 has been a tough year for commercial
Got
real
2
estate
more.
in particular.
And one of them is a female blue Russian, something like that. This cat is like a teenager right now. She thinks that I'm her boyfriend, and I'm not her. I'm not a cat guy. Well, I guess I'm a cat guy when nobody's looking, but
joining us for more
goddamn cat thinks I'm a freaking boy cat or something. Like, get away from me.
CEO and chair of the People's Corp. Don, it's great to have you here, not least because your tone goes a bit against the tone of markets ever since the Fed meeting yesterday.
Yeah, I know, John. The horror, right? You know, John, I just saw what John H. just said.
Right now, what's happening
I always love when you guys look back and find out when this is. I'm not going to name names here because every time you say something, you piss somebody off. But
is a 60%
you know,
occupancy rate in
there are
office
some
space, and
famous,
that's on a Tuesday. That's the best yet.
well-known
on average, it's hovering around 50%.
short operations out there. You guys might know some of these short operations that are on, like FinTwit, right? And they'll say that they.
Not as bad yet. What's happened right now?
There's been leaks in the past. So what ends up happening is they sound really smart. The name of the company sounds smart. They claim they do an investigation, and you know they do a hit piece on company XYZ. It makes the rounds everywhere. It makes the rounds on CNBC, Wall Street Bets, Twitter, you name it. And of course, the stock suffers a hemorrhage. Right? They blast down with big red bars down to fucking depths of hell. And on the surface, everything looks great. Like, hey, they did all this research. Hey, they're very intelligent, smart, all this stuff. And then, of course, every once in a while, emails or texts will leak and float around. And you find out that these guys are just slamming the zero-date puts button. You know, that's their strategy right before they leak this information or data or whatever. You'd be surprised. My point here is that for a lot of the people out there that you and I look up to and say, wow, they sound really smart, if you ever see in the background what they're actually doing, it's literally like slam the fucking put button, like zero-date put or zero-date call or whatever, if they have that insider information. It's kind of gross and disgusting. You know, meanwhile, you think you're not as smart as them. They just happen to have more information than you do. Does that make sense? So it's kind of pathetic, right? And people say that hedge funds don't blow up; they blow up all the time, And if you find out historically the ones that do blow up, you'll be like, somebody that had all this respect for how they blew up is usually an insane insider story. Not looking good here for the bull or for the Bears, but also if you are a bull, do not get strapped into the closing bell today. It's 235. There's a high probability that even if we break up here, that you're just going to get trapped and pinned to a close. John Haggerty. That's what I was thinking, Binky. Grind it out. Now there's a high probability of more downside to come, or not probability. There's a window of weakness tomorrow. Now that could result in upside movement, but there's a small window tomorrow for some weakness. So this could be a chance to grab some liquidity for that downside move into tomorrow. If that does happen, you're looking to target 460 as a firm floor. 460 on Friday. If that does happen, you could see some so that Volmageddon stuff, right? You could see some funkiness into tomorrow. They run VIX up all across the board to provide some breathing room. Yeah, I don't like calling it the window of weakness, Uncle JBJ, because I know who uses that terminology, and I usually make fun of that terminology. The tough part about using that term, too, that window of weakness, does not mean it will happen, right? It's just that there's an ability. So it's kind of a shitty term, isn't it? Well, it's not a shitty term. I think two things. I think saying window of weakness means one thing, right? There's a window for this to happen, but I think a lot of people jump on it and say, hey, we're going to crash because of the window of weakness. Or they don't, they pin or associate a window of weakness with confirmed definite downside. Kind of, I don't, it's a good word. It's a good use of words, but it gets manipulated, right? There's a manipulation going on. Or a manipulation of that word. Yeah, so Dilabar said it has to happen exactly in that time frame. I agree with that one too, Dilabar. As a matter of fact, the dates for the past 3 or 4 weeks now have been front run, right? We're like front running everything by a day. Everybody knows, so it's like front run this a day in advance. Front run that a day before. It's like every roll down is like a day before. Every roll up is like a day before as well. So there's some FOMOing all across the board here. That's impacting the trading days. Hey, thanks, Donut Shopper. Appreciate that. I see you, John H. That's kind of it, though, for the Bears, man. Or not it, but for any more downside for today, this is the last opportunity for Bears. You'll be waiting for tomorrow, probably, or you need some Bond vigilante to come in here and just like order up, sell fucking $2 billion of SPY right now at this moment. Now, there's another issue here too. If funds are buying all of these stocks, right? One other heads up here in that note that I read to you a few minutes ago. If funds are forced into buying those, that underlying, they will dump them the first chance they get. So just be aware of that. No, you're not bugging me in IWM. I made a post on FinTwit 3-4 weeks ago. I laid out the entire IWM plan. The thesis here is in and around December 15th is your next opportunity in that post. About 3-4 weeks ago, I highlighted all of this, okay? Right around, I shouldn't say right, so not right around, basically on December 15th, in terms of trading days, you're supposed to be looking for a low on IWM, and you long it into March, not January. And that now, if you're longing into March, some of you'd probably want to be taking calls that are dated, let's say, for April, May, June, July, but closing them in March, or put spreads that are dated a week or two out into April for IWM. Now, there's a caveat to this statement here, okay, that needs to be addressed. You also have a couple things that I want you to be thinking about. I don't care what anybody says out there, okay? There is a tractor beam on the end of month for 45.15 on SPY, okay? That doesn't necessarily impact IWM and where you buy IWM, but just be aware of it. Now, I don't care if we're above the magnet at 45.15 or if we're trading below the magnet at 45.15, but the closer we get to the 31st, SPOOZ is going to want to go there. Another thing to note here, too, is because of what happened with Jerome Powell, IWM should outperform the greater market, okay, because of what happened yesterday, basically. IWM should outperform. Now, you will see outperformance by small and mid-cap tech stocks. You might even see big tech do well, but the key point or driver here is S&P 500 and the Qs should underperform IWM coming into March at least. Like, you'll still see good performance, but not even near what IWM should do. And IWM exposes you to those small cap, mid cap, small cap, risk on spec growth tickers that you're looking for. Now, you can find other indexes to trade this. But IWM seems it's got great liquidity. You're not, you've got, or you should have, IWM's got shitty liquidity, but they'll have better liquidity than some of the smaller indexes that are out there. And you might only be able to buy those indexes, not even trade options on them.
So in and around the 15th, okay, on the IWM trade for March. Am I saying that the MOAS on GME starts soon? That's a tough one. I'm watching GME for that. I'm on the fence on it right now because I know they will trade anything up as long as there isn't any fraud. And there's a bunch of companies in here that are open to an M&A into February that could drive that. January, February, you also have that. You get the January effect, and then you've got, if you guys don't know what, I'm going to tell you guys a couple things. I'm going to interject here and go off on a tangent. If you don't know what Volmageddon is, Google search that. Go down the rabbit hole. If you don't know what the January effect is, tax loss harvesting, start Googling all that stuff. I'm not going to go on a diatribe here today on it, but you need to know what that stuff is. You need to understand about cutting your losses for tax loss harvesting, a grand rotation that takes place, and then and also a bunch of tickers that have the potential to boom up into the end of the year. You can actually, you've seen that happening the past few weeks. A bunch of tickers have been talking about all year long that have been moving, just like marching up. They're blasting them to new highs right now into end of the year. And then a rotation into some of this stuff into the beginning of the year with the the implication of tax cuts, or excuse me, of rate cuts coming in 2024. Now, there's a caveat to all of this. And this March projection is, where are we in the timing of all of this? Like, are we timing this back into end of July, right, for timing when we actually get rate cuts? Or is it from this point forward? And when do you expect those rate cuts? Now, no one's going to want to tell you this, okay? But I'm going to tell you the truth, and this is going to piss off a lot of bulls. Okay, now, price will matter on this, but
Brent crude
there should be a front running, no matter where price is. I don't care if price is at 5,000 or if price is at 4,500. I don't care where price is, but I want you to know that regardless of where price is, banks are going to attempt a front running of rate cuts. So you should be keeping your eyes on the rate of inflation. You should be keeping your eyes on the unemployment rate and be thinking about when the Fed will actually cut. Roughly 1 to 3 months before that, you will see banks attempt to front run that eventual cut and begin to dump the market. So let's say we're at 5,000, right? They would dump at 5,000, and we might blast down to 4,800 or 4,600, right? If we're at 4,500, we could blast down to, say, 3,800 or even 3,600 when that eventuality comes to bear fruit, okay? So it is going to matter what price is, but you have to think about that as well when you're trading this IWM trade or this possibility of IWM outperforming. Do they cut it? Do they cut it short? Is it January and not March? That's the big question, right? Do you actually get that that effect on IWM of eventual rate cuts all the way into March, or do we end up getting a subdued version of that into March? Isn't rate cuts bullish? That's a complicated. That's a loaded question. Historically, no, they are not. Or no, they are not for where we are. So here, let me draw this out for you really quick. So our rate cuts bullish. Ready? Positive rates right here. Market. This is the market. Positive rates, right? Let's say this is the market right here, right? We're pausing, normal pullbacks, pausing, right? This is, hold on, let me bring this, hold on a second here. Let me bring this over so you can actually see it. Give me a second here. So this right here is the rates, okay? They're steady. This is the market over here, right? And it's just grinding, like higher pullback, higher pullback, right? Let's say this is in the future, and you have rates cuts, right? About 1 to 3 months before those rate cuts,
you'll see the market usually bloodbath, okay? And it will chase this, and you'll be like, why is this happening? Oh, God, why is this happening? And you'll see the eventual rate cut somewhere in here, right? And the rate cuts will chase price down. Does that make sense? And you won't get the bounce up until afterwards. So we're like right here. This is where we are right now, okay? So you're like, yeah, fuck yeah, everything's awesome, everything's awesome. You're looking for this 1 to 3 month range for this roll down. Now, this pricing could be 5,000, could be 450, 4,500. It doesn't matter where it is. But you want to be aware of this, okay? So when someone says rate cuts are bullish, fuck yeah, they're bullish. But they're bullish. But they're bullish, yes, they're bullish, but that's because we're trying to buy a fucking dip down here. Does that make sense? Not back up here. I think there's people misconstrued what that statement means. This always happens. Always. Every time. Every single time. Now, what you think is pain on that trade, is or price will matter what the pain on that trade is, I should say. Does that make sense to you guys or no? Let me know if that makes sense or not. Now, and you have to think about that into next year. That's not really a today thing. That's not really a today issue. But you have to think about it. Think about it when you're planning out your 2024 low to buy the market. And as a matter of fact, where I was talking with a friend yesterday, and he was expressing to me that this is a bear, right? But he owns the market as well. And what he did was back in November. So we can show this down here, right? Whoop, right back here. So back here, so we can show all this right here. Where's the low? Let me put on a 30-minute. So a whole bunch of people sold in here. The underlying, not trading, okay? I'm not talking about day trading, swing trading, none of that stuff. I'm talking about underlying assets in market. Whole lot of retailers got out here. Guess who else got out in here? I did. As we went into earnings, I was selling any green I got. So like I say, I went to an earnings on like Budweiser and a whole bunch of fucking tickers, right? Tyson Foods, you name it, PayPal, fucking you name it, any earnings that were good, anything that I saw green in my account personally, I took the money and ran. So I took my money out of the market, okay? Now I traded everything great, made a bunch of money. Had I left this underlying tickers in the market, I would have exceeded my target on the year for returns. So I missed a ton of gains for this year. Personally, I did. I missed a ton of gains. Now, my friend of mine had the same experience. Now, he's a bear, right? So he's been trying to short this entire run as well. He's not down heavy, but he's sore, right? He's upset. And the reason that he's upset is because he could have, even if he was shorting, he could have made money with his underlying, right? He missed out on all of those underlying gains. And he was on the wrong side of the trade going up, right? So he was risk off on the underlying, but he was also risk off on his thesis for the market. So he's shorting, getting run over, and then what his regular paying stuff is not making him any money. So he's got cash on the sidelines is my point. And I have cash on the sidelines. We both do. So we were discussing this last night, I think, and then I tried to catch up with him late night, but I was in a birthday party and all sorts of stuff, family and friends and all this kind of stuff. But the point is that he asked, well, when do I re-enter the market? Or when are you re-entering the market? And my answer to him was, you know, I feel like right now, so I've got my trader hat off, or I've got my trader hat on, my investor hat on, and I've got my Main Street hat on. And that's a big question, right? So I missed out on a bunch of gains. I mean, big gains, 6 figures. 6-figure gains I probably missed out on in total for just underlying money in the stock market, right? But when am I willing to put that money back to work? And that's the question. And I don't want to put that money back to work right now. I'll be honest with you out there. I feel like with my Main Street hat, that CNBC, Bloomberg, I mean, literally, New York, I've read it everywhere. New York Times, Washington Post, you name the publication, and they're out there trying to tell people, hey, rate cuts are in sight. You can come out from your hidey hole. And it's time to put some risk into your portfolio. Now, for me, and then the second thing they're telling, you know that realtors are out there right now. They probably had a fucking, sorry, I'll stop swearing. I'm not going to express it this way because probably kids out there listening. But the realtors probably showed up to their offices this morning and literally had a, an adult party with each other. And like rephrasing their pitches, recalling everybody that they've been begging to sell their homes for the past 3 years, right? And you know they're just going to spiel them with rate cuts are coming. We don't care what kind of loan we get you in, right? We'll get you a loan where when rates come down, they're going to go back to zero and you're going to be fine, right? And let's start selling your house. And furthermore, man, you should do it now because everybody's going to be doing it. Right? And you want to be the first one out before everyone's selling their houses on the same block. I'm sure there's that I'd be saying that to potential home sellers and buyers, right? Myself, I'd be saying that this morning. So as a matter of fact, I own 3 properties, and I guarantee this week I get flyers on my front door. I used to get them all the time. I get flowers, candy, door hangers, you name it, from people trying to get me to sell. So I'm assuming that's going to restart again at this point. So I've got my Main Street hat on. I'm being told as a regular investor where I just buy the stock market, I own properties, or maybe I want to buy or sell some properties. I'm going to get bombarded from like this from mainstream media telling me everything is fine. Come get out from underneath your rock. To me, from my experience, to me that's a dangerous thing. It's exit liquidity for banks. It's exit liquidity all around the board. So as it relates to the stock market, so I buy all this shit and the banks sell into me. I'm the bag holder, right? That makes me the bag holder. So they can unload onto me. So at least for my, not the real estate side of things, but at least for the stock market side of things, our discussion last night was with me saying, hey, I'll enter this market. If we've got a 1 to 3 or 5 year bull run coming, right? If we got that coming, what I can do is look for a low in 2024, rate cuts in 2024. I'll keep an eyeball out for a bunch of things. I want to see unemployment at 6 to 8%. I want to see the rate of inflation year over year, even if it's fake, bouncing off that 2%. I want to see the rates being cut, actually being cut. Wherever that low is, I don't care if it's at, I'll be honest with you, I don't care if it's at 3,800. I don't care if it's at 5,500. I don't care if it's at 5,100. I don't care if it's at 5,000. Wherever that low is, I will then re-risk my cash in the stock market. And I'll trade it. I'll trade it up. I'll trade it down. I'll trade it to 6,000. But until that happens, I'm unwilling personally to risk my cash in the market. I have real fear there. I don't want to wake up. I'll be honest with you. I don't want to wake up this summer, right? And I don't want to wake up this summer and you've got everyone trying to sell their homes at the same time. You have buyers out there that are willing to or not willing to pay high prices. You've got sellers undercutting each other. If you see the housing market crash,
you know, that's bad, right? That's bad. That's pain, right? If unemployment rate's going up, people are losing their jobs, and you start to see the market roll down hard and heavy. I want to buy that bottom. That's the bottom that I want to buy personally. Yeah, I'm not buying this. Well, I'll buy it, I'll trade it, but I'm not going to like come back in and buy Apple here at 200. I'm not doing it. Not for where we are in the stock market cycle and the business cycle. Just be careful out there. I know saying this is going to piss off a lot of bulls and be like, that guy's not a real bull, and that kind of stuff. You should see some infighting as well in the coming weeks and months amongst bulls. You should see bulls fighting with each other. You're going to get people. This is pretty crass to say, but I got to say it, okay? I'm going to get it out there at least in public at least once. This is pretty crass. You're going to get bulls that'll say things like, you're not a real bull, right, for saying that. That bull that's saying that could be anybody. You know, if I have $500,000 that I want to put into the stock market, that person speaking might have $1,000, $10,000, right? That person speaking could have his wealth could be $10 million to my $500,000, right? So if he's putting $100,000 into the market, it's not the same percentage as I feel like I need to be in the market, right? So you got to be careful on when you're hearing a bull speak to you or argue against that thesis. If you hold that same thesis, be careful who they are, what their motivations are, what their wealth is, all that kind of stuff. Okay, and I'm going to assure you guys right now that I got people in this stream, man. You can look at Binky, Joe Donut. There's a few people I talked to yesterday I'm not going to mention, but they're in this stream, and I'm not going to mention them, but these guys are all high net worth people in real life.
According
you can come
to
see us.
Money Market Fund
These guys
assets
have
slipped
pictures
to the
of me. I got pictures of them. They post stuff sometimes on the internet. These people have high wealth, and we're having these discussions, and most of us are sitting on our hands. I want you to know that, okay? Like if I want to go with $1,000, right? Buy the market, sure, I'd do that, but that's not my net. That's not my net worth. It's like what 0.00005 of my net worth. Just be careful out there of who you're talking to, where they're coming from talking to you. Your own personal investing, your own personal trading is only yours. Don't be listening to other people talk about what they're doing and be like, yeah, I got to do what they're doing. I'm gonna go. This guy over here he just posted on FinTwit that he bought $1 million in Apple today. You don't know if that guy has $100 million in wealth, and he just bought the market with 10% of that, right? Whereas you're going to slam down 20 grand, and it's every last dollar that you have, right? Does that make sense? What else? You need to, Smiley, I want you to look up, again, Smiley, I want you to look up tax loss harvesting, the January effect, and the rotation that should take place into the new year, and then ask me that question again. Yeah. Jeremy Irons explained it to me like a golden retriever. I love Citron. I love Citron, or Citron, however he pronounces his name. I fucking love that guy. Yeah, so for me, if you want to know what I'm gonna do this year, we'll have a whole program dedicated. I'll do a recorded program. There's two things to leave you with this. Number one, after we launch on Friday, you're going to get a private video for members, even the lowest member, so just not public. What you'll get from me is you're going to get an outlook for 2024, right? You're going to get some data from me from JP Morgan. I'll have links to data from JP Morgan. They remove these links. They're not available forever, but they'll be available on the write-up that I do. You'll be able to see what they're saying for managed money. I have money that's managed from them. So what I'll do is every year I do a write-up, and I'm going to point out sectors to be watching for the year, to be like, hey,
These are the sectors to be buying for 2024. I'm also going to give you an outlook for a macro outlook on the S&P 500 for 2024. If this, then that. If that, then this. That kind of stuff. And for 2024. And what else you'll get? Basically, that's what you get from me for the year. Now, that stuff won't come out until we're in January. Sometimes I'll do it in December, but it's sometime in like from now into middle of January. I'll get the information that I need, and then I'll do a big write-up for you. It's somewhere between the 15th of this month and the 15th of next month where I start getting all these fucking letters from JPM telling me what to do for 2024. Yeah, Mr. Phibbs is talking about the psychology of money, Chapter 11. Everything isn't the same for everyone. Why best bulls combat narratives. I'm going to tell you, if you're a bull, and I need to reemphasize this. If you are a bull, right, it is a very dangerous time for what you're consuming. It's very similar to when we're at bottoms and bears are consuming the wrong content. So you got bears on bottoms that are listening to the cacophony of we're gonna take a second leg down here, right? And it's exit liquidity for those bears that do not have the blinders on. They're not focused on what's in front of them. And as a bull, I assure you, into this year, it's fine for the market to go up, and it's fine for it to go to 6,000. Stick with your tools. You need to be vigilant in this environment as a bull. Again, with the IWM, I made a post. You can do an advanced Twitter search and look up IWM, RTY, small caps. I spell it SMOL caps. And I made a post, I think, 3 weeks ago or something like that. And as a big, long diatribe, like a 3 or 4 page post, made it public and just showed what to expect. I think I got that data from Trader's Almanac and some other sources for that post. But for me, if it was me, I'd be buying. For me, if you want to know what I would do, right now, I could give you all the easy, or I could give you all the complicated ways to trade it. What I would probably do is just buy some fucking in the money IWM calls for 2 or 3 months, like out past March. So like April, May, June, and I would be looking at the options chain for high concentration calls. Like where they're usually at 0s and 5s, and then I would go 1 full 5 strikes below that. So let's say everybody's on IWM. Here, let's take a look. Let me look at the chain right now. Hold on. Yeah, you know what I would be recommend if it was me, I'd be watching the chain over the weekend. I'd be watching IWM over the weekend. There's some large concentrations between 240 and 200. I would think that something closer to in the money would be better. And you ride that all the way, like you get. Well, I'm looking at the March 28th. I'd probably be looking at April or May or even June. And going a little bit deeper in the money and just ride it the entire way. When you're talking about what's launching for members tomorrow, what defines a member? Okay, I'll write that out for you right now. So we've got a free member, we've got a $10 member level, we've got I believe a $59 member level and a $150 member level. Launching tomorrow. So you're going to get all, what is that, 1, 2, 3, 4 levels. And you're also going to get some kind of Joe Donut's doing some kind of a hype launch on this where we are going to give big discounts out. So whatever prices I just said to you, those prices will actually be lower. There's a bunch of stuff for people that have been following for a long time that we're going to be launching here today or tomorrow.
Yeah, so you choose what membership you want. If you are, heads up on this, if you are a free member, right now, which is what everybody should be, right, free, your experience will be enhanced from this. So if you're free with us and you want to stay free, I do want you to know that you're going to actually get more from your experience that you have right now. Yeah, it's gonna be cool as fuck. It's gonna be really cool. I'd be stoked if I was like you and you're like, this is what I get from Captain for free. You're gonna get a better experience. My linking Twitch sub tiers to correlate with my member access of your site. Bork, I'm going to. I DM'd you yesterday. I'm going to DM you about that today. The idea here would be this. Let me see. I can say it publicly at least. So there are people that, believe it or not, there are people out there that only want to watch the show. That's all they want to do. Watch the show, either on Twitch and on YouTube, right? So if that's all you want to do, you have two options. You can sign up for Amazon Prime Gaming and chat for free on Twitch, okay? So that's your free, basic, free, like super free. I don't want anything to do with you, right? Fuck you, Cap. I want to watch a show. That's all I want to do, and I want to be able to chat. That's how you get your free option to chat. If you're like, Cap, that's all I want to do, but I want to watch it on YouTube, your option is to pay $5 for that access. And that's all you get. If you are a classic free, if you've been here free since the beginning, and you chat, right? We have a $10 level. That $10 level will be tied to Twitch and YouTube. So we want you to not be paying that $5 shit on Twitch and YouTube or having to sign up for Amazon Prime Gaming. And we're trying to give the ability so that if you pay $10, this is what you get. And this is our classic old school free membership level. You'll be able to chat on YouTube or Twitch. You'll get the Discord access, and you'll get your levels on our website in a pretty cool format. And I actually expanded those levels. I don't know if I hope that launches tomorrow, but you're going to get expanded levels as well. And then the reason we're charging the extra money is because of Discord. I have to do something in the background to kick out all the scammers, the bots, and a bunch of shit. So I got a job I have to do that costs money. So for the security and safety of our free membership, because we attract financial discords in general attract scammers. So that's that free level. Now the next level up is the $59 level. I think that goes down. I think there's a deal on that too, to make it even cheaper. But that level right there, you're going to get the tool embedded on our website for a list of tickers. It's all the indexes, all of the so you get like SPY. And you'll get ES, you'll get Qs, and you'll get NQ. You'll get, I think included in that is, don't hold me to this shit, but I think included in that is Apple, Tesla, NVIDIA, AMD, AMC, GME, the most traded stocks in the stock market. The next, and in that level, you're going to get some other shit. I think you get stock levels for the entire stock market. You get more access in the Discord. And some other stuff. And then the level above it, the 150 level, you get just the tool. You can do it anywhere, wherever you are. You run around, using the tool however you want, and then you get some unique support in our Discord as well. We have like a ticketing system or something in our Discord for the pro level, so that we can answer your questions whenever you need those questions answered. Also, there'll be a training program included for those levels as well for anyone that gets the tool either on the site or in the Discord. We have been diligently working on a training program for people at any level. If you're an absolute beginner, I started the videos on how to set up your trading view. Like, here, this is how you buy the trading view. This is how you don't buy the trading view. This is how you set your trading view for use of the tool. Or if you're just using the tool on the website, no matter where you are in your trading journey, there should be an answer for you in an educational program. There's some other things included in this will also be that I haven't talked about. We're rolling out a bunch of other stuff, but I don't think that happens Friday. You're going to get market briefs. You're going to get briefs from myself, briefs from
Another trader here is going to help us out with some briefs. I'm not going to name names. You're going to get a Sunday stock show. We're actually going to try to launch a nighttime video as well. Like Bob Kendall was doing that stuff. We're going to do something like Bob Kendall did. I heard that he wasn't doing it anymore, so we'll try to fill that space. But we've got a bunch of crap coming, like stock scanners, and we've got paper trading, and we've got a options profit calculator. That shit's all for I think the options profit calculator is free for everybody. We got a bunch of shit rolling out in the coming weeks too. Is my point. It's just taking some time. So you should see a baseline product, and then you'll see additions to that. Whatever level you're on, you're going to see bonus tools and bonus content. I got a whole Gamma thing coming out. Gamma, Gex models, historical charts. Really cool shit. Super cool stuff coming your way. So it's going to be cool. It's going to be fucking cool. No, you know what the cool part about this is? I want to say this again, or harp back on this again. So we're at a place right now where we've accomplished what we set out to do. And we're at a maturity in that. So we've matured into, hey, did we do what we set out to do? And we did. And we're at a place here where the question becomes, do we want to make this sustainable and grow? And if that is the case, we have to offer some type of a monetized greater benefit to our members. And we have a demand for that, or people are saying that they want that. So if we can provide that to people that want to pay, and if that helps us to keep doing what we're doing, that's what we'll do. And if it doesn't work, we'll just close it down. It's very simple. So this next step, the grand vision from myself for this next step is that it becomes it takes care of itself. I can keep the people that we've attracted over the years invested in what we're doing. Like, I want to keep a David AMS around. I want to keep a John L here. I want to keep a Blind Nest Owl here. I want to keep Joe Donut here and Quinn here. And Binky breaks his dick day in, day out. I want him to do a Sunday stock show, right? We've got other people, great traders out there that want to get involved with what we're doing. We got vol control, vol signals. I want to talk to that guy. When you try to, and there's some other stuff here too that I haven't discussed with you, but we're trying to do a network as well for traders that want an outlet, for an easy street outlet for them to get their stuff out to other people. There's like a Trade the Trigger network, but that we're trying to work on right now. But the idea being here, or the idea with this is that if we can take care of those people and keep them focused and staying with us and not just disappearing, this will continue to become a more sustained community. You know, one of the things that I'm scared of, if I have like a fear right now, it's that, there's, like people that want everything free. I'm fine with people that want everything free. I got no like ill will towards somebody that wants something for free. But I got to say this, there's people that want everything for free no matter what. And if where they're getting that free stuff remains unsustainable, there's a finite time frame where you can't do that anymore. And so we shut it down, right? Well, that person that only wants free, they disappear and they go find the next free thing. Okay. So it's not like I'm not trying to like talk down or bad about someone that wants something for free. So the only solution that I can find to that, and people that want to continue to see it keep going are going to be like, what the fuck, man? Like, why'd you shut it all down? So the only sustainable solution I find here is that people that want a more enriched experience, that are willing to support that, if they pay for that to happen, it only benefits the person that's looking for free. So if you're someone that wants this free, look towards people that want to see this grow, and they will, and they're going to actually provide you with that free experience. So that's where we're at right now. I don't know how to explain it. So, and then there's some other mechanics too. There's mechanics behind, is there value in what we do when it's free? A human psychology is to discount its value. There's a bunch of other crap behind this. Yeah, so I gave beta. Or we released beta testing for people, and I had to do some shit to the tool and move it. And so I ended up deleting everybody's access unknowingly, even my own and Joe Donuts. So I came back on Monday morning. I'm like, weekend's done. We're going to shut this down, flip it all over there and launch. And I come back on Monday morning. I'm like, fuck, I don't have access to the tool. I felt naked. I got emails from people that were beta testers, and they were fucking pissed. And, I mean, that's bad. But on the other side of things, it does mean that people are using this stuff in their day-to-day trading. They want it's like, hey, I want this, and I feel naked without trading with it. Joe Donut said it to me. Binky said it to me. And some other people said it to me. And I feel the same way myself. I wouldn't trade without it. I wouldn't personally trade. I wouldn't even buy this market without it. So, yeah, the pricing is justified where we roam. I think that it is. If it's not, you just call me up and say, fuck you, Cap. This thing sucks, or everything you're doing sucks. Here's another side, too. Let me talk about some of that enhanced free stuff. Like right now, it's a one-man show. It's a one-man show by me, but there's a bunch of people working in the background. Let's look at that for a minute. If I don't have the ability to stream, hey, Cap's not here. The tool's not here. What do we do? You kind of fucked, right? As a free user, you kind of fucked, right? If Cap's not posting on FinTwit, you're kind of left holding your dick, right? Invariably. When we monetize this, you're going to have other people with access showing it. You're going to be able to ask other people. I have the ability then to pay for people to stream, right? To post content, to be available for you on a more consistent basis. So, like that seamlessness and that more consistent basis and more consistent stream schedule, more consistent market updates, just consistency all along, more consistent user experience. Like, what do they say for like Apple and all these tech companies is you make something and you make it what? You make it user friendly, you make it ease of use, and you make it something that's that you need to have, right? That's useful. And we're not quite that right now, right? Because it's a free model. We're kind of like in this beta all around right now as to what we're doing. And I want to smooth that experience out for people. And so hopefully this provides that. That's the gist here. What else here? When does Captain's Alpha ETF Fund start trading? We are talking right now, or we've had some tacit conversations with. I don't know if I should say this or not. I don't know if I should say this. If I should make that public, but we've engaged at least a fund that we could maybe like dabble our feet into with. Let me ask you guys what you think of this. Let me ask you guys what your thoughts are. If you're in this program right now, listening, we were thinking about possibly teaming up with a prop trading firm, and so you don't even have to use your own money to trade. But there'd be like a combine or a boot camp from us. So we'd teach you as a day trader, and we'd put you through a combine, and you'd be trading other people's money. And I don't know the legality of all this. My attorneys are all working on this shit, finding out the legality of all this stuff and what kind of licensing I need and all that other stuff. But we're talking about it. Yeah. So we'd be like a combine. So basically, you guys would come to us, right? We'd put you in a training program. You get guys like John, you get guys like David AMS, you get guys like me or whatever. We like do a big like intensive training program with you, throw you into the fucking combine, and if you're like scared and you're like, oh, Cap, I don't want to lose 20 grand, and these guys will give you 20 grand for $200 or something, and we'll try to hold your hand through the process. Like, try to like find out what are you doing wrong, what are you doing right, and try to do that stuff for you. Yeah, prop trading is best for poor people. Yeah. Are you guys interested in that at all, or no? Okay, there's at least some interest there, right? Okay. That's a big project. It's like it's like a lot of legal shit I gotta do. I literally, so you guys might not know this. I don't have an attorney. I have a fucking general counsel. I got like, so these guys are like making sure that everything that we're doing is fucking legit, right? I don't want to be fucking, what's that guy, like all those guys that are like, they got indicted for like buying like a low float fucking penny stock or something, then dumping it or and selling into their own fucking members, and they got like scumbags out there fucking doing all this fraud bullshit. Like I can't do it, man. I got a fucking wife and kids. I don't want anything to fucking do with that shit. So yeah, you guys are listening to all those people. I don't want nothing to do with it, man. I got a like great fucking life. So anyways, that's in the pipeline. Don't hold me that that's definitely happening. I don't know what I have to do to legally to be doing that. So if whatever that process is, if it's a process of me getting a license, insurance is bonded. If I have to go to New York and there's something with FINRA, I might have to do. It costs like $50K or something like that. Yeah. Oh yeah, I used to be I've been in boiler room. When I was trading, my younger years, I was in boiler rooms. They're fucking nasty, man. You guys never been in a boiler room? There's like shot callers. Like you go in the Discord and there's like different levels of moderator, and they all get information at different time frames, and they're all like in the trade before you are, and then the fucking Discord goes out there in public and pumps it everywhere. There's usually a public face of the high follow account's disgusting. It's gross. As soon as I figured out what was going on, I was out of there. I was like, what am I doing? And I've been caught in a pump and dump. I was caught in a pump and dump during the beginning stages of COVID, and it sucked finding out. Yeah, I worked for a place called Duke & Company in New York. It's so fucking stupid. It's so like, it's so fucking stupid. It's so fucking, and those guys are, you want to hear something really fucked up? So I know a pump and dumper. I know one. I know a real one, and he's on FinTwit under a different handle today. I'm never gonna tell you who he is, but we talk, and all those old school pump and dump room guys, they're all older now. They're all like 50s, 60s. You guys know what they're doing right now? Those are the guys that are running all the fucking NFT and coin scams right now. The smaller ones, not like fucking Bitcoin and shit, but all the small shit that you see out there. A lot of that shit is being run by a bunch of old fucking scammers from like the 90s and early 2000s. You believe that shit? That's real. That's real shit. It's gross. And this guy has explained how they're run to me. And I was like, fuck. And the craziest part, you know why it's attracting all these guys? Because there aren't a lot of rules. There aren't a lot of FINRA and SEC rules on what a lot of the trading that's done like that. So they're like skirting around the rules of the regular stock market. It's been like a fucking boon for these guys. It's been like the biggest unicorn for these scammers in years. Yeah. All right, that's all I've got. I got to get back to work. I'll be back with you guys later. I'll put the CNBC on. I do have to shut the stream down exactly at 4 p.m. I have a conference call that requires a lot of computing power, and it shouldn't, but it does. I need like 6 screens open so I can reference, not computing, I guess, display power I need to have like 6 displays up so I can bounce around and sit in a Google Meet meeting. So right exactly at 4 p.m., the stream will be shut down today. Yeah, see that grind going on right here? This is the fucking, this is like even when they break up here, right? Coming in at the end of the day, what are they doing now, right? You're like, fuck yeah, I'm on 0 dates. They take you up here, and what do? Just start fucking grinding them, right? Start grinding your fucking calls for that that what you're expecting is a squeeze. Just fucking dust right now. Thank you for playing, right? Hey, you're welcome. Thanks all of you guys for showing up. Bork, I'm going to be reaching out to you today. Bork McGork is going, if you guys don't know, Bork McGork is going to possibly, if he says yes, this guy's really smart. I don't know if you guys know this. So I was looking at Bork. I checked out Bork in the background. He's a very smart guy. Very intelligent. We don't already follow Bork McGork. He's on FinTwit. He's been on FinTwit for a long time, very long time. I think 2009. And he's very smart. I didn't just like do a cursory look. I wanted to see what kind of a person he was. Very intelligent, very insightful, poignant, and looks like he has a cool life, whatever he's doing out there in the real world. So we're going to try to bring Bork McGork on and see if he is a fit. I don't know if he's a fit or not. He might be, might not be. If he isn't, we'll still be friendly with him like everybody else. But Bork McGork, we're gonna possibly bring him on as a Twitch administrator, and I'm hoping that he has some YouTube experience so that we can have more of a cultivated experience like when Winky was helping us out. Because Winky did a great fucking job, right? Winky was like right-hand man. Still, to this day, love Winky, but as an administrator, we need someone to fill that role, and it looks like Bork can do that. Like, he has experience doing that too. So if you don't follow him already, if you want to follow him, find him on Twitter, and I hope that he's the right fit. And everything I saw, I think he is the right fit. So I think we'll get along great. So I think he's got a positivity about him that members need too. We don't want, like, of course, Bork probably already knows this, but some of you have been around since the beginning. We don't want any dictator fiefdoms inside of our Discord or the website or the streams. We want happy, right? We want people to have a good time, want to be here. And Bork seems like he facilitates that, at least from his online presence that I could see. So yeah, Bork McGork, check him out on Twitter, and I'm gonna try to find it if we can get him to join our group. I'm looking forward to it, man. If you're I don't know if you're still here or not right now, but if you're out there, Bork, I'm looking forward to it, my man. Yeah, he's here. I can see. I just saw a post from him. It says, day job deals with making free textbooks. I'm all about it. Thanks, Bork. Yeah, man, dude. I was really impressed. I saw you. I actually checked out a lot of your replies across the internet going back a few years, and I really liked it, man. Your content was fucking great. Cool. All right, what else we got here? Anything else? Any other big questions? Anything that's not charting a stock for you? What do you guys got for me? You guys have any questions for me out there? Anything you want answered before tomorrow? Be aware. I already told you earlier. Be aware that there is a quote-unquote window of weakness tomorrow. Doesn't mean market crash. Doesn't mean we even go down. Just be aware that it's in. So, like, here's an example. So, like, today, yesterday, we know where the support levels are. We know where the resistance levels are, right? But there are days in a month where those levels, you might be like, hey, why didn't that level hold? Or why did we break through that level? And there's other mechanics in the background that are taking place, okay? It's the same thing as when we couldn't break through 4,600. We needed call side development to the upside at that point. We needed like 4,700 to open up, 4,650. We needed 4,750, and now we're looking for 4,800, 5,000 levels to open up to go higher, right? So there's like doors, right? Think of it like a door, right? A door is locked and a door is unlocked. Just be aware that tomorrow there are some unlocked doors in the market. Doesn't mean doesn't mean you walk up to the door and it's you bounce into the door and it's going to open. It's just that there is a door with a door that's unlocked. So if we were to have real money selling, real money buying, any of that kind of stuff, we can overpower the options market. Some of you guys understand that, right? That's really what a window of weakness is, basically. Real money buying, real money selling, overrunning the options market. All right, you guys want to see Tesla really quick? I'll show you Tesla. Let's take a look at Tesla here. I see the Tesla bulls in there. They're all wondering. Let's take a look. It's a Tesla 1-minute chart. We got the green bar up there, right? Go to a 30-minute chart on Tesla. Let's talk about it. Woo! Here's Tesla, a 30-minute chart, right? We kind of did this for you yesterday. All right, let's take a look and see what happened. I said, yeah, we're probably going to squeeze up here, break down, and then slam up there. What did we do? We didn't even do that, did we? We said, fuck you. Boom, right? I guess we did it, but then what else did we do? Rip up and slam into that green bar again, right? So we kind of did it. Not exact, but pretty close. And see it right there, right? Came, and I said, yeah, we're going to go up, right? We did one little bloodbath down, slammed up there, all right? Came back. Well, we didn't slam up there. I guess we could say we slammed up there, came back down right here. And then we had that nice squeeze up and got above, right? Did it sooner than later over here. We already did it. What's next for Tesla Bull? Let's look at it. Let's take a look. Let's go to the main trigger screen here. All right, and what are we doing here? Do you guys know what we're doing here? I don't know if you do or don't know, but this is what I'm going to tell you is happening. Fucking bulls caught in this. Blast down, all right? So you're a trader. We're gonna go back to this discussion from earlier of listening to other bulls, right? So now we're coming up, and I'm gonna promise you that there are people right there, people right here, people right here, people right here, and they're in your ear. They're telling you Tesla is bullish. Why? Because they're up here. And they're way upside down. So they're going to tell you, if you're not already long, they're going to say to you, we're going to the moon, we're going to the moon, we're going up here. Why? Because they just want to get out. They just want to exit over here. And what these people do is they wind up buying tops all the time. That's what they do. They buy tops. They're top buyers. So what happens is they get caught here, right? They get bloodbath. I'm going to talk the cycle to you. They're doom and gloomers, but they're still holding. They're still holding down here. They didn't get squeezed out down below, right? They made it through the pain, and now we come up here and they go, oh fuck yes, thank God I didn't sell, right? So we come up here and so they start telling their friends, they're like, oh dude, we're going to the moon, bro. But in reality, as we come up here, guess what they do? They fucking sell right there, and then they go, I'm just going to stay out of the market. I learned my lesson from over there. I'm going to wait to buy. You don't realize that when you're up here, right? While that guy's talking to you. Now, that guy that was talking to you before, guess what he does? Now he's sitting on the sidelines. He's watching all this action. And guess what he does? We squeeze up here. Or we squeeze up here, then up there. He's actually up here fucking buying again. And then he goes through the entire cycle one more time. So that's what's happening right now. You've got people selling into you. You've got of course, you got funds and all that selling into you, but then you also have trap buyers selling into you. So what do you need to do? You need to wear out all of these sellers that were trapped here. These aren't actually bears. These are probably bulls. Or you have bears, but then you have bulls doing it too, right? So until we break through these previous sellers here, we should be doing this. But this is all positive. This is all very positive. This is all very positive for more upside to come. So what I would like to see is, let's take a look back here. Right there, right? We're grinding all of that out right there. We're going to draw another one right here. These are more trap buyers up here, right? A little yellow bar right there. Whoop. Right there. You got another one right here. Small one right there, right? Then you got these two bad boys right here. Let's look at these back here. That's a beautiful one right there, right? 300. You might be asking, why am I drawing these in? It's because how much volatility do we actually have above us, right? Do we have these yellow bars all together, or is it just one or two bars? And then this is the squeeze right here, by the way, just so you know. Just a big old fat squeeze in here. Right there. That one's red. Okay. Right there. So this kind of shows you the path, right? For SPOOs, or for Tesla, right? You got a lot of sellers in here, and then you got a big old squeeze up here to 300, right? So I'll tell you this here, okay? You see that daily trend. This is very bullish here, extremely bullish. You want to see that trend continue to the upside. So you're going to be looking for some kind of trend, right? See some kind of trend. And you want to see price just keep doing what it's doing, right? Slam up, wear out sellers, come back down, slam up, come back down here, slam up, come back down here, slam up, just like that. Sit on here, Yahoo, everything's awesome. We're going to go to 300, right? Just like that. So as long as we stay on trend the whole way up and you're buying dips down here, you'd put your stops just on this trend, right? Stops down here, right? See any kind of like rejection. We pull back and we start to reject and start heading down, beating out previous lows. You're going to cut yourself out of that long thesis to the upside. The best place to buy was down here. I want to show you why. Tesla trades almost perfectly on negative daily velocity. Whenever I see like minus 50, minus 25, minus 50 on Tesla, it's time to buy it. So if you're already in down here, congratulations. You're just on the ride right now, just heading higher and higher and higher. If you're looking for a dip buy in your Tesla bull to continue on this trend to 300, see how many opportunities you've had. 1, 2, 3, 4, 5, or 1, 2, 3, 4, right? So you might be saying, oh, Cap, you just long this shit right now. I don't subscribe to that. I think I either want to see this first and buy that back test to get up there, or I want to see another roll down and just keep hammering away. Every time I go up there and hammer these, you're a buyer. If there's another roll, you're down here and you're a buyer, right? If we sit up here at any point, I'd be a buyer here too. So buyer right there, buyer above this green bar, or a buyer down in this trend line. So right now where Tesla is, I'd be taking the money and running. That's a trade. Now I want to see Tesla get above and sit here and then beat this previous high right here and start to grind all this stuff out right there. Actually, your next trade would be like there and then a pullback. Hourly trend, somewhere like that. So that is Tesla. I'll pull this down for you so you can have a better look at it. You can snap that if you want, snap a picture of that. I will say this, man. I mean, you're going to get this upside ramp on the daily velocity, but again, I still love these buys down here. Prime place to buy. Every one of these, see it right here is another one right there. You see it? Gorgeous place to buy. Catch a run. Gorgeous place to buy. You guys can snap that for yourselves. I do want to bring your attention to one other thing here, okay? I want you to watch one other thing here. Always like being a bull when the 1 minute trigger is vertical. Always like being a bull when the 5 minute trigger is at a nice steep angle. See that 1 and 5 minute trigger starting to flatten a little bit? See that, like a little bit of flattening going on there. This is a sign of consolidation and possible distribution. So be very careful here. We don't have a vertical red line and a vertical white line right now, do we? White line, red line, vertical. We don't have price above it right now. So we are in some kind of consolidation distribution at the moment on SPY. That's right, Canuck Mobile. Fair value gaps, baby. Fair value gaps, baby. You know what they are, Canuck. Some of you guys that are good traders know you like how you trade like that Tesla chart I just showed you, right? Canuck Mobile just brought up fair value gaps. If you have like 10 or 20 and you start building 50, 100 tickers, 200 tickers, and you just set alerts on those fair value gaps down below, even if you miss Tesla, there's going to be another one that does that for you. Exactly, brother. Low volume areas, my man. And that's where the pain is too, right? It's where the pain is for the bears and pain is for the bulls. Where the most pain is for bulls, most pain is for bears. Up and down. Everyone's crying and whining, and you're like, I'm going into buy right now. Yeah, volume imbalance is, yeah, absolutely. Volume imbalance as well. Hey, are you talking to David AMS, by the way? He watches those as well. David AMS is like, he thinks it's all pre-planned too. A year, like you can actually plan this out in a year in advance, quarterly, monthly, weekly, and daily. And he's mapping it all right now. Some of the stuff he's doing is insane.
So looking again now to the early market on close imbalance, still sitting at 305 million to the buy side.
If you're one of those traders that are looking for those gaps down below or on the upside to sell and to buy, dude, you'd be a wealthy person, wealthy individual. I was gonna do a post on Twitter. Horse Lover Fat's been making some really great content surrounding zero dates, and I wanted to throw a post out there about zero dates. All right. I'll talk to you guys later.
But again, I just don't think there was anything here that was perceived as surprising or remarkable relative maybe to what we've seen, at least like with AMD on the hope trade or clearly with NVIDIA, just given where their numbers are going. There wasn't anything. This was a CPU event. This was a PC and server CPU event. That's what this was. But that's all it was supposed to be. They never said anything else about it. If you look at their own press releases laying this out, it was to launch these two products. That's what they did.
All right. Well, we appreciate you being with us.
Yeah, you bet. Anytime.
I get you. We'll talk to you soon. Stacey Rascon.
All right.
Up next, we're tracking the biggest mover.
Just a note that I am looking for any risk on SPX. The 1-hour chart looks great. 4-hour chart looks great. 30-minute chart has a little bit of weakness. Down to 46.90 on SPX. 15-minute chart looks bullish. 5-minute chart looks kind of bullish. 1-minute chart's it's kind of okay. Five-minute chart looking like it wants to squeeze right now. Nice big fat squeeze. It's signing. This is SPX, by the way, if you're watching. This is a SPX 5-minute chart right now.
Come on, Bears, put your back into it. Nice. Art Cashin did come on today. That makes my day. They did wheel out Art Cashin today.
US 30-year yield falls more than 15 basis points on the day to 4.02%.
What?
So we're looking now to the market on close imbalance, sitting at 200 million to the sell side. So again, that's the market on close imbalance for the NYSE, 200 million to the sell side.
BC.
All right, we're 10 out from the bell. Let's get back to Christina Partsinevelos now for the stock she's watching. Christina.
Well, let's talk about Moderna shares rallying today after positive results from its new mRNA vaccine that reduces the chance of relapse or death by skin cancer, and they're reducing it by roughly half. So those results occurring when the experimental cancer drug is used with Merck's immunotherapy drug Keytruda, I should say. And so that's why the stock is up 9.5% right now. And a few airlines on the rise today after an analyst called Goldman Sachs naming United and Delta as its top airline picks for 2024. Goldman saying that Delta and United's exposure to the, quote, less recovered Pacific market gives them opportunities for growth, as well a stronger premium market. And you can see shares up over 1%, United up higher, almost 2%. Scott.
All right, Christina, thanks so much. Christina Partsinevelos. Up next, countdown to Costco, the big box retailer reporting numbers in OT. We'll give you a rundown of all the key themes and metrics that every investor needs to know ahead of that when we take you inside the market zone next.
Hey, just a heads up out there too. Tell all your Tesla bull friends. I will have a Tesla embedded chart with the tool on it that you can manipulate. So if you're a Tesla bull, I got some jams coming for you. What up, Diamond Dave? I see you out there. I see you, doggy. I swear to God, it's like, I gotta tell you guys something. I shouldn't be on here, right? I gotta tell you guys something. I gotta say this. This is real. So I went out yesterday to do a family birthday party, right? And then I had some time where all my friends were left, family left, and I was alone, right? And so I'm in downtown Detroit last night, and I was alone, and this is fucked up. I'm like all my friends, my real friends are online. I was like, I spend so much time with you guys here on stream. Like, we spend so many hours together every day. You guys are like my family. It's kind of fucked up. It's not bad. It's just you guys are my friends. Like you guys felt like my real friends in real life. Yes, last night or something. It was a really bizarre feeling, but you guys are my family, man. Like, I consider you guys part of my family. It's I don't know. I've never had like in that. I've had those feelings, but not in those circumstances. Like, I was like lonely, and I was thinking of you guys. Like, it was really cool, but really bizarre. It was like, really, like, right now I'm missing my online friends.
We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli.
I got on like the internet last night, and I was thinking about. So I like, this is what I do is like, so I get back to my house, right? My wife and kids went to sleep. I'm home alone last night, and I was like, you know what? I want to go see my online friends. So I jumped on Twitter last night to see my friends, and it was just the coolest fucking thing.
Today on the New York Stock Exchange,
just the coolest fucking thing.
Everything essentially but the Magnificent Seven and other big winners.
Not a bad thing. It was good. Billy Ray, 218, saying hopes and dreams for my new grandson, born by C-section at 3 a.m., been out of the picture since yesterday morning. I'm long SQ, which hurts. Is it time to close the position, or can I recoup some losses? Thanks to all. Billy Ray, we do have a window of weakness tomorrow if there was an opportunity. Doesn't mean we're going down, but there is an opportunity for some downside movement. Tomorrow is likely it for you, brother. Congratulations, though, man. Like, what's up, man? You got a new grandson. He's healthy, right? What's going on? Is he handsome? Did you get to see him? Look through the glass or anything to see him? Mr. Talking Monkey's like, Cap's all drunk, bumping into stuff, man. F this and that. My real friends are staying on the stream. It was really cool. It was a good feeling. It's not a bad feeling. It was a pretty good feeling. Like, my real friends are on the stream. My real friends are on Twitter. My real friends are in Discord. Like, my real life friends happen to be online. It's kind of weird. It's kind of weird. I never had that in my life. Like, I'll be honest. Like, I haven't spent a lot of my life online, so. They don't, or it's never been like where I've done 8 hours or 10 hours online. So it's just different. Something that's noted. Yeah, so here's Jeremy Hofstetter says, thanks, Cap. My friends are salespeople that I buy farm equipment from. Yeah, exactly, dude. Like, I'm with you, Jeremy. Like, I had this like realization last night. I was like, people that I care about are mostly online. I got like a few really close personal friends in real life, but I could count them on one or two hands. I don't have but I have like another real friend in life that's on the internet, and it's really, it's. I never knew how much that meant to me, I guess, in that aspect, except for when everyone was asleep last night. I'm like, dude, I miss my friends. And then I'm like, who are my friends? And they're all online. And it was really cool. It was really cool, not going to lie. Billy Ray saying, so weird, my baby girl is a mom now. That's awesome, man. That is awesome. Your wife refers to me as the guy. I've been trying to slow down with the swearing. I've been trying to clean it up. I have actively been trying to swear less than I used to. I used to be really bad. But I still swear, and I need to cut that out. I need to make this a little bit more polished and professional. What I'd really like to do, too, is, I don't know how this is going to roll out, but I'd really like to keep the, you guys know how I have a straight face on at Captain's Alpha generally, like 99% of the time. I'd like to move all of that stuff public on the Trade the Trigger handle. So if you don't like my rants on public, we'll have some kind of we have a Twitter handle called Trade the Trigger, and I'd like to make that the like a public persona that's the serious, soberish captain, and then keep my or bring back rein in my CaptainJimJames profile and make that just mine. So if you're like, fuck that guy, he's up late drinking, or by the way, I'm not. You guys think I'm drinking? I'm not. I'm either overtired or I've eaten gummies. I'll be honest with you. So I get all goofy and funny late night. Wife, kids go to bed, and I'm still awake. I don't get a lot of sleep. I don't know if you guys noticed, but I don't sleep a lot. I'm awake and working most hours of the day, and so if you ever see me online, but my point to the point where I'm trying to say here is, if you're like, I can't stand following him on Twitter because he gets on late night and he fucks around, goes finds his friends, all kinds of stupid shit that I do on Twitter at nighttime. You can either mute me at night, or what I was thinking was that I would instead of doing the mix of. And there's another part to some of the stuff I do, so I gotta tell you guys about some shit. So it's 4 p.m. Okay, I gotta get going, but I'll wrap this up with one last talk. So it's a mix of like shit posting and real serious shit that I post on my handle. Okay, intermixed in that stuff, I try to throw off scrapers like data scrapers, data sellers. There's a lot of data scraping that goes on Twitter, and bots, and like I could probably have 100,000 followers if I wanted on Twitter. I don't fucking want 100,000 followers on Twitter. I'd rather have 1,000 or less, I'll be honest, on my CaptainJimJames handle. So the less followers I have, the better off I am. When you start getting into like 100,000 followers, what happens is I have to be exact in what I post. It all has to be backed by data that I have to post. Let's say I see some data and I'm like, yeah, this is what's going to happen, and I'll post it, right? People are like, I want to see it. I want you to do this, that, and the other thing. So the more followers I have, the shittier the experience becomes for me. So my thinking here is, I'm not sure I'm going to do this, but my thinking here is after this weekend, you'll see all of the serious captain on the Trade the Trigger handle, and if you want to just be my friend like in real life, that CaptainJimJames handle will likely turn into no more, hey, this is gonna happen, that's gonna happen, I'm long, I'm short, or whatever. So you'll see more of like a I don't know, a combined at Captain's Alpha and the serious CaptainJimJames and the serious at Captain's Alpha shift over to the Trade the Trigger handle, and you might see a very toned down, just this is me, not anything to do with trading. Or it'll be shit posting about trading, but I'm trying to push like all this stuff off into this Trade the Trigger thing if I can. What do you? Let me think about that. Tell me what you think of that, because I know some people hate my fucking Twitter profile or personality. It's intentional. I want you to know that. If any of you guys don't know that, I have another handle that I keep a very straight face on. That's very fucking straight faced. So I don't know what to do here. I think I'm gonna switch to make a public straight face, and then this is actually who I am. You love the surly Cappy posts? I'm not, most of the time, I'm not that surly either. I'm just pointing something out. That's another thing that I can't do either. I can do less pointing out these days than I used to be able to. Like, you got 1,000 followers, dude. You can say whatever you want. Nobody's watching. Right now, It's like you get like 10,000 followers or more. Everyone's fucking watching you. I'm serious. It sucks. Yeah, Beartown Sheriff's making a point that's real. This is true. I want you to know, right, that some of the stuff that I post on Twitter that is a shit post, if that's making you angry, it's intentional. It's not that I believe it or that I am trying, or I'm even trying to make you angry. I'm not actually trying to make you angry. I'm just trying to make you think, right? It's never like, it's intentional that it's gating a reaction out of you. And mostly I'm trying to draw you in so that you're not angry, so we can discuss things or see what your perspective is, that kind of stuff. It's not like, hey, he's a fucking asshole. I don't hate anybody. I don't hate anybody. I don't hate anybody on FinTwit either. In reality, there's nobody out there that I really fucking truly hate on FinTwit. So if you're watching right now or listening to me right now and be like, I hate Cap or he hates me, I don't hate you in any way, shape, or form. And yeah, Beartown Sheriff, you're correct, man. I'm trying to attract bears and bulls and teach them how to be buyers and sellers that support and demand. There's part of what I do is about attracting young traders intentionally, so they have a place to go to learn, get tools, and become a better trader. Some of the stuff that I post, yeah. Yeah, I don't want to be a dickhead or an asshole. You know, and sometimes I do. I will say this too. I have shit posted before and pissed people off. And when I do, I delete those posts because that is not my intent. And I have done that. I've had probably, in the past 3 years on Twitter, I've probably had 10, maybe 2 or 3 a year that I'm like, fuck, I got to delete that. I'm being a cocksucker or a dickhead right now. Or I'm a fucking clown, or I'm an asshole, or insensitivity. Sometimes I've said things that are very insensitive. I used the word regard recently, and I had to delete that post. Not recently, but Winky was talking to me about it and was like, hey, man, you know, when we were young, that was acceptable. Today it isn't. And he was right, you know. So I went through and tried to delete all that shit because I don't want to piss people off. It's not my intent. We bring them here to you, career low. That's what we do with them. I'm trying to get them to meet you. Seriously. I want them to meet you and John L. and Raveology and Blind Nest Owl, David AMS, Stacy and John H. And all these guys are in these comment sections, right? All of you guys. Well, guys are in the Discord, the people in the community on Twitter, right? Hey, welcome to the community kind of stuff. All right. Oh, shit. I got to go. I got to fucking go. Dude, I'm in so much trouble. I got to go.